he confirmed that he thought that SVB and the banking crisis is not over and that it will be a 2-year period in which it unwinds. Most of us have forgotten or kind of forgotten about the banking crisis. He sees it's still ongoing because he's still buying assets from regional banks in the U.S.
Well, you see, that's what happens. You have the furor, the blow up, the emotional breakdown of some of these markets. And then, as he says, we evolve into this phase 2, which is quiet deal making, where these assets are being taken off the books of various banks. You look at all the banks that are going through various restructurings that we've covered, Santander, UBS, Credit Suisse, along with a number of others. But I mean, it was a great conversation. Do you know what I do in the afternoons? I actually listen into what you were doing. It's not a zero-sum game. We win, banks lose. When banks are in transition, it's a good time for private credit. But of course, you made the point, it didn't just come from anywhere, did it?
No, I am also so flattered, Manus.
You're okay,
I also
Danny.
feel like you probably have better things to do in your life than watch more of me. But
right now, I'm just giving all my life, my emotion, my money, every piece of me to the brokers of New York. Good morning from London and New York. And next up, we'll have Mark Dowding, the CIO at RBC, Blue Bay Asset Management. He joins Danny and I for a conversation on Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa, $1 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed. Because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. The Bank of Japan decision caps a busy week for central bank action. The yen continues to slide as policy remains unchanged with no clear signs of a shift. Yields march higher and stocks sink in the wake of a hawkish Fed shift. The Lachman remains short bonds while Bill Gross warns of more losses to come. And the euro also under pressure with more grim data suggesting the economy contracted in the current quarter. Still, though, good news when it comes to China equities, which you maybe wouldn't expect after such a down day in American stocks yesterday. But yet we had the CSI 300 Manus finish up 2%, a report that China is maybe considering changing some of the ban of foreigners to buy domestic equities. That's not supporting Europe, of course, why would it at all? Catching on from what the U.S. had yesterday, down about a third of 1%. S&P 500 futures, though, coming back, but just ever so slightly, Manus. The S&P fell 1.6% yesterday, the worst day since March. Outflows this week, according to Bank of America, have been the worst since December 2022. And Morgan Stanley says, beware of the fragility of this equity market. It is not a good picture for risk right now.
No, well, of course, it depends whether you think there's one more jolt to come in the rates market. It's almost like a Bible, isn't it? That Bank of America, the flow show, in terms of what Hartnett actually says. For me, it's all about dollar yen, and we'll push this conversation forward with Mark Dowding in just a moment. But what you have is, of course, and miles to go before I sleep. Not that I'm poetic, but it is about dollar yen. This is about not putting any blockage in the road from Ueda this morning. He says the distance to ending negative rates is not changed greatly, and so the real effective exchange rate trashed, hit the lowest level in 70 years yesterday, and still we wait to see whether the yen burst can be blocked. Ueda says price slowdown is not quite as much, so you have 148.18 on the board at the moment. What is the next moment for intervention? We'll come to that maybe with Dowding. 200 against the yen. Dollar yen is Martin Malone's call. That is a pretty stupendous call. Yields are just coming back ever so slightly. Don't forget, yesterday was a monster day. 30-year paper up 13 basis points. 10s up 9 basis points. And real rates are now firmly above 2%. The debate is from the bond bearer bills. In other words, Bill Ackman and Bill Gross saying, nah, you know what, these rates are not going to come that much lower. This price already is pricing 2% inflation for Bill Gross. More on the bills in just a moment. Crude pops a little bit higher. There is a little bit of a firming in this market. Why? Because Russia has announced a temporary ban on diesel and gasoline exports. Why does that matter? It's to remind you. It's to remind you who's in charge of the flow show in this narrative. And Russia pulling back on supply is to reduce our complacency, according to Halima Croft over at RBC. It's to remind you there is a weaponization of energy, and it's live and it's real as we go into winter. That's what the Russians have done. They've just gone, bosh. Remember us? We're here. We're in control of the flow. Danny.
Can we get back to the bills? I really want to get back to the bills, only for the sake of alliteration, right? Bill Gross, Bill Ackman, both of them are bearish bonds, bearish on the long end. One of the things both of them mentioned, Manus, and we just had Martin Malone mention too, is the spending coming out of the U.S. government. Bill Gross called it the government throwing money out of a helicopter.
Yeah, and he talks, I mean, it's just like whoosh, 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 whoosh. I'd love somebody to come and go whoosh, 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 whoosh with money to me at the moment. Deficits, 1.5 trillion for the first 11 months. And quite literally, it's that. It's whether you believe the fiscal narrative, again, Martin Malone pointed out the fiscal largesse of the US relative to the UK, relative to Europe. And that is in many ways driving the US economy. So it is about fiscal concerns, which are the dominant forces for the double Bs, Danny. But let's move the conversation along. Let's reflect back onto the dollar yen call from Martin Malone. 200 against the dollar. That's where we're going. And Ueda does not want a Bernanke-style shock. Mark Dowding is the CIO from RBC Blue Bay Asset Management. Join the fray, Mark Dowding. Good morning. Do you see any possibility dollar yen trading at 200? Is that going to be permissible? And if so, in what time frame? Good morning.
Good morning. Well, I think a call of 200 is frankly very far-fetched. Martin's a good old friend of mine, but on this one, I think that's a bit of an attention-seeking headline. I think the thing that I would really say, if you think about the fundamentals just for a moment, the honest truth is that actually the yen is a very undervalued currency. You go to Tokyo right now, and frankly, prices are incredibly cheap. By contrast, traveling to the States, prices are super expensive. I would have my own beer index. Having a beer in Tokyo costs the same number of yen as it did 30 years ago, whereas in the US it feels like a fortune to buy a pint these days. So the yen, you have to remember, is a very cheap currency. I think, frankly, it's just being undermined because of the policy dynamic of ultra dovish monetary policy coming out of the Bank of Japan. But we're confident that is going to change. The other thing that's been overlooked today is actually we've had an inflation print, a CPI print, which is above expectations again in Japan today. We're looking at core inflation at 4.3%. And the thing that I'd be very confident about is that policy change in Japan is coming. They'll make these policy changes at the quarterly meetings, not the interim meetings. So it's really going to be next month's BOJ meeting, the October meeting, where they look at their inflation forecasts, which is the one where you can actually see a change occur. And actually, we do hope that at some point, Ueda wakes up, smells the coffee, and says, actually, we have hit our 2% inflation target.
Mark, I got to stop you there because something weird is happening. And I got to ask this to Manus. Manus, is this a new economic indicator that I just totally missed out on, is judging inflation by beers? Mark, you're the second person to do this. Manus, was it Paul Donovan earlier this week who was judging inflation based on beers?
Yeah, I wonder was doubting going to judge my ability to find an apartment. I'm not in the townhouse market. I'm not in the Danny Burger sector. And I'm not a beer. I'm more a martini. I'm more sort of a frisky martini at around 9 a.m. when we finish the show.
I love that. I love that, Manus.
I'm not sure I can afford martinis.
It's 10:30, it's 5:30 in New York. No martinis yet, everyone. Okay, wait, Mark. So you think next meeting is where we get something? I know last time we talked, you said, look, the carry, it's going to eat into it too much. You can't play this through the dollar yen. JGBs is where you want to be. But I look at Ueda, who says that we are still a distance to ending negative rates. So what will change next month if it's not negative rates? That's going to make you comfortable continuing that JGB short.
Yeah, so I think the change comes when you change the inflation forecast. When you change the inflation forecast, that's a pretext to make another material adjustment in terms of yield curve control. I can see that 10-year yields drift up towards 1% in the wake of that meeting. And I think that then also becomes a precursor for a move on interest rate policy, potentially at the December meeting. At the December meeting, we'd see rates currently between -0.1 and 0, going between 0 and 0.1%. And although these seem like small changes in the scheme of things, the reality is that there is importance in terms of the signaling here. Once it looks like Japanese policy is starting to turn, this will take away some of the pressure that's currently on the yen, forcing the yen to continue weakening. What we can also see is the Ministry of Finance in Japan, they're mighty upset at yen weakness. They'd like the yen to be 130, 135. And so it was interesting earlier this week, we had the Ministry of Finance reaching out to Janet Yellen.
Well, here's the question then, Mark, very briefly. You're right. I mean, Yellen, any intervention by Japan to prop up the yen would be understandable if it were aimed at smoothing out volatility. So my question to you, in short, do you expect substantial intervention to quash the yen? I know you poo-pooed the 200 yen to the dollar. Briefly, do you see constructive, consistent intervention? Is that road now open, and unilateral intervention, will it work?
Yes, intervention is coming. If we move above 150, I expect the BOJ to be in, or the Ministry of Finance to be in. That will push the yen stronger, but it only will hold the yen temporarily stronger. What you really need, intervention's a short-term fix. What you really need is a change in policy here. Yeah. A change in policy is what's going to change the trend.
Hey, Mark. Stick around with us. Much more to discuss. Mark Dowding there of RBC Blue Bay. This is Bloomberg.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Brief. I'm Danny Berger in London. Manus Cranny is in New York. Manus, it was a tough week for virtually everything. Maybe save the dollar. Let me take you into the charts for a radio listening audience. I got stocks, treasuries, commodities, high yield credit. It's all on here, and it all fell this week. Was it the Fed, or was it just this whole week of central bank action as an opportunity to take the liquidity in the markets and have some wholesale adjustments? Let's bring back in Mark Dowding, RBC Blue Bay CIO, who's still with us. Mark, was this the capitulation? Was this, as you put in your notes, the decisive moment across markets? Did we finally reach it?
No, this is a small wobble, I think. This is not the big shock that we would be looking at as a buy catalyst. I think that the message is be patient. There probably will be a bigger, deeper correction at some point in the next month or two. That'll be the moment that you really want to buy. But at the moment, I think people are long and wrong. Don't jump in just yet. Be a bit patient.
Where's the biggest vulnerability? I mean, the Bible on this show is the Bank of America, the Flow Show. It's not quite the Bible, you know what I mean? We have our own Bloomberg T-Live and Bloomberg Analysis. But the Flow Show shows nearly $17 billion went out the door from global equity funds. So my question to you is this, where is the biggest vulnerability, Mark? Is it in equities? Is it to another propulsion higher in rates? What would you call the highest vulnerability?
Well, I think the vulnerabilities go hand in hand. One of the issues here has been that over the course of the summer, we've seen a return of the risk parity trade. People going long of risk assets and long in duration at the same time. This week's been interesting because both bonds and stocks have simultaneously come under pressure. And I think we can see a bit more of that. It's an unwind of some of the complacency around a soft landing is what we're currently witnessing. Yeah. And so for me, I think that looking at the flows are interesting. Preempting the flows is always difficult. But I would say at the moment, because managers are under performance pressure, they're long and wrong, wait this out a bit. You could get a better opportunity to dive in than you see right now.
So risk parity gets crushed as all these assets fall, Mark. You got 60-40, not performing, bond stocks both down. What is your favorite hedge? What is the best performing hedge then in this uncertain macro environment?
Well, we've liked credit indices as a hedge because credit indices in CDS are trading very tight relative to cash bonds. So that's an area we would hedge. Otherwise, in terms of looking for hedges, it's actually quite difficult at the moment, which is why I think you want a fairly clean portfolio. You don't want to have too much invested. Cash is king. Cash is king for the time being, but wait it out and there'll be a great opportunity to buy, we think, at more interesting levels.
Okay, if cash is king, how much should I have stacked in cash?
So depending what your benchmark is, I would be half weight relative to benchmark at the moment in terms of directional risk. I just don't like directional risk. You're not really being paid to take a lot of directional risk at the minute.
Mark, we also have a moment where the Bunds yields are at their highest since 2011. Is that not maxed out either? Is the ECB not maxed out at this point? Can you buy duration in Europe yet?
Again, I think the message is you're just a little bit too early on this trade. Remember that cash rates are substantially more than long-dated bond yields. And I think you can only look for a structural rally in yields when you can start plotting a course to lower interest rates. And that's not going to happen until inflation is materially lower. So I think it's be patient, be patient. I think too many people have been premature wanting to jump into a trade too early. And as I say, when investors end up long and wrong, sometimes that pretends to a moment of capitulation. And actually, the moment you really want to buy, is at the moment where everyone else is selling and going the other way.
So I suppose the question is then, what could prig that capitulation? What in your mind, what's the biggest red indicator for you that goes, actually, this is what I'm looking and watching at for the capitulation moment or time frame?
Yeah, it's the $64 million question.
Well, that's why you're paid. That's why you're paid by RBC Blue Bay to be the CIO, buddy, and that's why I'm an anchor.
Yeah, well, for sure. But I think that in terms of picking the moment here, look, I'd be looking at sort of certain technical levels on charts where I feel that CTA funds, for example, at the moment, they're going through some interesting triggers and they may be needing to sell more stocks. But in terms of looking for a catalyst here, what I really want to see to get much more bullish is more clear evidence that actually inflation is coming down. And you kind of know it when you see it, but the moment to buy is not just yet.
Yeah, Morgan Stanley's trading desk saying the same thing. We're almost at that moment of CTA for selling. Mark, my takeaway is I'm stealing the line from you. People are long and wrong. I love that. I'm stealing it. Don't worry, I'll give you credit for it. Mark, I'm owning it, and which makes it okay. Mark, hopefully I didn't scare you away. Thank you so much for joining us. Really appreciate your time. RBC Blue Bay's Mark Dowding. Enjoy your weekend. Now, coming up, we're going to take a look at some of the market-moving events to watch throughout the day. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
of State, Senator, First Lady, with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
We still think rates are somewhat too high over the long run.
As long as the politics lets the U.S. be exceptional, you can have higher yields and a stronger dollar.
Turning to the U.S., we are a lot weaker than consensus with U.S. growth.
Inflation expectations are fairly well behaved for consumers.
What we're seeing is the lagged impact of fairly aggressive monetary tightening really starting to bite.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
This is Bloomberg Surveillance live from the City of London for our audience worldwide. Good morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market positive here by 0.2%. It's been a rough, dicey couple of days in this market. Let's put it all together. Biggest one-day loss on the S&P 500 in about 6 months. Yields we haven't seen for more than a decade. Cycle highs on a 10-year, on a 2-year. This morning in today's session in Asian trading, we went through 450 briefly on a 10-year. We come back about a basis point, 448. TK, putting it all together, what a ride it's been over the last few trading days.
I'm going to go away from the equity market. I really take issue with the worry and the doom and gloom on equities. It's barely a pullback here with the VIX at 17.12, I believe, is a level. You think we had a 20, a 22, a 25 VIX. We got nothing. It's been resilient equity markets with the bounce back today. In the other areas, you're right, John, in foreign exchange, I'm telling you, it's an interesting study. It's not 1 or 2 pairs. It's like 10 or 12 pairs you can study. Sarah Vellis with us from Deutsche Bank coming up.
That's going to be very cool. Let's pick up on the euro weakness of the last couple of months, 10 weeks of it now against the US dollar. The resilience in the US data, the lack thereof in the European data. We've had some PMIs this morning in Europe, both in the UK and on the continent. And those PMIs, Lisa, are absolutely dreadful. I've used that word continuously over the last couple of months to describe European data. They are not good at all. And if you compare and contrast what we're witnessing in America, we'll go back to it next week. Just resilience, resilience, resilience. You look at Europe, breaks, 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 cracks, cracks, cracks.
It's getting worse. France really was shocking, coming in with the worst private sector activity going back 3 years or nearly 3 years. There's a question, at what point is the U.S. not experiencing the pain that it's going to experience versus is a completely different story than Europe? And really what has changed this week more than anything is which economy is most immune to higher for longer? Which economy is going to be weakest with higher for longer?
It's the United States, it has to be that with a dynamic sense. I do want to note that there is a surveillance adjustment here to French GDP off the Macron-King Charles soiree that we've seen in the last 24.
The pictures that have come from that.
Yeah, I mean, folks, if you want to recapitulate a Spielberg movie at Versailles, they succeeded.
Hugh Grant was there.
Yeah.
Arsene Wenger was there. Mick Jagger was there. I was not invited. Maybe the king didn't know I was in town. TK.
I don't know.
Could have got the train over.
But there it is with French pop. We're all going to run down to Paris here on our way back Monday to take the Eurostar, and it's a Brexit. Yeah. It's a Brexit Eurostar.
I always think those banquets are so tone deaf in times like these. But that's my view. Whatever that's
let them eat cake.
Literally.
Don't ask for high wages and let them eat cake.
Like Lisa's morning brief, there's pomp, there's circumstance.
Nice.
Very good.
You've been here too long. Equities on the S&P, positive here by 0.2%. Yields a little bit lower by a single basis point. Lisa, 448.23.
Today, Fed Speak does return. Fed Governor Lisa Cook at 8:50 a.m. I know that you're very excited, Tom. San Francisco Fed President Mary Daly. In Minneapolis, Fed President Neil Kashkari. Both of them are speaking at 1 p.m. At 9:45 a.m., following what we saw over in Europe, we do get the U.S. manufacturing and services PMIs. How big is that differential, right? How big does it have to be? How big of a surprise does it have to be to cause further dollar strength? And at 10 a.m., this to me is really important. You know, we're going to hear from the UAW. They're having a Facebook Live event in Detroit.
So is that for the public or for the UAW people? I think that's an important distinction.
Or the automakers.
Or both, right?
Okay.
The
idea here is that they are taking control of the message in a surprise kind of tactic. And I think that it's a good question because it raises a point of, you know, why is this time so different? Why has the tactic been so different for Sean Fain at a time when the auto manufacturers say, look, we're stepping to the table, we're going to bankrupt us. And he said, we have not gotten our fair share during the financial crisis. We have not gotten our financial share in the decade that followed. We have to get ahead of this before all of the technology changes.
One quick observation, the Fed speakers, what's the difference when they speak now versus Jackson Hole 2 cups of coffee ago? And the answer is real rates have moved. The story of the last 72 hours is 2.10% up to 2.11% on real rates. That affects every single person listening and watching.
Are we sufficiently restrictive now?
Yeah.
Dan Morris, BNP Paribas Asset Management, joins us around the table. Dan, good to see you.
Likewise.
Are we sufficiently restrictive now?
Well, I think it's more a question of the time than the level. I think from here, no one's really expecting big moves from the Fed. Maybe we get another 25 basis points. Does that really matter at this point? Probably not. It's how long do we stay at this high level? And the message they wanted to give from the dot plot is that we're going to stay here for longer than the market thinks. We'll go back and forth about that particular debate. But it's when the pivot happens, how quickly the pivot happens, that's what's going to determine whether this ends in a recession or just a slowdown.
To BNP Paribas and Banque de France excellence in the 20s and the 30s, I'm sorry, it's always been a real rate study. You people are steeped in this. How does our world change with higher real rates and inflation-adjusted rates back to December of 2008?
I think we look with a bit more history. We get, certainly surprised by these level of rates because we haven't seen them for such a long time. But pre-global financial crisis, of course, this was quite normal. And I think the stock market did just fine and the U.S. economy did just fine with rates at this level. So it's not so much the level of the rates that's the problem. It's the adjustment. We thought we had gone through that adjustment last year and that was rather painful. We're getting a mini replay of that now. But once we do get to what we hope to be relatively stable and a point for rates that they can start to move down, then I think the economy will be able to withstand it.
When you point to that era where the economy did just fine, it was also at a time where this was actually the rate being borrowed at. Right now, it is not for the vast majority of consumers and for the vast majority of corporations. In the U.S., they are not paying those rates. So have we really felt the effects of the monetary policy tightening that everyone talks about with shock, or is it a long way away?
Well, definitely have not felt the impact. And that's the whole, fundamentally the challenge for the Fed is to assess when is it going to come, how long is it going to take. But if you look at, I think, corporations by and large, they were smart enough to take advantage of rates when they were very low. They've, absolutely termed out a lot of their debt. You kind of consequently don't have the sensitivity to the moves in rates that maybe you had historically, which goes back to your point about resilience. So it'll happen, but I think it'll happen slowly enough that we don't see that in and of itself as a major risk.
Do you think the levels that we're seeing now, specifically in long-term yields, are the new levels that we're going to see for the foreseeable future?
Well, probably not at quite this high, but something with a 4 handle I think makes complete sense. Just a rough rule of thumb, if U.S. trend GDP growth is 1.75 or so real and inflation's 2 or more, it's a 4%. And I think especially what happened post the Fitch downgrade, I think it's levels now that seem much more sensical, if you will, than necessarily what we had when we were sub 4.
Do you sense this FOMC is confused?
I don't know if I'd use the word confused. Why do you say that?
Did you get a satisfactory explanation of what they're forecasting?
Well, if you always want to find a perfectly coherent and believable story between the dot plot and between what you get with the summary of economic projections, you could have a lot of fun. I don't know how successful you would be.
They seem somewhat mystified by how resilient this economy has been. Steve Englander of Standard Chartered's written about that in the last couple of days. They seem somewhat mystified about it. I think if you'd asked any of us 12 months ago what 5% interest rates would do to the US economy, we wouldn't have unemployment with a 3 handle and jobless claims down at 201,000, would we?
Well, I think that mysticism's pretty widely shared, if we're all honest. And it's justifiable insofar as we have never, ever had this scenario that we've had over the last 3 years between the pandemic and the stimulus.
So why is it the consensus view, Dan, that we are sufficiently restrictive when we're also mystified by how the economy is responding to interest rates?
I think it's more the response to what we now, if rates are at a sufficiently or at a restrictive level now, it's still the basic principles of economics are still going to hold in terms that that's going to slow down growth. It's just how quickly, that's where I think we've been much more challenged in assessing, understandably. I don't think it's a criticism of the Fed.
So BNP Paribas has been so good about nominal GDP guesstimates, about taking a real GDP and overlaying some form of inflation number on it. Do you frame the United States as a sub 4% nominal GDP?
Well, yeah, conceivably. We have to go back to, has the long-run trend growth rate of the U.S. changed in some kind of fundamental way, post-global financial crisis, post the pandemic. And, we still go back to, and we don't want to forget the longer-term trend issues that the U.S. faces, demographics and so on. But if there's an argument for that growth rate to be higher now, frankly, it does come back to AI. I mean, if the kind of fundamental key challenge that the U.S. faces, Europe faces, Japan faces, it's lack of labor, and if this is a way to increase productivity and at least lessen that constraint, that actually is the one thing that maybe gets you above a 4% nominal.
I look at this as just the arch issue. Greg Bowdle is more enthusiastic about equities, U.S. equities as well. Do you share his enthusiasm?
We're more cautious, actually, and it's as much an assessment of how adept is the Fed going to be at knowing when to cut rates. I mean, if we go back to, as we've discussed for 9 months now, about inverted yield curves saying a recession is going to come. Well, if that's, I think, fundamentally because the central banks in general have made a mistake and held rates too high for too long, that certainly can happen again. So I think our concern is that they are going to keep rates too high for too long. They're going to slow down growth too much. That's going to hit corporate profits, and the consensus estimates that we see for earnings estimates aren't going to materialize.
So the median projection of the Federal Reserve, if we were to ascribe a narrative, forgive me because I'm going to, they're essentially telling us right now that we can get back to 2% and unemployment
with
goes
no slowdown,
no higher than a little above 4%.
Yeah, we're not quite that
You're not
optimistic.
There.
No, nice story.
Of BNP Paribas. It is a nice story, isn't it? It's a story that they're not really telling, though, Lisa. They're just sort of projecting it without.
It's not their baseline, but it
much
is
about
their baseline.
Well, can you make sense of that? It's an objective, not the baseline. So our projections aren't forecasts; they're aspirations.
It was not a coherent, total message. I think that we can all agree on that. The key question to me is, where are they wrong? Is it how much inflation is going to come down, or is it how much unemployment is going to go up? Is it the weakness, or is it the strength? And a lot of people in the market seem to be saying it's the strength, which is the reason why yields in the long end are the ones that are rising so much more. There's a question of that, whether that's getting embedded in market expectations as they push against.
I think Arthur Burns in another time and place had aspirational smoke signals coming out of his pipe. There's just way too much information now, and all of it is predicated on guessing and forecasting. They're data dependent, and by definition, as Daniel correctly states, they're going to be ex-post.
You want less information.
I would like them to be more choosy, more surgical about the too much information they have now. Instead of, do we have 3 Fed speakers today?
I think we do, yeah.
I think
why not a 4th?
Look, I've said over the last couple of days, it's right to convey the appropriate dose of uncertainty that surrounds any forecast, and the chairman did a great job of that. I do think we need a sophisticated conversation about the underlying dynamics by which they're confused. And at the moment, it seems they are confused by how well this labour market has stood up to the interest rate increases they have done, which makes me wonder why we have any degree of confidence whatsoever about being sufficiently restrictive.
Correct.
That's a conversation we have to have with yields where they are right now at 450 on a 10-year and a 2-year pushing 520. If you are just tuning in, welcome to the programme. Equity futures right now just about positive by 0.16%. Coming up in the next hour, Sarah Malik of Nuveen. Tons to talk about. I think we should wrap up the calls of the week so far as well here in London. And Rita Sen with that call on triple-digit crude by Halloween. Maybe that's a story just around the corner. Max Kettner of HSBC, given everything that's taking place right now, still super constructive, still saying we need to focus on what can go right next year. But Lisa, when you see moves like this in the bond market, sometimes you just can't help but think, what could go wrong?
That's the reason why you're seeing people sell tech, which is the one thing that really did well. I mean, let's be honest, that's really what has been the gains in the U.S. equity market. It's almost entirely been the Magnificent Seven. You strip those out, you're up less than 2% on the year for the rest of the
I'm going to go to the trading envelope function on the Bloomberg. I'm going to look at standard deviation moves, and we're all addicted to normalcy and up, up, up. And the answer is you're allowed to correct 10%. We're nowhere near that in many, many series. We have not seen any pain. OMG, what was it yesterday, John? The VIX went 14 to 17, down 3%, whatever it was. That's another day at the races and another time and
We had
place.
a 1.6% move. We just haven't had a move like that for 6 months.
Dow Jones Industrial Average like a rock.
It's been fairly snoozy, even with a banking crisis, although Mohammed said don't call it a banking crisis.
He was right.
We moved on, didn't we? Let's see if it comes back. AMH in New York, up next from London. This is Bloomberg.
ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
As I discussed with President Zelensky, the people of Ukraine are steeled for this struggle ahead, and the United States is going to continue to stand with you. Today, I approve the next tranche of U.S. security assistance to Ukraine, including more artillery, more ammunition, more anti-tank weapons, and next week, the first U.S. Abrams tanks will be delivered to Ukraine.
The President of the United States, Joe Biden, speaking in a meeting with Ukraine's Zelensky. Anne-Marie from New York on the UN General Assembly in just a couple of moments. Let's get you up to speed on the price action. Equities trying to bounce positive by 0.2% on the S&P yesterday. Biggest one-day loss going all the way back to March. Remember the banking issues? Moved on from that pretty quickly. If I told you back in early March, though, that cycle highs on bond yields were in our future, I'm not sure what you have said back to me. 520, got close to it in the last couple of days on a 2-year, 450. We had a little look at it in today's session on a 10-year, 448.64, Lisa. Yields almost unchanged on the day, but what a move it's been over the last couple of days.
Ben Carlson, out on X, pointed out that the pandemic lows for Treasuries, and I'll just give you two denominations, 2-year 0.09%, 10-year 0.5%, now 5.14%, 4.447. He says, it's kind of crazy nothing is broken yet. I think we all can agree. When does something break, or does it not break because this is the new normal?
Well, I did say, and Lisa, I know you're on the same page with this, something did break back in spring. The banking system started to break, didn't it?
Which then was quickly remedied. So this raises a question, would we have felt the effects if policymakers hadn't stepped in to ease the frictions, the fissures that happened during some of the banking crisis that wasn't?
I always go back to that Torsten Slok deck over at Apollo, and he's got the delinquencies, he's got bank lending, all of that stuff in there. I was going to say all that good stuff in there, but it's bad stuff right now. So you are seeing that tightening start to come through. You're certainly not seeing it in a profound way in the mortgage market or housing in America, and we can talk more about that. But these are reasons why the likes of Andrew Hollenhorst, the city, thinks that maybe you see more price pressure, that the labour market does matter, that the housing market does matter, and that could contribute to a re-acceleration in inflation. That's why I think this Federal Reserve has so much uncertainty about the future, because there is that risk that those things materialise, and they don't want to entertain any kind of conversation about rate cuts anytime soon with that in mind.
At the same time, there isn't a lot of discussion about going much further and raising rates much further. There's sort of a tacit understanding that they've gone as far as they can go. And Jim Bullard was saying he doesn't believe in lag effects, long and lag effects. If he doesn't believe in that, well then you would have to assume that rates should be higher if we have unemployment rates so low and jobless rates coming in even lower than people expect.
I'm so glad you brought that up. That was an incredibly important statement by Dr. Bullard. The idea here of taking a model from the 50s and 60s from a goods and services America that was totally different, John, and bringing that monetary timeline out to the modern age, and he would say we transmit rapidly faster.
Credit to Bill Dudley, former New York Fed president, for writing that column in the summer. I think about a month before Jackson Hole, he was raising that question whether we'd already seen all the policy come through already. We've lived with it, we're dealt with it.
We're going to do the shutdown now, but before that, we need to look at something really shocking. Our Margaret Collins in Washington reports in conversation with Mr. Zelensky that there may be a winter war in Ukraine. That's an assumption not made. Anne-Marie Horton is very familiar with this, particularly with continental European seasonality and war. Anne-Marie, I was shocked by Peggy Collins' story, the idea of autumn, okay, I'll take it. But we're going to have a winter war in Ukraine?
Well, I think what you see from Volodymyr Zelensky, who was in Washington, D.C. yesterday, was that he wants to make the point very clear to not just American lawmakers, but the American electorate, that they are not going to stop in this counter-offensive, and they want to continue to try to retake these cities regardless of how difficult it may be with the harsh winter that you see, especially in eastern Ukraine. Peggy Collins, our bureau chief in Washington, D.C., was a part of a group of reporters that got to speak to him. I was more taken with, and I know they were pressing him about what was the conversation between you and Speaker McCarthy. And the quote was, in their private meeting Thursday, House Speaker Kevin McCarthy, quote, said that they will be on our side, according to President Zelensky when he sat down with these reporters last night.
AMH, we said it earlier this week, this is a wartime leader in Ukraine, and I think we have to say that up front. Just purely from an observational standpoint, not a judgment, do you sense a degree of frustration with the leadership of Zelensky within certain nations in Europe and across Washington, D.C., beyond the obvious places?
I would say this goes beyond even Europe and Washington, D.C. I would say that anyone who has been giving this individual help in the meetings he has had, there is a little bit of frustration for potentially how much the Ukrainians ask, and also the fact that these leaders are dealing with an electorate that is growing uneasy. There is a sense of war fatigue that they are all dealing with. Many are also dealing with upcoming elections. So this is a difficult one for Zelensky and a difficult line for him to walk, especially as we do know what President Vladimir Putin wants to do. Putin wants to keep this going at least until the U.S. election of November of next year. So Zelensky knows that he needs to keep the pressure up when it comes to the aid that he's asking for. But when you're not making a tremendous amount of progress in terms of the counteroffensive, the messaging becomes very difficult.
And Maria, how much is aid to Ukraine part of the whole debate that's factoring into the potential shutdown in Washington, D.C.?
It's factoring in a lot, because I would say that yesterday, one of the key things to watch out for, and we talked about it yesterday morning, was that vote at 10:30 a.m. And this was just a vote, a rule, to then allow the defense bill on the floor to debate it. And our Kayleigh Lyons spoke to Marjorie Taylor Greene, who voted no against that. And she had said that this was because of Ukraine aid. I'm trying to find the quote now. She said it was because of Ukraine aid. And she says, if you take the Ukraine aid out, I would be okay with even debating that defense bill. And I say this is important. It's not in the continuing resolution, but that vote was going to show how united McCarthy's party and his caucus is when it comes to keeping them together. But they couldn't even get a bill on the floor to debate. So you could see how far apart the centrists are in his conference and some of these hard right members in his conference. And Ukraine aid is one of those really big sticking points.
And Marie, do you expect there to be some sort of vote of confidence with Kevin McCarthy? Is he at risk of losing his House Speaker role?
Potentially. You know, you have the likes of Matt Gaetz, the representative from Florida, who says he wants to begin every day with the prayer, the Pledge of Allegiance, and a motion to vacate, wants to get rid of Speaker McCarthy. This will become a little bit more clear whether or not we will see it, depending on how the continuing resolution plays out. Likely there'll be a government shutdown. Likely you'll have to pass a clean CR, and then that would be a moment that potentially you see some individuals on the hard right say, you have not delivered for us, so we do not want you as our speaker.
Okay, that's an important distinction, Amory. We feel sort of out of the loop here in London. Let's cut to the chase. You're stating that you frame a shutdown as a likely occurrence now?
Yes, Speaker McCarthy has sent lawmakers home. They are not even in D.C. to vote. They can be called back, but some of them have left. So they are home now until next week. The government runs out of funding September 30th.
Amazing. MH, thank you. Anne-Marie over in New York for the UN General Assembly. I've got no idea.
He loves talking about this.
For those just tuning in.
That's sarcasm.
I really don't, for whatever that's worth. All right? I really don't.
I'm right there with you.
It drives me nuts. I think it drives everyone crazy. And maybe this is the real deal. Maybe we do shut down, put that together with a strike at UAW. Maybe you do slam the brakes on a little bit of a solid, resilient U.S. economy.
I want to make clear, particularly to our international audience, you know, I grew up in a house where there was hysterics about the debt and the deficit. That goes back to Hal Bronner and Bernstein's classic book. And John, a shutdown is not the same as an argument about the debt or the deficit and OMG, trillions of dollars, we're all going to die. A shutdown affects people who don't have the luxury of going to a font of savings to get through whatever. Millions of people and some in, medical and the
certain
rest.
people in
This is
certain
not
roles that
good.
will be going to work and not getting paid, Tom.
I just want to partition this from the fiscal follies over to a shutdown, which is absurd.
I hear you.
Absurd.
Let me get you the next 35 minutes or so set up. This is what the schedule looks like. George Saravelos of Deutsche Bank on foreign exchange is going to be joining us shortly. Dollar stronger again this week against the euro. 10 weeks of it. Lots to talk about there. Interest rate policy, the difference between growth in Europe, not much of it. Growth in America, pretty solid. And then we'll catch up with Roger Boodle, the Capital Economics founder. Good friend of this program, Tom, over the years. I know you're looking forward to that one. That's in the back half of this hour.
Boodle on the follies of London. There's a little bit going on. You think he drives an EV?
There's a lot going on. We can talk about that with him, actually. Equities on the S&P 500 trying to bounce from London. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Potentially the worst week since March, heading towards a third week of losses on the S&P 500.
Closer to Brammo
Equity
than me.
futures up, a lift here. by 0.2% on the S&P. What are you two talking about? On the NASDAQ, up by 0.4% on the NASDAQ 100. Futures doing a little bit better. Do you want to settle the argument now or on the next board?
No, it's good.
Honestly, can I just say this?
Sure.
Just because the market is down doesn't mean that someone who's saying that it is down is gloomy. They're just reporting the facts. And so good job reporting the facts and putting it into perspective.
Fortunately, we all fly on different airplanes.
We're bouncing now. Okay, anyway, you two carry on arguing. Let's turn to the bond market. 2-year, pushing 520 a little bit earlier this week. A 10-year in Asian trading, pushing 450, went through it briefly, coming back by a basis point. These are yields we haven't seen since 2007 on a 10-year. It's amazing to see a 30-year yield now looking at, what, 460 maybe? 456.39. Big moves this week. Cycle highs on bond yields. Resilience in the US economy. No resilience at all in Europe. Let's turn to the euro. The euro negative against the US dollar for 10 consecutive weeks. The euro right now 106.39, down by 0.2% on that currency pair. Tom, the data out of Europe, I've used that word dreadful too many times. Ugly, brutal, just not nice. Sub 50, contraction, France. Not much better.
Different shades here, and maybe there's all different stories to it, but the answer is they don't have the dynamism of the United States. It's going to be, where are they in November? Where are they as they drift into winter? And particularly if oil prices stay sustained. We haven't even touched on gas, natural gas.
Well, this is what we were talking about with Jordan Rochester, right?
Yeah.
Namora, you get the pickup in gas prices. That's the toxic brew, Bramo. Toxic.
There are a couple of them.
Under surveillance this morning. 3 holds across the board for major central banks this week. The BOJ joining the BOE and the Federal Reserve, leaving rates unchanged. Governor Ueda tamping down speculation of a future rate hike, saying this: because we aren't in a state where inflation accompanied by wage growth, sustainable and stable inflation, is in sight, we're patiently continuing with monetary easing under the current framework. The BOJ, I thought he made some comments recently that if wage growth remains buoyant into year end, they'll have a little look at moving away from negative rates. What happened to that?
I don't know. JP Morgan thought that maybe by the end of the year they could abandon negative rates, and by next year they could abandon yield curve control. Pushes back against that even after getting a hotter than expected CPI print in Japan.
North of 3.
Yeah. How much are they getting cover from the fact that he doesn't have to say anything and people are just quavering under the fear of some sort of foreign exchange interventions? They're not going to even bother.
Like us, they have different inflation metrics, including fresh fruit, and there's 40 other ways to slice it, including a Tokyo CPI as well. But the answer is, when we say 3 or 4% inflation there, it's not the same as 3 or 4% inflation in America or the continent of Europe. That is a whole new world, after all, for the people of Japan. That is high inflation.
Yeah, when you've been living with 0, no inflation, you get 3.
I think that's behaviorally and politically, that's the
key. Should we say that's like 6?
I haven't done the work. I don't know, but yeah, you can make that study. You can do it on the Bloomberg if you do a double chart overlay with 2 y-axes.
Nice. You should do that, TK.
My free time.
Let's get you your update on the big 3 automakers bracing for more walkouts potentially today as they remain far apart from the UAW on key issues, including job security and pay parity for temporary workers. Union President Sean Fain expected to make an announcement, as Tom just mentioned, through Facebook Live at 10 a.m. Eastern Time. We've got a deadline, Tom. It's midday. And ultimately, the deadline apparently with UAW is never midday. It's 2 hours before.
Exactly.
So there was a midnight deadline and there was a 10 p.m. news conference. So basically, if you don't have your stuff together, almost said something else then. By midday, he'll do a news conference at 10. Restraint. They'll do a news conference at 10.
Keep it together, John. That's okay.
Maybe make this strike a little bit deeper.
Where are the automakers? Am I surprised that I haven't heard massaged statements from various automakers?
Well, you have. They've talked about how it's unaffordable, and the 36% wage increase that you are asking for, that they're asking for, is not affordable. What I find interesting is it's not about the salary. It's not about the take-home money. And this, according to one union member, it's about job security and product. We need to keep jobs in this country. They're taking billions in tax incentives, EVs, but when it comes to keeping jobs here, they won't guarantee anything. And that is ultimately at the crux of the debate.
Job guarantees, the stakes are higher, big EV transition is not going to be straightforward. We're learning that in the UK. It's going to be difficult in the United States as well. I want to finish on this story. Apple's newest iPhones and watches went on sale in about 40 countries today, including Australia, China, the US, and the UK. Sold out pre-orders and long lines. Long lines, we're still doing long lines outside retail stores, indicate strong initial demand. Bramo is going to get a new iPhone 15.
Only because I cracked my existing phone. That's the only reason why. Yeah, but I'm not going to be waiting in line. I don't understand lines.
Why are they still doing that?
Because it generates excitement, demand. You're going to be in on it.
Apple, but like, why do you want to do it as a consumer? You can go and just, get it from.
You go hang out. You're the first adopter.
That's
you
still
can
a
go
thing.
to your friends and you can be like, look at all these cool
Is that
gadgets.
still cool?
I don't know. Am I cool? I don't think so.
Pretty sad,
I don't think
isn't
that
it?
I could do
Just
that.
lining up when you don't need to.
But except if you're with your friends and you're talking and there's the excitement around it and it gives you something to do. I don't know. I'm making a pitch.
Do you want to go to Covent Garden today?
Yeah, actually, I've been in that store now that you mentioned it, and the answer is no. I'm just taking it in because I think what Dan Ives would say is a bull on Apple is it's not an $1,100 or $1,300 or with 1 terabyte $1,600 transaction because you're slipping into it for $46.32 a month off some stupid plan at a company. I really take issue with the snobism and bad research of a lump sum purchase. It ain't happening.
I didn't do it either.
Yeah.
I don't think you did either. You do them.
I'm not buying the new one. I still owe money on this one. I called him up and I said, I didn't even know where I bought it. I'd forgotten where I bought it.
This is paid. We're done and dusted. Those payments
well,
are
then
done,
you can slip into, like Bramwell, you can slip into a new one.
Upgrading until they ruin it.
George is about ready to walk out of the room. Should we get to our guest?
I think you probably should, yeah.
Let's get to our guest. Joining us, and this is really, really important, folks. This is what surveillance is about. Joining us is George Servois, Global Head of Foreign Exchange Research. And as we had Jordan Rochester with us a bit back, you take a starkly different view. I want to set this up with selected firms saying Swiss franc dominant, lots of financial tension, Swiss franc will do better, others will do weaker. You go the other way. Why will Swiss franc weaken and other currencies will prosper in this time?
So thank you for having me. We did just publish our outlook for the end of the year, and we've been very bullish on the Swiss franc for more than a year, actually, but this is the first time where we've switched. And there's a couple of reasons. The first one is, and the most important, is the central bank. They came out yesterday and they've said inflation is now below target. They don't need to hike rates now, and they think they're done. And the fundamental reason behind why the Swiss franc has been so strong is because of the central bank that's been supporting it. So it's starting to look more attractive as a funder, it's looking expensive, and that's why we changed the view.
In the last 72 hours, and go with the real yield in America, but many other indicators, John's been great about framing out what gilts have done, what Germany's done, Bunds, what we've seen in the United States of higher yields. Is that, as a general statement, the ultimate fake-out rally in yields setting us up for a general global disinflationary trend?
Well, I think this has been the big question throughout the year. Are you going to get a hard landing? When especially does the US slow? Everyone's been focused on this US recession. So the key question we need to ask ourselves is, why isn't it happening? And there's theories around exceptionalism, AI, but if you look at the data, the simple reason is the Fed rate hikes are not being passed through. So for example, corporate interest payments are actually going down, and that's because everyone's on very fixed term borrowing. In the housing sector, you're in fixed mortgages. So the slowdown will eventually mathematically come, but it's just taking a very, very long time.
Are you seeing a cleaner, quicker transmission of monetary policy in Europe?
Absolutely, and I think that's the key difference if you look globally. So let me give you an example. If you look at average mortgage rates in the US, they're up by 20 basis points since the rate cycle started. If you look at Sweden, they're up 200 basis points. We're talking about a magnitude 10 times as different. So what's going on in markets is quite different to what's going on in the real economy. And I think this key question of transmission is what's affected this currency divergence, so to speak, and will matter a lot going forward as well.
I'll tell you what I see, and then there's a question involved in it. My observation is it's quicker and cleaner. It's hitting growth. It's not bringing down inflation. So can you help me understand why it's not bringing down inflation? Because it's meant to go as follows. Comes out of the central bank, hits growth, inflation falls. That's not happening in Europe. Why not?
So it's interesting you mentioned inflation. What I would say in the US is while growth is surprised to the top side, inflation is actually being surprising to the downside. So everyone's growth numbers have been constantly revised higher, but they're moving down inflation. So in the US, inflation is actually doing even better in terms of deceleration, and that's because the supply side's improving. In Europe, there's a bit of a lag, but if you look at the month-on-month numbers, so in the US, everyone reports inflation numbers in month-on-month terms.
Sure.
In Europe, we never get to see that. Month-on-month inflation in Europe's also slowed down. It's 0.2, 0.3 the last few months if you adjust for all the distortion. So it is coming down. I'd say that's one reason why we've got the ECB topping out, and the ECB sees that as well, and that's why they're topping out at 4%.
So why are you bullish on the euro?
Well, in the piece we just published, we're neutral, and I think the reason is this US exceptional story because of delayed pass-through. And if you look at Europe, rate increases are being passed through very quickly because it's a bank-based system. So most corporates have their loans against banks, so immediately cost of borrowing is going up. That's what's impacting growth. And I think the key question is, when does that catch up with the US? We don't have high confidence. You're about immediately to go into a very soft landing into the US, or a hard landing, so to speak, and therefore we're pretty neutral euro.
Why wouldn't you be negative on euro? Why wouldn't you see more dollar strength ahead?
Point number one, if you look at relative data surprises, they're quite extreme. So the market's really pricing this US exceptionalism versus Europe. If you look at the PMI numbers today, they actually surprise to the top side, excluding France, where there seems to be a bit of a statistical issue. But potentially the market's getting a bit too pessimistic on Europe. And number two, if you look at rate pricing, again, it looks pretty extreme in terms of that Fed ECB divergence.
Speaking to that sentiment issue, being neutral sounds bullish, to be honest with you.
Exactly, that's exactly what it is.
So far this week, George.
I would give you one example. People talk about car exports and how China's taking market share. And everyone has this chart of Chinese car exports going through the roof.
Yeah.
But no one shows European car exports. They're up 20% since COVID. If you look at the Euro trade-weighted index, it's actually at record highs. So the point here is, it's not the euro that's weak, it's just the dollar that's very strong. And the euro is actually pretty strong against the yuan, against sterling, against Scandis.
Within 24 hours of the Putin invasion of Ukraine, David Folkets-Landau sat with us, and he said there will be a fiscal response, a fiscal stimulus within Europe. Is this austerity still in Europe? Is the austerity mindset still within Europe, or are we going to see a fiscal renaissance within Europe?
Well, it's definitely changing, and if you look at this year, you're actually seeing the peripheral economies, so to speak, Italy, Spain, they're doing better precisely because of the fiscal stimulus that's flowing through the NGEU. But fiscal is definitely one story that's supporting growth everywhere. So to answer the point on inflation, inflation's coming down because of the supply side, but growth's holding in even in the US because you're still seeing delayed fiscal. So we've got the fiscal rules up for debate, but given the growth slowdown, I doubt we're going into austerity anytime soon.
George, this was awesome. It's always a clinic. Should we move back to London? Should we make that happen?
Absolutely.
You know?
We?
We.
We? Is this the royal we?
We?
Yeah, all of us?
Yeah, of course.
Yeah, we're all going to go to London. No, I think, the timing works a lot better.
Doesn't it? Don't you feel rested?
Like,
so much more relaxed. You know, wake up, have breakfast, go to the gym, tea cake.
It's shocking for those of you in America that have not been over here. The polarity between New York and London is never, to me, has never been greater.
Yeah,
never been greater.
We'll talk more about that, Tom. If you are just tuning in, welcome to the program. Your equity market positive here by 0.2%. In the bond market, yields just about unchanged, but some major moves this week. Through 450 briefly earlier on this morning, 448.44 on a US 10-year. Love our audience writing in. People stand in Apple lines to make money in the resale market, taking them back, selling them into other countries where it's hard to get. Chris Hutchinson, thanks for writing in this morning.
A lot of people writing in on your interview with Daniel Levy. I think we're going to play a little bit of this here in the 8 o'clock hour. Why did that make global headlines in 60-plus entities?
Because he barely talks is the short answer.
How did you get him to do that then?
We were working
Did you get tickets for Arsenal
We worked on this for a long, long time, and we finally made it.
Did he give you seats?
I've got no seats. I don't get anything in return. You think I get seats?
I thought you only did it to get into the derby here this weekend.
No, the interview was the gift. The fact he never talks and never talks to us.
I didn't know what to expect. I've never even seen the guy, frankly, but it was fascinating.
I think he was pretty open about what the club's gone through.
I was thunderstruck.
He's clearly in a much more comfortable, happy place to talk about the football club because they're doing so well so far, and they've spent a lot of time,
Ian Wright went mental. He went absolutely nuts. He saw
Arsenal striker.
Yeah, he saw what you did, and he's like, "Who is this guy? Let's get Farrell. What is it? Match of the day? John Farrell, match of the day."
I got some feedback. They wanted the Glazers next. Yeah. They wanted that as the next interview. Todd Bowley as well. We're trying to figure that out.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy.
That right there is the risk, and jobless claims in the last day or so speak to that risk. That was Jim Bullard, the former St. Louis Fed president, sitting down with the brilliant Michael McKee a little bit earlier this week. The moves we're seeing in this bond market off the back of that risk of higher for longer and maybe a re-accelerating inflation story in the United States, lifting yields higher on a 10-year at the moment, 448 on a 2-year. Let's call it 513, but getting really close earlier in the week to 520. So yields up, stocks down, dollar stronger, equities down yesterday, biggest one-day loss in 6 months. Futures this morning positive by about 0.2%. In the FX market, talked about this number a few times, worth talking about again. 10 consecutive weeks of euro weakness against the strong dollar. The euro against the dollar, Tom, 106.39. That currency pair negative 0.2%.
When we invented surveillance, it is all about what we just witnessed. To see the polarity of the Nomura Deutsche Bank call on the set of currency pairs we look at is the raging market debate that's out there into the end of the year.
Constructive Europe.
Yeah.
He used the word neutral, but neutral, let's be clear, the word neutral is constructive relative to the bearishness we have heard all week about the continent, particularly off the back of the data we saw earlier today.
This is an important conversation, whatever your politics. Roger Bootle joins us now, founder of Capital Economics, and what's important about that is the day they published, they were authoritative. He is a conservative voice in the United Kingdom with a shingle out at the Telegraph often. And we talk to him now, literally big time, going to rip up the script of what we have observed in the London battle of the Conservative Party, maybe an ascendant Labour Party. Tony Blair out, talking up Labour to a great extent. Bootle of Capital Economics, do you drive an EV?
Oh, certainly not.
You don't. You certainly not. You don't.
I don't drive. I don't need to enough.
For our American audience on radio and TV, it's basically London is under a debate that's encapsulated in what, Lisa? 2025 United States? Is that where we're sort of heading? Explain to our global audience how ESG and the timeline of the distribution of electric vehicles has been crushed by the Prime Minister, the conservative Prime Minister.
Yeah, this is really interesting because a succession of conservative governments following on an initiative begun by Labour laid down a pretty tight schedule for a whole series of green anti-climate change measures, including electric vehicles, heat pumps in houses.
Right.
This has been it's been an extraordinary episode because we all know that the ambition is fine. We want to get to net zero. That's fine. But getting from here to there has always been extremely difficult. And it wasn't clear that we could do that with existing technology, and it wasn't clear quite what the costs were. Quite frankly, I think British politicians have played fast and loose with the public.
Well, this is important. Farrow's been out front on this, way out front on this, talking about virtue signaling. The Telegraph mentions Rob Henderson up at Cambridge talking about the elites and how they look at luxury belief and lecturing and that. This translates across all of the Western world, and that we know what we're doing, trust us. Is that under threat right now politically?
Oh, absolutely. I think it's very interesting what the Prime Minister's done. I think he's been rather late in the day, by the way, because plenty of people in the Conservative Party have been urging this, but he's realised what the electoral penalty might be for carrying on, and equally what the electoral prize might be, because Labour, of course, have taken exactly the opposite tack. So we're now beginning to see the emergence of clear green water between the two parties.
I think this is really, really important. And what I want to say up front, Roger, this is not about denying climate change.
No.
It
is not about that whatsoever.
And Sunak said that.
This is about being transparent with the public about the cost of the transition. And Roger, I think the point that you're making is that we're not being transparent enough about how costly this might be. Can you help us put some numbers on it? Help us understand how hard this is going to be.
I can't put the numbers on it, but let me tell you, and Sunak quoted these figures the other day, what ordinary people are being asked to pay is an extra £5,000, £10,000, £15,000, and the dollar amount's not much larger than that, obviously a bit larger. Now, for well-off people and for the elites, this is chicken feed, but for plenty of people, this makes all the difference between a livable life and, frankly, penury. So it's been, I think, not, frankly, a very edifying episode of the last few years. Politicians living off hope and promise and aspiration rather than getting to grips with the nitty-gritty. And as you say, this is not denying the climate change point. There's another aspect I think is very important here. A lot of people don't realise that Britain has been in the forefront of cutting emissions. We've cut them very, very substantially. And of course, the big emitters are elsewhere in the world who, should we say, are not doing that much?
Maybe there's uproar right now because of the financial situation that the United Kingdom has found itself in. And a lot of people in the sort of back rooms are saying it's because of Brexit and it's because of the importation of a lot of the inflation and of some of the lack of trade deals. You scoff. Why?
Well, I have to mark your card if you didn't know. I was a Brexiteer. But even if I were not a Brexiteer, I would find it really rather tiresome the number of times that people just trot out Brexit as the explanation for everything that's gone wrong in this country. There's plenty wrong in this country, and there's been plenty wrong for a very long time. Nothing whatever to do with Brexit. I think it's quite clear, really, although Brexit has probably had a disadvantageous effect on the British economy, which I don't find entirely surprising. I thought that would happen. The scale is minimal, frankly. Look at the trade figures. Look at how we stack up against other countries. Germany has done far worse than the UK. And as far as I know, Germany hasn't left the EU.
Well, but some people argue that the lack of labor is directly tied to some of the immigration barriers that have sprung up from that whole affair. You're shaking your head again, but there is this question of, well, what are some of those effects? How much does that factor into the uniqueness of the inflation and slow growth that the UK is in?
Well, I don't think very much so, because the fact is that last year we had record levels of immigration into the UK, absolutely massive. And the difference is now these people are, of course, coming from outside the EU. Now, there could be something to the idea that EU workers were particularly prominent, as indeed they were, in the hospitality sector. And there's not a direct substitution between the workers coming in from the rest of the world and the workers that used to come in from the EU. That's possible. But there's something else here, you know. During this period where some sectors, including hospitality, have been suffering from a shortage of workers, public sector employment has gone through the roof. You might just as well say that the problems have been created not by Brexit, but by the overexpansion of the public sector.
75 years, I'm looking in the right column of a given paper, and the doctors are on strike at the hospitals. The NHS, by every estimation, including our NHS expert, John Farrow, is completely broken, busted. What can Americans learn from the failure of British medicine?
Right, well, first of all, the NHS is by no means the only, as it were, non-American alternative available for the health service. I mean, I'm not a great admirer of the NHS, nor am I a great admirer of the American system, by the way. And I think we've got to think clearly with imagination about what's on offer. Australia has a good system. Singapore has a good system. I think France has a pretty good system, actually, where you're asked to pay a sum to visit a doctor, always. And if you really are against your limits financially, you can reclaim that amount. But the idea is you're asked to pay. I think the British system of not having to pay for anything is straightforwardly bonkers.
Yeah, Uwe Reinhardt, Princeton, the late, great Uwe Reinhardt. Australia is the model.
I think the thing that people outside of the UK don't quite understand, particularly those in the United States, you can still have a private healthcare plan in the United Kingdom. That seems to be lost in this debate whenever I hear it come up. You can have access to the NHS and also have a private plan. If you work in an institution like Bloomberg in London, you will have private healthcare on top of your access to the NHS.
That's true.
And I think on a percent of GDP, the US is 16, 17, 18%, and UK is 10, 11, 12.
Yeah, some people might say the US figure is a little too high, to be honest with you, Tom, but we can have that debate another time.
One good thing about the NHS, there are some good things, is it has helped to keep down healthcare costs. I think the problem with the US system is you get massive inflation in healthcare costs.
Can you come back and actually talk about capital economics at some point? we didn't
start the conversation there next time.
It's Friday. Tuesday we would have done capital economics.
Roger, it's always a pleasure to see you, sir. Thanks for being with us. Roger Boodle there of Capital Economics. Take care of the tension of things in the United Kingdom at the moment.
I'll be blunt, folks. The newspaper debate here, Bloomberg News, FT, 47 other newspapers, I don't know. It's so much richer, John. It's such a more complex.
What do you think the difference is?
Screaming. There's more units with Mr. Murdoch retiring. He's the one that invented it. There's just more units. I've been reading the Sun.
I would say this about the UK papers. I think they're far more transparent about what their politics are.
Yeah, I mean, I look at page 3 or page 6 of the Sun, and I'm learning a lot about the British system.
Sarah Malik of Nuveen is coming up next. Your equity market's positive by 0.2%. From London, good morning.
The thing that strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction or they invest for if they invest for the right reasons, just keep at it.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I think we roughly know what the impact of monetary policy is so far.
I think the real core question kind of haunting markets at the moment is what is the neutral rate?
We're much more dovish on the Fed, and in general, we're much more dovish on growth.
A stronger dollar will be much less damaging to the United States in the short term than it is to other people.
Unfortunately, we need a recession to really correct some of those imbalances.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene in London, on radio, on television, on a Friday. And all we know is things have changed. After 3 central bank meetings, I've got to harken back to November 2008, John, because you're hot, then you're cold. You're yes, then you're no. You're in, then you're out. You're up, then you're down. The 10-year real yield is up. We are back to yields back when Katy Perry was telling us you're hot and you're cold.
Did you just want to sing that song?
I just did. I just in honor of Katy.
I think you've got to go back to 07 for where the yields are currently.
Katy this week sold, are you ready for this? She sold her publishing catalog this week to David Rubenstein.
Very cool.
To Carlisle.
Didn't know that.
That's what triggered in my head. And I said, what was Katy doing in November of 2008? You've heard John Ferro talk about the yield structure that out there. We're back to 08, 07, 06.
I'm sure David appreciates that rendition, Tom. But certainly, yeah, we've seen some massive moves in this bond market this week. It's been phenomenal to see the 2-year pushing 520, to see the 10-year going through 450, and still sitting here asking the question, are we sufficiently restrictive? Are we? The Federal Reserve thinks perhaps we are, based on the economic data we've had so far. There are others out there, Tom. I like to pick on Neil Dutta of Renmac often. Neil Dutta thinks maybe we're not. Maybe this economy could re-accelerate.
And pushed against a shock of the yields. Let's go to Krugman talking about plain vanilla and disinflation coming in. George Saravelis making the idea of the granularity of month-over-month or 3-month annualized statistics, as Furman of Harvard talks about. The answer is there are disinflationary trends in place. Lisa, it's not only the U.S. Saravelis suggests disinflationary trends in Europe.
How big are those disinflationary trends? Are they enough to really keep the ECB from hiking further, and whether they're going to drop rates lower? I think the big sea change this week is just the longer-term yields going higher. This is not being driven entirely by the front end. And yes, I am going to have Katy Perry in my head for the rest of the day, and we can't really move past that time. You're not allowed to start on such a distracting
You've got to see how he plans this show. We're both sitting there with the Bloomberg terminal sitting in front of us, and Tom's scrolling through the lyrics.
I know.
When Jordan Rochester was on.
What are you looking at?
Trying to work out what song and which verse he's going to use.
And that was
Have you got any more?
Hey.
Was that?
Look, seriously,
was that
and
singing?
we're going to interrupt the show here first.
We just did.
There's a great photo of a guy.
Now you're asking for permission to interrupt the show.
I'm interrupting the show right now to tell you that there was a great photo of Mike Bloomberg with Sir Paul. And one of the things to do in London right now with Bloomberg Philanthropy support is to go over to the newly opened National Portrait Gallery and see Paul McCartney's black and white images from 1963, 64. And when you're over there, she loves you. Yeah.
Oh,
yeah,
come on.
Love like that.
We're going to turn to the price action.
Please, let's do a data check.
CK's going to work on
Sarah
its next
Malik's going to walk off the set.
Sarah Malik, I hope, is still there. Equities on the S&P positive here by 0.3%. Yields come in a single basis point at 448. If you want to know where crude is, back in the 90s, up $1.04 today. $90.67, up by more than 1%. Right. And the dollar is stronger against the weaker euro, 106.43.
I want to hold her hand. Sarah Malik with us now, Chief Investment Officer at Nuveen. Sarah, the fear is out, price down, yield up. Should we be in a sense of panic or frenzy or caution, or is this a normal adjustment that we will survive?
Well, there's two issues the market needs to adjust to, and that's what's going on with the economy and what's going on with rates. The economic soft landing narrative is definitely being challenged, and the markets had started to price that in. So that's what the markets are adjusting to. And rates, of course, interest rates higher for longer, inflation higher for longer, all of that together is going to be a headwind for the markets also. We think long term, a lot of cash still on the sidelines. So I don't think the bull market's over, but short term, you do need to be a little bit cautious. The two areas we like are technology stocks and dividend growers. Technology stocks still less correlated to economic growth, so I think they can have a rebound from here. And then dividend growers is an area of the market that's really underperformed year to date, and they tend to perform well in markets that are going down, so they have less downside capture. And so those stocks I think are cheap and could protect portfolios and provide income.
Sarah, what you just said is actually incredibly controversial today. It might not have been controversial 2 weeks ago, but today, basically, you're going against everything that everyone is saying at a time when you have tech going down to such a degree and leading the declines. So how is tech defensive at a time when they potentially could be interest rate sensitive and when they have exploded? The big seven magnificent stocks have absolutely driven everything we've seen so far in terms of gains in the U.S. equity market.
Well, let's start with semiconductors, which is an area that we like. September tends to be their seasonally worst month in terms of performance, so not surprised to see that. They peaked out in about July, but if you look at the tailwinds for semis and software, which is our two favorite areas of technology, first of all, artificial intelligence, we don't think that it's hype. It's a real trend. It did get a little bit crowded, but I think it'll last for many years. Second, inflation has been increasing because of energy prices, which we think will moderate after the huge upswing that we've seen, and then continued services spending, which has been around for a while. That continues to moderate, another tailwind for technology stocks. And interest rates, we see the Fed basically one and done from here. One more rate hike. What got priced out of the market next year was 2 rate cuts. We didn't expect rate cuts for 2024, but as the Fed pauses again, I think these are all positives for tech stocks. So a few of these headwinds that have come in the last 2 months, as the sector did get crowded, will move out of the way. Also, looking at portfolio managers, they generally were underweight some of these mega cap tech stocks coming into this year. So you could see a lot of people stepping in for catching up to get their weighting in their portfolios to the right level. And then clients are holding still about 25% of their portfolios in cash. That at some point needs to come back into the markets.
Does it though? I mean, this is sort of the key question. Does it, if you're earning 5% on it? Actually, maybe it looks pretty good. And there's a question about whether we've actually seen the effects of rates that are now the highest going back more than a decade, 2007, 2006, depending on which denomination you look at. Are you saying that these are rates that we can live at? That basically we have seen the effects and they haven't been too bad?
Yeah, I think what clients learned this year was there was an opportunity cost for holding cash, especially when inflation is at the levels that it was, and the markets have done what they've done, year to date, even though they've moderated a bit in the last couple of months. Markets are still up well above cash year to date. So there's an opportunity cost for holding onto that cash. So I think clients are figuring that out. And when it comes to high interest rates, the 10-year at over 4% is a headwind for the markets, but it all depends on what economic growth does. And if economic growth stays strong, I think the markets can handle a 10-year that's at these levels.
Sarah, this discussion on technology is so absolutely critical. A huge body of retail has taken the story if institutional is not. Now, the gloom is rates up. There's a duration argument about technology. I get it. Where in the income statement will you see tech superiority? Are they going to outperform on revenue growth, or do you go down where they surprise with a better marginal free cash flow?
The answer is all of the above, in the sense that the good news for software companies is they don't need to rely on pricing power. And as inflation does continue to moderate, which we think that it will, software companies are less affected by having to lower their prices and hold on to pricing power. Margins are important for tech stocks. We saw that with Meta this year, where they were ahead of the curve in terms of cutting costs and preserving their margins, and other companies have followed, which is important too. And then strong free cash flow growers. You look at Broadcom right now as a company that we like. Strong free cash flow, ability to buy it back up to like 9 billion in shares. VMware is going to add free cash flow to their model. So all of the above for these companies.
Lisa's buying a new iPhone today at Covent Garden. Sarah, should she be also acquiring Apple shares at the margin?
Apple is a company we've not been as bullish on for many reasons. Number one is the post-COVID normalization of their unit growth. I think it's going to be an issue for them. And even with the upgrades to the iPhones, I'm a user of an iPhone myself, but upgrades have been pretty incremental recently, so they're not as exciting. I'm glad Lisa's excited about it, though. And also, their next big product is VR, which has a very high price point. So I think those could be struggles for Apple's, which has got premium multiple as people have that's been a consensus holding for many investors.
I just want to set the record straight. And Tom, you know this. I am not a line waiter. I am not someone who's some sort of rabid enthusiast. I cracked my phone, so at some point I'm going to have to get a new phone.
They're going to be in Covent Garden lined up. They're going to be, oh my God, it's Lisa Bramo. It's surveillance. Can we do a selfie?
Let's move on. Sarah, I'm curious, though, just as we sort of take a look at the whole week, is 60-40 still profoundly challenged at a time where we're seeing bonds sell off at the same time in tandem with stocks?
It was challenged in 2022. I think 2023 has had a better return for the 60-40 portfolio, but it taught us a lesson about diversification and alternatives, an area we really like outside of the traditional 60-40 is private credit. It also tends to be resilient to an economic slowdown, and I think that's really important right now, is owning areas in your portfolio that are less susceptible to economic slowdowns, can continue to grow. I did also have one more question for all of you, though. You talked about Katy Perry. Are you in the Katy Perry camp or Taylor Swift?
Oh, well, I got to go with Katie, frankly. But I love what Taylor's been doing with the National. I mean, she and Antonoff, what they've done has been extraordinary. She's going with the needle on GDP. I mean, can Olivia go out there and move the same needle?
You're asking him.
I'm not engaging. That's all. Was that a question for Sarah or me?
No, this is for you.
All right.
You're going to try to just completely ignore
Sarah, she's ignoring me. It's Friday. Thank God.
Of Nuveen. Wondering what on earth she's walked into. It took us about 2 hours and 10 minutes to ask a serious question this morning, and it was Bramo.
No, this was just...
Does 60-40 work?
But this...
60-40 work. Everybody sits down with a financial advisor. They walk into the room for people who don't know about investing, and they get told, do this. You ask them
You're
why.
100%
they
correct.
Give you a reason.
I also disagree with
And then they look at your portfolio, and they're going to look at things right now, and they'll say, but I thought you said that when this happens, and then this didn't happen yesterday at all. Treasury's down. Stocks down.
Yeah, but even over the last 18 months, if you look at the Bloomberg Total Return Index, 60-40 is tanked. And what's so important there is what Malik says of Nuveen is the zeitgeist of successful retail investing now. They bought 7 stocks as a generalization, and they're not selling them because they're the memory here. The memory back 3 years, 5 years, 10 years just says keep the apple, own it, and buy more.
That's enough. Give us another verse.
This zeitgeist. No, I just, I mean, Lisa's out there. She's going to be over at Covent Garden, and she's going to get up and shake the glitter off her clothes. That's what you get for waking up in London. I mean, that's what Lisa's going to be doing.
Nice. That's good. We've got another 40 minutes of this, haven't we? 50 minutes?
It's Friday.
Can't wait.
We did the thing. What we do, we have a huge tradition, folks, where we pull the strip, and Lisa won it. Lisa's going back in the Gulf Stream.
Very cool.
Yeah.
She gets the plane. Yeah. Nice. If you're just tuning in, welcome to the program. The S&P 500 positive here by 0.3%. Coming up shortly, in about 15 minutes from now, we'll catch up with Janet Henry of HSBC on the global growth backdrop. 3 big central bank decisions, no change at all 3, but there's one we've hardly talked about, and it's the BOJ. The BOJ just not really part of the conversation because they're looking at inflation in a completely different way, Lisa, compared to everybody else.
Because they're not saying anything. They're not saying what they want people to tell, like what they want people, what people want to hear, which is, when are you guys going to actually move? When are you going to recognize that data that you're actually looking at? And UAIDA's saying, we're not going to give that to you, so sorry, go home. And so we all are.
For them, it's not a problem, Tom. It is a solution to the issues they've had there for the last several decades.
I was honored, I kid you about tea. I was honored to take tea at the Bank of Japan a number of years ago, and it's from another time and place. This has nothing to do with modern monetary theory. The institutions are in place. They make the rules. These are the rules until.
Can I just say one thing in terms of clarifying all of the misspeaks that we've been having this morning? You say that I'm going to be on the Gulf Stream or whatever.
Well, it's a G,
and I just want to let you know something, that when we were coming home from Jackson Hole, the guy at the security counter said to me, why aren't you on the jet stream? Why aren't you on the Gulf Stream?
Yeah.
And I was like,
Did you tell him that I had the G6? Did you explain it?
I explained to him that you drew the straw.
I mean, to be honest, it's a little unfair.
To them.
Obviously. You're like, come on.
In the old days, Francine hogged the thing. She had it nonstop, jetting around doing the leaders with Lacroix thing. But now, it's more fair. It's a more equitable distribution.
It's a more fair distribution.
Democratized.
Yeah, democratized.
Nice. Communist even, almost.
Don't talk to me.
Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
How do you compare the pleasure of being Secretary of State, Senator, First Lady, with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
A little bit of strike fever is kind of coming to fruition right now. And when people get concessions, when labor unions get concessions, other industries, other labor unions say, wait, maybe we should do that too, or we can do that. It's not a frivolous decision, but it's a strategic decision.
Wendy Schiller of Brown University on the UAW strikes, the conflict, the tension between that union and Detroit's big three, Ford, GM, Stellantis. There is a new deadline for further progress, midday today, Eastern time. And if we don't see a sign of that further progress in the next couple of hours or so, we've got a Facebook Live. We calling this a press conference, Bramo? What are we calling this? An address?
What is it? Yeah.
Facebook Live address taking place at 10 a.m. Eastern time with the UAW president. Going into all of that, this is how your day is set up going into the weekend. Let's get you to that weekend as quick as we possibly can. Your equity market on the S&P 500 positive here by 0.3%. That's about from the biggest one-day loss going all the way back to March and all the banking difficulties that we had in the first couple of weeks of that month. In the bond market, I don't think the call was ever to see cycle highs after that tension, that those issues in the banking system in America back in spring. But to see cycle highs off the back of it 6 months later is phenomenal. We are pulling back a little bit. We're down 2 basis points on a 2-year to about 512, down 2 basis points also on a 10-year to 447. But to give you an idea, I don't know if you've been on vacation, hiding under a rock, in the last 24 hours, 2-year getting close to 520. 10-year in the Asian session going through 450. Just stunning to see.
We do this every day where we're completely jaded by it. We're, you know, it's been sudden in the last 48 hours with the 10-year real yield out to 2.11%, I believe now 2.09. But John, you know, you get off the plane in New York, and what's the first thing you think about? What's the 30-year mortgage rate going to be? I mean,
pushing
does it
8%.
go back out to new highs?
Pushing 8%.
You know, do you nudge up?
I think number one question we've asked is the right one. Okay, that's the mortgage rate if you want us to go and get a mortgage right now.
Right.
How many people are going to get a mortgage right now? So you've got the price of money and then the price people are actually paying given the agreements they've made over the last several years. So when do we start to see that great refinancing? Where in our future is it?
And again, it permeates for me down to a real yield and an inflation-adjusted yield. Let's remember 2.x% in the United States positive real yield affecting all, and the fiction of the United Kingdom where the real yield's still a massively negative statistic.
The unknown. Tons of uncertainty about the inflation story. But Tom, if they are seriously high for longer, if they're taking away all those cuts for next year, and if you're going to see inflation continue to make improvement, disinflation, then that real rate, Tom, gets even more destructive, doesn't it?
Absolutely. There's no question about it. And you know, we go to the residual math here, but that's going to be a huge theme into October. One of the themes we know is Keith Naughton and our team in Detroit will be glued on Facebook at 10 a.m., maybe to find out what modern UAW strategy is. If you're weaned on Walter Reuther, if you're weaned on George Meany of the AFL-CIO, it's a whole new world to provide wisdom with huge depth and perspective. Naughton of Detroit. Keith Naughton, I'm just going to cut to the chase. It's a whole new world after all. What have you learned about this new negotiation of 2023?
Well, it's really guerrilla tactics, Tom. You know, they are taking out different plants at different times. They're trying to keep the companies off guard, keep the companies guessing. So yeah, what we will get today is UAW President Shawn Fain will announce the next round of strikes. They've already struck 3 plants, one at each company, as you know, and they're going to probably strike 3 more. The question is which plants they'll be. Will they take down the big pickup truck plants that provide most of the profits for the big 3?
Each of these companies has a different character. I think that's underplayed. We sort of amalgamate everybody into Detroit in their immense support of the Detroit Lions. Forget about it. Which company are you watching? Which culture in Detroit will give you signals about a successful outcome?
Yeah, I think the company that's in the lead is Ford. Ford has traditionally had the best relationship with the United Auto Workers. They've actually made 4 offers to the United Auto Workers so far. They were the first to give an offer. As you know, Bill Ford, the executive chairman, great-grandson of the founder, he showed up to make a proposal in person, their most recent proposal. Sean Fain stood him up.
Keith, what's the big holdup? Do we have a sense now? Is it really the salary? Is it the mix of products being manufactured? Is it the sense of guaranteed workers at a certain level at a certain number of plants?
Well, it's really all of those things. They are very far apart on wages. The union has come down from a 40% request to a 36%. And the best the companies have offered so far is a 20% from GM and Ford, 19.5% from Stellantis. So there's a very wide gulf on the wage demand. But yeah, they're hanging over these talks is the electric vehicle transition and the battery plants that all these automakers are building that are not yet organized by the UAW. The UAW wants to make sure those future battery workers will get the same wages and the same benefits as the existing UAW workers.
Keith, when you say that these sides are very far apart, you talk about the distance between the two, and I think about how inventories are going to start being bought down of some of the dealers, the auto manufacturers as well. How much do we expect auto prices to increase? How long does this have to go on before people feel it materially when they go buy a car?
Right now, inventory is pretty good. The automakers really built stocks in advance of this. So industry-wide, the day's supply is 58, and what's considered ideal is 60. So right now, there's a pretty good inventory situation. But the more plants come down and the longer this goes, then it starts hurting.
Keith, what's your timeline? The one thing I can't get out of experts, I mean, I got a lot of punditry and that, but you people are so informed. I mean, even Craig Trudell over here in London is somewhat in the game. What's the Bloomberg timeline, your best guesstimate of this strike?
Well, we've spoken to one analyst who thinks that it can run to the end of October. It's very hard to know. There's some stuff that came out overnight, some texts from union sources that it looks like they really want to make this go for a long time to inflict pain. So it doesn't feel like we're very close to a resolution.
So are we talking F-150 now, Tom? Are we going that far?
They're going to go to the emotion of pickup trucks, which is the lodestone for certainly. Well, I'm going to go all 3 as an amateur, but I defer to Keith on that. But
Keith, just to make it really simple, is that like the last thing that they reach for, or do you think that's the next thing?
It could be the next thing that they reach for. If they really want to inflict maximum pain, you take down the Ford F-150, the best-selling car in America since Ronald Reagan was president. You take down the Chevy Silverado, you take down the Ram pickup truck. Those are the cash cows for Detroit. Those will cause pain immediately.
Well, Keith, the big hang-up here is how much money they have left at the UAW to keep paying people who strike. I mean, are they going to try to use it up? Do they have a limited amount of time, or do they have a lot of runway?
Yeah, so they have $835 million in their strike fund, and they're paying $500 a week to strikers. But so far, there's only 12,700 strikers because of this targeted approach they're taking. That's how they can conserve money in the strike fund. However, the companies are laying off people because there's this ripple effect that happens when plants go down. And the union has agreed to pay those people getting laid off as a result of the strike from the strike fund as well. So that will deplete it faster.
Interesting. Keith, thanks for the update. Keith Norton there of Bloomberg, looking ahead to this Facebook Live event at 10 a.m. Eastern Time, ahead of the supposed deadline of midday Eastern to make sufficient further progress. I sound like Chairman Powell over at the Federal Reserve, but we're looking for sufficient further progress in talks, Tom.
Well, I'm glad you brought this up. And, John, the pickup truck thing is certainly very emotional, but I was thinking, based on all my knowledge and heritage here, I just think UAW, they really ought to go after the Pinto and the Javelin. I mean, that's really...
Do you want to explain what the Pinto and the Javelin is?
The Pinto and the Javelin, to foreigners like you, is when we started buying foreign automobiles. They were so bad. They were so poorly designed. There was also something called a Suzanne Vega, a Vega. There was a Pinto.
You can't say he's a foreigner in the UK when we're in London. You can't say that.
No,
do that when I'm in America.
I know, exactly.
No, but
I mean, it's like you
the
can't
bottom
do it
line,
there either.
no, but seriously, when did we start buying foreign automobiles and why? It was because Detroit invented and engineered these monstrosities. They were all glass. They weighed a ton. They couldn't go around the corner.
First for bigger cars.
And we said we want to buy a Renault. We called it a Renault, I think then, and a Puget, and the rest of them.
Say that again. Say that again. The last one. The French
a Puget. It was a Renault. You bought a Renault Dauphine. The rich kids' fathers had a Renault Dauphine.
Did they?
And the rich art students, the art chicks, they had a BMW 2002
How much of this have I got to get through? Another 30 minutes, something like that. You're going to stick with us at home? I hope so.
Yeah.
Henry of HSBC is going to join us shortly. Sima Shah a little bit after that. All of that in the final 30 minutes of whatever this is. Live from London. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
He never never stopped for what it's worth. There was a break of about 3-4 minutes, but the conversation continues, and I'm still none the wiser. If you are just tuning in, congratulations. Your equity market on the S&P 500, positive hit by 0.4%. Session highs on the NASDAQ as well, up by 0.7, a lift off the back of the biggest one-day drop going back 6 months to the month of March. In the bond market, cycle highs, a 2-year, a 10-year, a 2-year earlier this week pushing 520, backing away this morning, down about 3 basis points. But to see a 30-year in the 450s, a 10-year in the 440s, and briefly overnight in the Asian session, a 10-year at 450 is just absolutely phenomenal. The Fed might be signaling maybe they're done hiking, but it's going to be at this level for perhaps a whole lot longer based on the way we've internalized that message in this bond market, Tom, this week.
George Saravelis gave us a window. He published literally in the last 30 minutes their outlook into the end of the year, and every shop has to do that. How do you publish an outlook with yields moving like this? You got to go, what if higher? What if lower? What if disinflationary trends click in?
Well, you had a dummy run from the Federal Reserve. How did that go on Wednesday? They published an outlook.
Your camp.
Then got a bucket of freezing cold water and just did that all over it and said, yeah, about that, no.
To me, I just think that there is one logical conclusion that we can have, and I feel like people are kind of dancing around this, which is that no one in the U.S. is paying the rates that are exactly being quoted,
the transmission
except for the U.S. government. That is it, right? Basically, the new bonds that are being issued, and even then, only on the margins. So how can we really say that we've seen the effects of this, right? But then how do we say that we are ever going to see the effects until 10 years later when all of these bonds mature, et cetera? So at a certain point, isn't this an economy that's just completely immune to rates and are going to have to go a lot higher than people previously thought? I mean, why is that not
we'll work through it.
part of the
For
discussion?
corporations in the next year, high yield, we know there's a maturity wall out there.
Right.
They'll have to pay it. If you wanted to buy a new car right now and you weren't paying cash, you'll have to pay it. It's just taking longer than I think we thought it was going to take, particularly when it comes to the mortgage market. Housing, I think housing's just its own beast. 30-year fixed, you're holding on to that 2% mortgage, you're not letting go, are you? So that's its own beast right there. But other parts of the economy, they'll feel it over time. Whether you need to wait or go further is part of the conversation. I think we're going into this quarter where we're hearing the same old story. That's the problem I've got with this fourth quarter. The fourth quarter, it's the economists that cried recession, and no one believes them anymore.
Right.
So now we're stacking up a whole new load of issues. Student loan repayments, headwinds coming from energy, et cetera, et cetera. No one's buying it anymore. No one's buying it anymore at all.
People believe in the strength, and that's why we're seeing yields get to such highs, even though everyone was saying, buy the long end, it's going to definitely go lower and go back to something more normal.
5 days into this sojourn in London, and after our great credit conference, we haven't even talked about Jim Zeltner on fire yesterday.
He's
fantastic. At the credit conference. I was like, you guys were going with him as bond people, and I was like actually listening to the state of the industry, which I never think about, but very, very cool. Thanks for the comments on that. The Julianic Memorial Credit Conference that we did there, I thought that was very good yesterday. We needed a voice near the end of our sojourn to provide balance and a view forward. There's no one in London that can do that like Janet Henry, global chief economist for the Hong Kong and Shanghai Banking Corporation, wired into Asia, literally like no one we talked to. You've got a lovely view. And then there's China. What does HSBC, with all of your contacts, say about the stability and the economic recovery of China?
HSBC has a perhaps more balanced view of China than some of the hysteria that hit the markets not so long ago. I think we're not going to get any quick answers one way or the other on China. And we need to learn to live with that. You know, financial markets always want to know with certainty where things are going to be in 2 years' time, and they want to price it today. The fact is, in China, what we have seen recently is some signs of stabilization in the economy. Industrial production showed some improvement. Retail sales showed some improvement. Credit data is showing some improvement. Are there still major challenges in the property sector? Yes, and we are seeing a gradual rollout of policy stimulus that is now being reflected in monetary data. Are there major issues in local government debt stocks? Yes, there are, but are they providing liquidity? Yes. This is a multi-year story of ongoing stabilization, and the next round will be structural reforms to deliver the long-promised higher quality of growth.
On monthly and 3-month annualized, and within your research note, we see a disinflationary tinge. That dovetails with Steve Major's long-term conviction of price up, yield down. That's been tested the last 72 hours. Do you guys stand with a disinflationary tendency which filters in to lower yield?
Well, from a macroeconomic perspective, for the last 2 years, Tom, as you know, I've been talking about a deterioration in the growth-inflation trade-off, a different mix of lower growth, higher inflation, and that probably requires a different policy rate level than we were used to in a pre-pandemic era. Yes, we have some disinflation, but there are plenty of risks out there. Even the Fed's Goldilocks view that they set out at the FOMC, the level of uncertainty around that they are admitting is quite high. But by the same token, it's not so long, as you've already highlighted, that everyone was forecasting a recession. First half of last year, this year, second half of this year, now a soft landing. The fact is, this is an unusual cycle. The last 3 years were unusual. Why does the market keep fitting with the idea that this is going to be a very ordinary downturn with a very ordinary Fed response?
Has something changed, Janet, from your perspective, the relationship between the labour market and price pressure, just based on those forecasts? And Chairman Powell himself hesitant to ascribe a narrative to a median projection, but let's have that conversation anyway. We have done over the last couple of days. They're essentially saying we can get inflation down to 2 with unemployment not climbing much above 4%. What do we learn from that?
We've learned that they are extrapolating what's happened so far.
Right now?
Yes. So you're right. I mean, it's remarkable. We've never been in the recession camp. We've been in the more protracted slowdown, the rolling recession camp, a couple of years of sub-trend kind of growth. But now the Fed has overtaken us on the unemployment rate. You know, we only had unemployment at 4% by the end of the year, but we've got it at 4.5% by the end of next year. The Fed hasn't even got that, having previously said that it was going to rise by more. It has been extraordinary that wage growth has gone from nearly 6 to just over 4, but the recent progress has actually been a bit slower. And everyone's talking about the strike. We don't know. It could be that actually there are other areas of the economy where, because of collectivized wage bargaining in Europe, because of public sector pay in the UK, because of strikes in the US, that it's not a linear story. Actually, it's a bit rocky on the way down, and the disinflationary process, as we've discussed before, is not continuous. We've got other areas of inflation volatility, and the markets are going to have to accept that they really are willing to keep interest rates higher for longer.
For people who go on the Federal Reserve website and they open up the summary of economic projections, should they view them as forecasts or aspirations? What are they?
They should view them, obviously, that every central bank, given their inflation targets, their inflation priorities, that is their primary goal, and they will do what is required to get there. Obviously, what we got in the Fed projections, and to some extent we've got in other central bank projections as well, is that they're almost willing to take a little bit longer to get there. The Fed is saying it's not going to be at target till 2026. And they have said that their central scenario is now that they can get there by being a bit slower, a bit more patient about getting there. They can get there without a traditional recession when the economy has some kind of deep contraction. But as no one ever reads page 2, page 4, question 4, question 5, what's your certainty about this range of forecasts? It's still very high. It's not where it was during the pandemic, but it's still high.
Are you basically saying that what we're seeing this week in markets is a sea change about our understanding of central banks' patience with such high inflation, that they will tolerate it for quite a bit longer, and that means it will become more entrenched in a way that people previously had not expected?
I'm not saying they will tolerate it staying at these levels, and they certainly will not tolerate any signs that it's reigniting, whether that's from wage pressures or elsewhere. They need to see further progress. They need to be confident that that progress is going to continue. And obviously financial markets, at the first sign that maybe a central bank is done, is celebrating the fact that the next move is going to be downwards. And actually, the more that financial markets do that, the more likely it is that a central bank that's trying to tighten financial conditions actually stops raising rates. So I think that what they're telling us is that they are determined to drive it lower. They might be patient about the timeline with which they get there, but they're not going to take any risk that it becomes entrenched. You had that from the Bundesbank again overnight.
The game theory that you just laid out, does that mean that the yields that we're seeing now are finally self-fulfilling and will actually create or foster the tight credit conditions that are necessary to get to the Fed's and the other central bank's goals? I mean, in other words, do you think that these are sustainable, or do you think that this is what we need to get lower?
I think how financial markets react, obviously I'm just the macroeconomist, will be a function of what central banks obviously do. But the central bank is trying to tighten financial conditions. It's trying to slow demand. They still think by slowing demand, they can impact on inflation and ensure that the inflation continues to slow. But we keep talking about all of the uncertainties that are still out there. We've got a renewed inflation volatility, not least from oil and from food. We've still got uncertainties regarding labour markets. The truth is they don't know what they're going to have to do, which is why, as well as saying we're ready to raise rates higher, we're ready to keep them on hold for a very, very long time, it's actually all still about the data dependency. So yes, they're still watching all of these factors as long as they can see progress, whether it's a consequence of higher yields, whether it's a consequence of what's happening in equity markets, whether it's a consequence of what's happening in spending behaviour. As long as they see the inflation data coming down, that will be enough to become more confident about the medium term.
I have to ask this question, and it's with immense respect for what HSBC and like Bloomberg went through with COVID. I mean, we've heard from the quarantines of HSBC and the travels during COVID in China. You walk out of the Bloomberg building in Hong Kong, you go across that historic tramway, and there's one Queen's Center, your building, your place. It's the foundation of Hong Kong finance. What's the stereotype right now we most get wrong about the new Hong Kong?
That is a very broad question.
Well, it's a Friday, so we go with broad questions.
It is a Friday. Yeah. But actually, as an economist, I always think that sometimes we think about countries. Obviously, as an economist, I love it that people want to talk about countries. They want to talk about central banks. But a lot of the things that happen, whether it is in Hong Kong, whether it's in Dubai, whether it's in London, whether it's in New York, is actually more about sectors and it's more about companies. So whatever view you have regarding the macro story, when we're thinking about where the true transformational shifts lie in the coming years, and a lot of it is in technology, there is still a lot of dynamism and there's still money being provided to companies.
I'm going to make some news here. 10 seconds. Are you a Hong Kong
trying to cause some trouble? That's what you're trying to do.
Am I a Hong Kong?
Are you a Hong Kong
Absolutely. As someone that lived in Hong Kong for 5 years, I'm still a Hong Kong optimist.
Are you done on that subject?
I think it's important. I think HSBC, Steve Major,
agreed.
Janet Henry, these people have a prism in there. All the stereotype blather we deal with. Our Steve Engel.
Since we're causing trouble, I miss David Bloom.
Yeah,
so
well, he's trouble.
He was great. He was trouble too.
He's trouble.
Janet Henry, thank you. Of HSBC. Appreciate it. It's good to see you. If you are just tuning in, welcome to the program. Equities right now positive by 0.4%. Yields a little bit lower by 3 basis points to 446.81 on a 10-year. Seema Shah of Principal Asset Management is coming up very shortly, Bramo, to round out our week in London before you head off to New York.
It's been quite a week, I have to say.
What's your big takeaway?
My big takeaway is that people are pricing in higher for longer, and people are pricing in this idea that it's going to take a lot longer to get inflation under control, and that suddenly there's a question about what that does to the fundamentals underpinning the market. If rates really are higher, suddenly you get those tighter financial conditions that weren't there earlier when people were just expecting the Fed and all the others to cut.
Which I'm listening to people pushing away from that, like Janet Henry and Ms. Malik over at Nuveen. She was starkly opposed to that cautious outcome. Starkly opposed.
It was the first time, I think, in the last couple of days where we've started to see those high yields hit risk. I checked high yield spreads this morning. At least they're a little bit wider.
Exactly, that's
given what's happened in the bond market, because they haven't been at all. They're still sub 400 for what it's worth. Still pretty tight on a historical basis. Equities right now positive by 0.4% on the S&P 500. To wrap up our week in London next with Seema Shah of Principal Asset Management, live from the city. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
My feet are firmly on the ground. We've played 5 games and we've started off well, but it's how you end that counts.
The mood around the club seems to have changed. Big Ange, has he changed that?
He's had a very, very big impact. We wanted a manager that we need to go back in time to our real DNA, and we needed somebody that understood that, you know what, there's no easy fix to win. We're very much a club that believes in the academy, producing players that can become hopefully superstars at Tottenham. We're not a club that can buy success. That's the reality, and we have to understand that. And we needed a manager that was completely aligned with our philosophy.
A better mood around Tottenham Football Club going into the North London derby this Sunday. That was Daniel Levy, the Tottenham chairman, talking about the impact of the new manager and the impact that manager has had at the club this season ahead of Sunday's derby against Arsenal. You can watch the full interview with Daniel Levy on Bloomberg's YouTube page and at bloomberg.com. TK, that's out
play
there
it down.
right now.
Come on, this thing went worldwide, folks. For those of you that don't follow this foolishness, this is the most substantive interview in English football in ages and ages. I looked at one German website which tore about, John, your work, and also 2 other outside sources on the future of Mr. Kane and when he comes back to the United Kingdom. What I don't get is Daniel Levy, with no government funding, with a lot of bank loans, built a palace. He described to you the free cash flow, and he's sitting there crying poor that he needs an academy to build the team. I don't buy it for a minute. Is he one of the rich guys like the Saudis and the rest of them, the Qataris, or is he as poor as he led up?
I wouldn't use the word poor, that's for sure, but I wouldn't use the word rich or as rich as the likes of Saudi Arabia. And competing with sovereign nations is really difficult. The beauty of the stadium that Tottenham have built is it's multi-purpose. So the pitch can go away, then you can have a music concert. The gate receipts, he was talking about the numbers, north of 100 million sterling. That's just for football. Another 30 million.
So Katy Perry can go in and go, if it's hot
Beyonce,
and it's cold,
she might want to sing that. Let's see if that sells out. I don't know if it will or not, Tom, but ultimately, yes, and they can raise more money doing that. It's made the club, as far as he's concerned, a lot more sustainable financially and put it on a really good path. The question now is whether he is open to a stake sale. He says he is.
Yes.
He says, like he always says, I've had a duty, as always, to lead the club for the best interest of the stakeholders and the fans for that matter. And if they get an offer, you just get a sense, that openness, Tom, that conversation.
Okay.
A lot of people reading between the lines and thinking that maybe this is a moment where he might be a little bit more open than he has been in the past.
Because of the impact of this interview, 2 quick questions. Is he looking for a minority sale, a stake sale of 10%?
Unclear, don't know.
Or is he talking about sale of the franchise?
Unclear, don't know.
What would they
All
go
I do know at this point is there is huge demand in British football. And we've seen takeover after a takeover happen, particularly from the United States. What would a number? I can't throw a number out there. I can say that the Glazers wanted something close to 7-8 billion for Manchester United. They weren't getting the number they wanted.
Okay.
Could it be close to 3, 4, 5?
Well, it's closer to London, and they have the derby. Okay. Well, who's your next interview with?
There's a list.
There's a list.
We've got to nail down the Glazers. I saw a lot of people giving me feedback to get the Glazers.
Look at Jim Selnick, and it's a Rochester interview.
Get Todd Bowley out of Chelsea. Try and make that happen too.
Okay, well, congratulations.
And the leadership over at Newcastle. Let's
huge
do that.
impact, and look for David Hillier and all of our English football coverage with Bloomberg News. Right now, Seema's going, is this what I showed up for? Seema Shah's with his Chief Global Strategist, Principal Asset Management, as we finish strong in our week in London. What have you learned of the last 72 hours of central bank football? What's the summary for the Principal Group?
That the conclusion of the London Derby is clearer than what the central banks are speaking about.
Do you have tickets? Excuse me, guys. Do you have tickets for the Derby?
I don't.
Continue.
No, look, I think the central banks don't really know what's going on. They're really confounded. We've heard from everyone that actually Powell is a little bit confused, and he talked through the conference. The questions, actually, he gave very, very unclear answers, I think. It was quite confusing.
Shah in the same territory as Pharaoh.
So what's your takeaway? I mean, right now what the takeaway has been from the market is that higher for longer. That seems to be the theme. Do you push back? Do you think that we're finally seeing rates at levels that will actually be restrictive enough to bring inflation much lower and to actually create some weakness?
So I don't think rates need to go any further than where they are today, because I still, we talk about the lags continuously. I think at some point the lags are going to come in. Timing is difficult to call, but they will come through. And then if you do another hike, you are risking a bit of an error. So that's what I think. I think, for the higher for longer, it makes sense in light of the kind of 1970s experience, which inevitably is going to be very fresh in their minds. And that probably is what keeps them from cutting rates a little bit longer than maybe they should do. So we're pushing it out to probably the second half of 2024 for the first rate cut because of that concern, what could happen to inflation.
Just taking a step back, are you more pessimistic on risk or less pessimistic on risk after what we saw over the past week?
I'm actually nowhere on this one, which is unusual. It's extraordinary. But the reason is, I'll explain why. So I think that the market is really going to be very range bound through the first half of next year because there is no very, very clear narrative. If you have high growth, then you have higher interest rates, so it's offset. If you have low growth, it's offset by interest rate cuts. So until you get to a point in the second half of the year where you do get an economic downturn, but then it becomes quite clear that the economic downturn is shallow, and then that's combined with rate cuts, that's when I think when the market can really rally with some conviction.
I heard 28 flavors of equity belief and conviction into 2024 on this trip. You're writing an outlook now to get to Q4 before your, painful 70-page 12/31/23 outlook. What's your conviction on equities?
That they're range bound. That is a clear conviction. If I look across, I think that the US is going to outperform Europe, certainly the United Kingdom. So there is still an element of US exceptionalism. I think that the large cap space is going to be challenged, but I want to be a long-term investor in that.
So you want to capture dividend growth? I mean, just as simple as that.
Yeah, I think that is what it is. We're thinking about income at the moment. That, I think, is the one thing that we can have a little bit of conviction on.
Preferred shares? How's 60s of me? We're talking Pinto and Javelin. Preferred shares?
Well, the interesting thing about preferreds is that, they were beaten up earlier this year. A lot of investors, even as actually the bonds came back, investors felt like they'd been permanently damaged by the events, and they lost conviction. But you've actually seen everything start to creep back. So I think preferreds could be on a decent rally.
I love, I love preferreds and warrants. It's great. I feel like I'm in England. I'm in London. It's railways to India.
Seema, just let's end on this note. That as you take a look at your caution from earlier in the year, and the fact that everyone who was cautious ended up having real regret and then saying, okay, well, we shouldn't be too cautious and we can't predict recession. Does that make you fearful of doing the same thing again? Has that sort of been a bit of shell shock that you feel across the street right now?
I think so. I think everyone is confounded by what's happened with the economy. They're confounded by central banks. And inevitably, as you try and switch your calls, you're worried that, oh gosh, everything that I thought is going to start coming through. So you have to have a view on the fundamentals. And for us, the fundamentals I still believe in the lags of monetary policy. I think it will come through, but I think it's going to take a little bit longer.
Seema, this was great. It's good to see you in London. Thanks for being here. Seema Shah of Principal Asset Management. Tom, we've got 2 more minutes left. You found more songs?
I teared up. Henry emailed in. Thank you, Henry, for watching. The surveillance team's interviews this morning from London with Stubbs, Rochester, Malick, and Shaw have been worth more than the cost of a month's cable TV subscription.
Very cool.
The benefits of your London week-long relocation have been invigorating. See ya in late November.
Is
I just
that
think,
your ghost account, or is that real?
No, that's real. I mean,
Okay,
I just think,
believe that.
I've got no idea.
after Thanksgiving, in time for holiday shopping, you can do another interview with Daniel Levy.
Okay. Let's watch this interview. Daniel Levy, catch the full interview if you can over the weekend on YouTube, on our YouTube page or on Bloomberg.com. Look out for that. On Monday, very cool conversation coming up on Monday. Permacrisis, the latest book with Mohammed Al-Arian, Gordon Brown, and Michael Spence, all three together, Tom, a conversation about their latest publication.
Fascinating, and particularly with the former Prime Minister, to see what Gordon Brown says about New Labour, about their dynamic, how they respond to what the Conservatives are doing.
There's so much to talk about. Also, that title, in and of itself, Permacrisis. Bramo.
Doesn't sound like Michael Spence.
I'm looking your way, Bramo. This is your kind of book.
I mean, this is the whole thing, is that we've been going from crisis to crisis, people planning for crisis, and now we didn't get a crisis, and now people don't know what to do with themselves. If we're not getting a crisis, what are we having right now?
I'm
so confused.
The laureate Spence is going to push against permacrisis. He is, optimist.
It's going to be very cool. This was great, guys.
This is great. Thanks to our team.
Thanks for coming back to home turf for a little bit. Back to New York.
Hot brown water was great.
Okay, I'm pleased you didn't insult too many people, Tom.
Thank you.
Just a few. We'll leave it there. Let's try and get TK on a plane and out of London unscathed. From the City of London, thank you for being with us all week. Thanks for the hard work of the team, the producers, for everyone who's put this week together for us. We appreciate it. Live from the city. Good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting, and my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Good morning from New York City for our viewers worldwide. I'm Matt Miller, in for my good buddy Jonathan Farrow. We're looking at equity indexes, futures that are rising. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, futures edging higher at the end of a bruising week for investors. The bond rout taking a breather after yields touch multi-decade highs, and the clock is ticking with a shutdown and more strikes on the horizon. We begin with the big issue countdown to 12 p.m. Eastern.
You look at the UAW.
The UAW strike.
The auto strike.
There isn't a deal that's been negotiated.
Potential for the strike going on longer.
What message does it send for wage earnings growth and how sticky wages may be going forward?
What is that going to do to wages across the board for labor?
Higher wages and margin compression.
That certainly could be inflationary.
The Fed's going to keep a very close eye on that.
It's going to make the Fed's job a lot harder.
Makes the Fed's job even tougher to constrain inflation.
Wage gains is something that, complicates their mandate.
The labor market remains very tight and wage pressures really haven't eased sufficiently.
It's definitely problematic for the soft landing.
The big question for all of us, looking at the economy, looking at the markets, will it have demonstration effects?
We don't know if there's a larger and more prolonged strike, exactly what it would do.
This is unprecedented.
Joining us now to discuss is TPW's Jay Pulaski, as well as Academy's Peter Cheer. Let's start with what to expect from rates going forward. I mean, I would have thought a couple days ago it's a perfect time to buy because they couldn't go any higher, and yet they continued to march higher. Jay, what do you think about rates? Is it a screaming buy?
Well, Matt, great to see you. I think the rate backup here really demonstrates the depth of belief in recession within the bond market. I mean, the way I'm viewing the last couple of days is that the good news is that the Fed is more in line with reality than at any point since COVID struck us back in March of 2020. I was on the program several weeks ago and suggested that the Fed was going to double its 2023 GDP forecast and raise 2024, and that's exactly what they've done. They took down unemployment, and basically they took recession off the table. And from a risk asset point of view, I think the opportunity is much more in equities than in bonds, because essentially what we've done is we've traded a recession call for 2 fewer rate cuts in 2024. And I think that's absolutely a great trade for risk assets. And as I see it, the Fed is now validating what the other cross-asset markets have been suggesting, namely that we're in a bond bear market, that the commodity bull market, commodities are up almost 8% over the past month, validating that, validating the rise in earnings revisions that have been supporting equities and will continue to support equities, and supporting the thesis that the credit market has been telling us, which is that everything is fine. So we're on a hunt for the return to stability, which is going to unlock the $1 trillion that went into the money market funds. And I think we've moved a lot closer to stability, believe it or not, after the last couple of days than we were a week ago.
Peter, don't we have to see at least another hike from the Federal Reserve? Because, as Jonathan was pointing out earlier on surveillance, they have been saying for a long time they believe they're sufficiently restrictive, and yet the economy continues to grow, right? And yet the labor market is still very strong. And we could get more inflation coming out of, obviously, this strike, considering it's looking like it's going to go on a little bit longer. So aren't they going to need to raise rates more to really be restrictive?
I don't think they're actually going to need to do that. I think if you look at the last job report, it was perfect, right? We actually had labor force participation increase. So I think as the data keeps coming in, it is going to give them enough reasons not to do anything, which is what I think they're looking for. Up until recently, they've been looking for excuses to hike. looking for excuses to do nothing, and I think the data is going to come in with that. I think people forget too just how good the consumer was and corporations were at locking in long-term yields. They borrowed longer term, even auto loans extended. Every part of the borrowing structure extended. So all these rate hikes, it's going to take a year, 2 years, 3 years for it really to start impacting most people. So they are better off leaving this on hold, letting real yields be high. And I think they're starting to get a message too, a very strong message from small and mid-sized businesses. Enough is enough. Borrowing costs are getting hard for us. It is difficult for us to invest, and I think they're going to listen to that as well.
Peter, I want to drill down on something that you're implying here, that the long and variable lags truly are long. A lot of people have made the argument, including Jan Hatzius from Goldman Sachs, that they aren't really, considering the incredible transparency, the fire hose of information flow that we get, and the fact that nobody has floating rate mortgages anymore. We're all fixed post-financial crisis. Do you really think these lags are still taking 6, 12, 18 months to come through?
Yeah, if anything, I think it takes longer, right? If you had a 3-year on average, you'd already be getting impacted. But people extended to 5 years. Corporations extended out to 8 to 10 years. So it's taking a lot of time for these higher costs to impact stuff. It's affecting some decisions, but it's not affecting current, capital bases. So I do think it's going to take much longer than people realize for this to take. And the people who do have leverage loans, short-term debt that's rolling over, they are starting to feel the pain, and that's where the noise is going to come from. And they're going to say, enough is enough. Let's just hold off and see where this plays out.
Jay, what do you think about the extra dot in the plot? I mean, it was 12 Federal Reserve members who said we're going to need another hike. Are we going to need another hike? And also, does it matter? I've heard so many people say 25 basis points doesn't matter. Does it matter? Because we'll freak out on the day that they do it.
Well, that's natural, right, Matt? But yeah, to me, dot plots mean squat. In other words, the Fed's history of being right on the future is very poor. Guys like us that make a living getting the markets right would be out of business if we had the track record that the Fed has in predicting what the economy is going to do going forward. So I pay virtually no attention to the dot plot, never really have. And my focus, again, we're focused on the return to stability. We're focused here at TPW Advisory on the rate cutting cycle that is underway around the world, Brazil most recently just yesterday, as opposed to backward-looking rate hiking cycle. We're effectively done, whether or not, to answer your question, they raised 25 basis points or not. The point is that the Fed has validated the higher growth for longer. We're not going back to 2010, 2019, low growth, low inflation, et cetera. We're in a new environment with new industrial policy. Global growth is accelerating and inflecting upward, and that is what we need to see for equities. And I expect as we move into earnings season and we continue to validate 2024 double earnings growth for the S&P, equities are going to do just fine.
All right, everyone piles on the Fed, but I feel like, they may be guiding us right now to a soft landing, which would be pretty admirable. Of course, there's still a massive threat. A few threats, but one I think that towers over the others, and that is the strike. Detroit's Big Three bracing for even more walkouts as a deal with the UAW remains elusive a week into it. The union's president, Shawn Fain, set to announce the next steps at 10 a.m. Eastern. Bloomberg's Kayleigh Lyons joining us for more. So, Kayleigh, we'll hear the Facebook Live announcement in just about an hour, and then I guess in a couple of hours, that's the deadline that he's set.
Yeah, right. Set for progress in these talks with the big three automakers. And so we'll understand when Fain speaks less than an hour from now exactly how they plan to expand this strike, which to this point, a week into it, has remained relatively narrow in scope. We're just talking 13,000 workers who have walked out of 3 different facilities, one per automaker, a Ford plant in Michigan, a GM one in Missouri, and for Stellantis, one in Ohio, all that make profitable vehicles. And according to S&P Global Mobility, it's affecting output of these automakers in total by around 3,200 vehicles per day. The union, though, intentionally left room open to begin inflicting more pain if necessary, if they couldn't get closer to agreement with these car makers, and that's where we find ourselves now. Of course, the union continues to ask for a 36% wage increase over the course of a 4-year contract. All three automakers remain instead right around the 20% mark. So there's still a lot of daylight there, but that really isn't the only issue. Take Stellantis, for example. Union negotiators have said just some of their most important issues aren't being addressed, including the issue of job security, given the potential closing of a number of Stellantis facilities. There's also the wider question of the role of workers in the EV transition. That's one of the complicating factors here in Washington for President Biden, who has pushed that EV agenda, but also is trying to be the most pro-union president, he says, in history. He has still been on the side of the UAW. He says record contracts for automakers should mean record contracts for record profits, rather, for automakers should mean record contracts for auto workers. And yet we're still trying to figure out the contract details. And the longer this goes on, Matt, the more pain theoretically it could inflict on the economy. If we see this strike expand to all 150,000 UAW workers, for example, that could affect about a third of the auto production here in the U.S. And remember, the auto sector is about 3% of GDP.
Yeah, it's, I think, a fascinating set of negotiations here. I mean, Dodge and Chrysler don't even have really any products announced for next year. They've shown us a Banshee concept, but nothing since then. And this could amount to a real wage price spiral if it gets out of control in the other direction. Kaylee, how worried are people in Washington about this in terms of its effect on inflation or the slowdown of the economy?
Well, they're always worried, Matt, about inflation here in Washington. That said, at least on the left side of the political spectrum, including in the White House, there is a conversation happening ongoing about how much profit corporations are raking in and how that should be translated to workers. If you are pro-union, which many Democratic lawmakers are, they would like to see the UAW workers getting more money here. There's even some Republicans who are saying that, like J.D. Vance, the senator from Ohio, where you herald from, Matt, who have said that the UAW should be using its leverage here in order to potentially disrupt the EV transition. That said, elsewhere here in Washington at the Federal Reserve, of course, they are watching this very closely. When we talk about 150,000 workers, we are talking about a very small fraction of the American workforce. So theoretically, it wouldn't necessarily expand elsewhere, but it just speaks to this dynamic where employees are still feeling like they can ask for more money, and if they get it, that could refuel inflation.
Sure, if you're at a supplier or another automaker, even if you're not a union worker, you're going to look at them and say, I want that.
Yeah.
Also, we call it the great state of Ohio, Kaylee, because 8 presidents call Ohio home.
Of course.
Thanks very much. Kaylee Lines there in Washington, D.C. Joining us now with a look at what's going on in the stock market ahead of the opening bell. Let's bring in Abigail Doolittle. Abby, what are you looking at?
Well, Matt, we are looking at a little bit of a relief pop for U.S. equity futures overall, with the S&P 500 right now up about 0.3% after a 3-day slide. Yesterday, the worst day for the S&P 500 on that hawkish Fed pause going back to March. But today you can see Amazon getting a nice boost, up 1.4%. This as they are saying that their Prime Video content will include ads starting next year. Activision Blizzard up nearly 2%. The deal with Microsoft is set to clear the final UK hurdle. And then ExxonMobil, just to broaden it out a little bit, we do have WTI crude still above $90 per barrel, up about 0.9%. And Morgan Stanley is maintaining their overweight on the shares. They've also raised their price target to $131. Not so bad. Again, a little bit of a bullish tilt for stocks this morning.
All right, Abby, thanks very much for that. Peter Cheer and Jay Pulaski are going to be rejoining us. I'm going to ask them what they think about the strike, as well as the shutdown. Time is running out on Capitol Hill.
Kevin McCarthy, on the other hand, doesn't play this right, could be subject to a sort of oust the speaker movement. And if that happens, then we have chaos. Then the shutdown could last a lot longer. And that's the nightmare scenario.
Government shutdown conversation still ahead. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
some of our biggest discoveries were in the 1970s or 1980s. And so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
There are two scenarios, I think, right now that we're looking at. One is that the shutdown, lasts a little while and then people come to the table and they resolve it because, there are probably 150 votes in the Republican Party that want to see the government stay open. Kevin McCarthy, on the other hand, doesn't play this right, could be subject to a sort of oust the speaker movement. And if that happens, then we have chaos. Then the shutdown could last a lot longer. And that's the nightmare scenario.
A growing risk of a U.S. government shutdown with just 9 days left to make a deal, splintering within the Republican Party, still causing massive problems. Speaker McCarthy's defense spending bill blocked on the House floor for a third time by a pair of ultra-conservatives.
Two people flipped, so I got to figure out how to fix that.
Did you know that they were going to flip before the vote?
No, that wasn't the impression they had given.
Representative Marjorie Taylor Greene, one of the GOP dissidents, suggesting McCarthy shouldn't have been surprised by her vote.
I've told him everything that I've told everybody else. I'm completely transparent in every conversation I have. We should have been passing our appropriation bills back in August.
Bloomberg's Anne-Marie Horder joins us now for more on, is it fair to call this an absolute mess?
It is a mess, and we are looking like it's looking ever more likely that we will have a shutdown. And I think you could see the division there just from hearing Speaker McCarthy and Marjorie Taylor Greene. Marjorie Taylor Greene voted no on a rule yesterday. That rule would allow a debate on a defense bill, not even a vote for or against the bill, just a debate on the defense bill because it took in and included Ukraine aid. This is what she said to Kayleigh Lyons yesterday. Kayleigh was up at the Hill. That is one part, Matt, of the GOP caucus. On the other hand, you have a congressman like Mr. Lawler. This is a New York congressman. He's from a Biden district, and he wants to see a vote next week on a continuing resolution. And if he doesn't see one, he says he may have a discharge position, which means he can work with Democrats, put one on the floor that would go over Speaker Kevin McCarthy's head. So this is what Kevin McCarthy is dealing with in terms of some of the individuals in his party and how far apart they are. And that gap just at this moment does not seem to be narrowing.
Does at some point McCarthy himself have to choose between being the speaker and getting absolutely nothing done or governing and getting the boot?
Well, the thing is, if he governs and gets the boot, this will be even more chaos. Then who comes next in this position? What you're seeing is because he is dealing with very, very slim majority. And actually, that majority actually got even slimmer because there is a congressman who retired recently. You have some individuals who are out because of medical reasons as well. So this is going very difficult for Kevin McCarthy. And what you see him try to do is what we saw during the debt ceiling debacle, which is try to get some leverage from the hard right, put that on the floor, and see if that works when he's dealing with Schumer or the White House. But at this moment, he's not even able to get the hard right bill of a continuing resolution on the floor. If he does work with the Democrats, that means he's likely going to face a motion to vacate.
All right, Anne-Marie, thanks very much. Anne-Marie Horder here in New York for UNGA, talking to us about the government shutdown as well, which I think it's safe to say is almost inevitable. Jay Pulaski and Peter Cheer are back with us. Peter, what's your take on the shutdown and how much it matters maybe relative to the UAW strike?
For me, both are fairly back order type effects. If the shutdown lasts months or something, maybe it's a problem. If we get it in a week, I don't see a big deal. I think the auto worker strike is potentially a risk. Again, that will take time to see how it plays out. When I'm sitting here trying to look at the world, and what I want to figure out over the weekend and the coming weeks is, we're going to see some AI success stories. I really want to figure out, are companies going to be able to start demonstrating, hey, we've used AI and we've seen these great efficiencies? Because I think that would be much more important to the market than anything that's going on with either the government or right now even the auto strike. And I'm looking at the IPO market, right? We've started to see some enthusiasm for IPOs. It's been mixed results. Do we get one of those pops where all of a sudden you start seeing companies, you start seeing acquisitions, maybe like Cisco did yesterday, and really that drive the market? So in my scheme of things, that's what I'm looking for, and those other issues right now are kind of taking the back seat.
Jay, what do you think? I mean, a lot of economists have been telling me the UAW strike could be a real problem going forward, because if it goes on for a long time, that's going to mean big inflation for cars and a slowdown in GDP. If they get a serious wage hike, then everybody else is going to want that too, and that drives up the pay.
Well, I think, first of all, Matt, DC is a clown show, right? And it has been for a long time, and I think markets are not going to be surprised by that. As far as the UAW, I expect it to be resolved reasonably quickly. There's plenty of money to go around. Profits in car makers have been significant over the last couple of years and likely to continue to be so. Here at TPW Advisory, we're focused on 4 signposts to the road to stability. And the first is continued disinflation in the U.S. and Europe. The second is a incipient global manufacturing recovery as we shift from inventory destocking to restocking. The third is continued upward revisions of earnings. And the fourth is policy traction in China. We're very focused on the opportunity set there. As long as China starts to gain traction, which we expect to be the case over the next quarter or two, we think the global economy is going to be fine. And look, we continue to be focused on opportunities outside the U.S., particularly in emerging markets and in commodities. And I think the U.S. is going to be fine, risk assets, because earnings are going to be fine. And that's all that really matters at the end of the day.
Peter, we just got 30 seconds here, but there's a list of headwinds I don't even have to go through anymore because we all know them so well. Are you as bullish the global economy?
No, definitely not. I think China, to the extent they are going to see growth, it's going to be by them selling their products into emerging markets countries. So I think that's a risk for U.S. companies that sell into emerging markets. I do think India is really interesting. I think India, I'm trying to figure out the right way to play it. I expect really good growth out of there. And the one thing I'm worried about in terms of a commodity super cycle is India getting its story correct between space, between AI, between infrastructure, between onshoring or reshoring that's going on in India. If they take off, I think we could see a 2006 to 2008 type commodity super cycle. And it seems to me that sort of inflation is the U.S. Achilles heel. So that's something in my background is a real potential headwind, not today's problem, but maybe next year's.
All right, Peter, great to get some time with you. Peter Cheer there from Academy. Jay Pulaski, always good talking to you from TPW Advisors. Coming up, the morning calls, and then later, big tech falling victim to surging bond yields. Mona Mahajan of Edward Jones joins us at the opening bell, revealing her higher for longer playbook. That conversation still ahead. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is the countdown to the open. I'm Matt Miller in for Jonathan Farrow. After the big drop that we saw yesterday, off 1.6% on the S&P, the first time we dropped below 1.5% for over 101 days, we're looking at futures that are bouncing ahead of the open. Let's get to the morning calls right now. First up, Wells Fargo upgrading Charter to an overweight, expecting growth to reaccelerate due to new mobile and video initiatives. Next up, Canaccord downgrading Deere to a hold, citing slowing growth for large agricultural equipment and normalizing dealer inventories. And finally, Bernstein upgrading Wayfair to a market perform, pointing to improving revenue growth and management's positive messaging on margins. Coming up, big tech set to rebound as Treasury yields fall from multi-year highs. That conversation up next, as well as the open. Mona Mahajan of Edward Jones joins us. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is the countdown to the open. I'm Matt Miller in for Jonathan Ferro. Moments away from the start of trading, we see futures up across the board after the big drop that we had in the live trade, in the cash trade yesterday, and after yields came back down a little bit, giving tech shares a little bit of room to breathe. There you hear the opening bell, and you can see it there on the New York Stock Exchange and here on the NASDAQ. Let's switch up the boards and take a look at some of the other asset classes that we pay attention to. The euro dollar, 106.48 right now. Not a lot of change there. The 10-year yield also little changed, but still at a relatively high level, 447.63. And NYMEX crude back up above $90 a barrel after having dropped below that benchmark price yesterday. 91.13 the level for West Texas Intermediate. Now, one stock to watch at the open this morning has got to be Activision. Microsoft is closing in on its $69 billion acquisition after passing a final regulatory hurdle in the UK. Microsoft executive Brad Smith saying, quote, "We're encouraged by this positive development in the Competitions and Markets Authority's review process." Ed Ludlow is here with more on this big deal. Ed?
It's astonishing because at the beginning of the summer, anyone you would talk to would say this deal wasn't going to happen. Now, look at Activision shares, $94.10, 90 cents away from the $95 per share offer that Microsoft made. This is a $69 billion deal. The compromise that Microsoft and Activision put on the table was to sell the cloud streaming gaming rights to Ubisoft, a French independent video games studio and publisher. And from the CMA's perspective, the Competition and Markets Authority, that is good enough to maintain a competitive market to their mind. It's interesting because basically Microsoft and Activision went to regulators, the CMA being the final hurdle, saying the cloud market is a tiny nascent part of the video games industry. Why are you so hung up on this? But it's what they wanted to see. And Sarah Cardle, the CEO of the CMA, was on our programs earlier this morning saying this is a lesson learned. Next time it would have been easier if you guys had just done this compromise to begin with. There is a consultation period through October 6th, but right now, based on the spread and all of the reaction to this CMA provisional decision, this deal is going through, and it's a big one for the video games industry.
Yeah, a big one. People care about Call of Duty as well. Ed, thanks very much for that. Some breaking news right now on Ford. We see the shares also popping in the pre-market. Let's get over to Abigail Doolittle with the details. Abigail?
Yeah, indeed, Matt. We do have the shares of Ford popping higher right now, up about 2.5%. The best day since early June. And this on a Reuters headline that the UAW is to announce progress made with Ford and labor talks. And of course, at 10 a.m., the UAW is expected to ramp up this very particular strike that they're doing, surgical strike that they're doing. But now we do, of course, have this headline that UAW has announced progress made with Ford in labor talks. The shares are higher, up 2.3%. We also have a sympathy trade in the shares of GM. They are also higher, so we'll be waiting for more here. But the idea, quote unquote, real progress has been made by the UAW with Ford. So it will be interesting again to see what announcements could potentially follow this, and if it also is a good sign for both GM and Stellantis. One other stock that is moving this morning, of course, Matt, is Amazon. This after the company has said that they, similar to Disney Plus and Disney ESPN and Hulu and some of those other streaming services, along with Netflix, they are going to be running ads on Prime Video in key markets starting in 2024. And of course, right now, Prime on a yearly basis costs $139. The cost to not have those streaming ads, $299 a month, which is less than Disney. I believe it's also less than Netflix. But these major streaming services, they are trying to bring ads into the service and then get people to pay extra to not have to have that. And just to return quickly, Matt, because you are a car guy, Ford right now at session highs up 3.4%. The best day, again, I believe, since early June. And on this Reuters headline that the UAW head saying that real progress has been made. And we also have now CNBC reporting on that in addition to Reuters.
Yeah, it's interesting. Usually the UAW gets along with Ford best. The workers like that the company is essentially family owned, or, you know, in a sense, and that Bill Ford gets personally involved in those negotiations. So typically they're friendlier. On the other hand, it hasn't looked like that over the past couple of weeks. We'll continue to follow these developments very closely. Abigail, thanks very much for that. Now, A big day for Apple. The new iPhone 15 going on sale in roughly 40 countries today. Dan Ives of Wedbush writing, quote, iPhone 15 pre-orders are still tracking much stronger than we and the street originally expected, and up roughly 10 to 12% from iPhone 14 based on our analysis. Katie Greifeld is here with the latest. Katie, did you get yours yet?
I haven't gotten mine yet, and apparently online reservations are hard to come by as well. But you take a look at shares this morning, up slightly as the iPhone 15 Pro and Pro Max models go on sale in this first wave. And Matt, there's at least two big tests here. The first one, of course, is what demand will look like for the new iPhone 15, and also can Apple fulfill that demand? Now, at least on the first point, there's plenty of early signs that indicate that people definitely want to buy this new phone. You take a look at new online orders for the highest end new models, and they won't arrive for customers at least until mid-November in several countries, rather. And while reservations for in-store pickups, they actually quickly sold out. So a lot of early indications of demand, and that's good news for Apple because there is a lot riding on this. These models will represent Apple's biggest sellers through the end of 2023 and are expected to make or break Apple's holiday season. Obviously very important for the iPhone maker. It's hoping to return to growth after a streak of quarterly sales decline, Matt.
All right, we'll be watching that. I saw lines outside the Apple store on Fifth Avenue driving in this morning already. Katie, thanks very much for that. Mega cap tech stocks flirting with one of their worst weeks of a pretty good year. Surging bond yields have kept pressure on some of the sector's biggest names. Mona Mahajan at Edward Jones weighing in, writing, quote, we expect some broadening in leadership as rates remain elevated and would look to complement growth in tech stocks with better valuation parts of the market. Cyclicals and over time small caps may play some catch-up. I'm pleased to say Mona Mahajan joins us now with more. Mona, great to have you on the program. I didn't see the word value there. Certainly not, describing that group of stocks. It's almost become a dirty word in this market because it doesn't seem to ever win out. What's the story?
Yeah, thanks, Matt. Look, I think a lot of the sectors that were mentioned there are part of the value complex. So to broaden it out to value more broadly, I think probably would also include some of the defensive parts of the market like healthcare staples and utilities, which tend to outperform in periods of a recession. And clearly this economy has held up too well to pile into defensive parts of the market. So we want to be really particular in what we're looking at if we do expect a broadening of market participation. And this is really for the quarters ahead as we head towards 2024. That is really an environment where we see the Fed potentially pausing and, as they've indicated, maybe pivoting lower. We see inflation continuing to moderate, and we could get a rebound in earnings growth as well. So that's a better backdrop for a balanced portfolio. Now, we wouldn't want to wholesale get out of the AI tech story. We think that's in early phases of a secular bull market as well. But we certainly think, given what's happened this year particularly, some broadening of participation, especially if we reemerge from some sort of period of economic softness, does make a lot of sense. We want to make sure portfolios are balanced, diversified, and have exposure to those cyclical and potentially small caps as well.
What are the cyclicals? I mean, do you like the automakers right now? It seems like a tricky situation.
Yeah, I think we have some headwinds ahead of us that not only with the UAW strike, of course, we have a potential government shutdown. We have oil prices that remain elevated, walls of worry that the market will have to continue to climb. But markets have looked forward in the past. They will continue to do so. So within the cyclical complex, we think industrials make a lot of sense, especially as infrastructure will continue to be built out here in the U.S. and globally. A lot of manufacturing is coming onshore across the globe. And so I think that'll be a trend that continues to play out in the next 12 to 18 months. Certainly areas like financials, which have historically been more levered to a better economy, could look to a period of better performance, but probably not till 2024, back half of 2024. And energy is the other part of the cyclical story that's already shown better performance even in this quarter. Part of that has already played out, but I think those three sectors and cyclicals we would continue to watch carefully. Think about consumer discretionary as well as we move forward.
Yeah, I was wondering about that. I mean, restaurants, airlines, hotels, luxury. How do you view the U.S. consumer right now as we get reports from places like, Darden, that its customers are choosing less expensive wine, although those aren't probably the same customers buying stuff from Hermes and Gucci.
Yeah, look, it's interesting. The consumer has been the backbone of this economy. They've been extremely resilient thus far. But we are entering this period. We're at the end of the summer travel season, and consumers are faced with not only higher oil prices, now an interest rate environment that may be higher for longer. And of course, we know they've worked down some of those excess savings that were given to them in the post-pandemic period. And by the way, credit card levels are elevated, and lending standards are tighter as well. So this is, probably some headwinds to consumption in the consumer in probably the 1 or 2 quarters ahead. We'd expect a bit of softening, not only in the consumer, but we're seeing early signs of labor market maybe cooling as well. So areas that had really held up well, will the next move be, better or some softening? We think probably some easing is likely. And so that's something to keep in mind, especially as we think about, earnings and growth in the months ahead.
What about rates? I mean, 4.5% on the 10-year, more than 5.1% on the 2-year. I mean, really across the curve, you're getting a decent return, so that even if you don't see capital appreciation, which seems likely to me, you're still getting a nice coupon.
Yeah, Matt, you summarized it well. Look, with yields towards the highs of this cycle, in fact, of course, there is some intrigue in the shorter duration part of the market. Cash and cash-like instruments are giving an opportunity that we haven't seen really in recent history. But there is some risk there. If you're in a CD and you have to reinvest in the months ahead, you might have some reinvestment risk. You have to reinvest at a lower rate. But also you can miss out some of the interesting opportunities that are forming. And to your point, the bond space in particular, especially if we look at a little bit of a longer duration investment grade bond area, that could be really compelling. Historically, forward bond returns have been determined by where the current yield is. And current yields, as we know, are probably towards a peak. And you're not only kind of locking in these better yields for longer, but you have that chance, to your point, of price appreciation. If over time, the Fed not only pauses, they pivot lower, you really have this nice window for extending duration ahead of that move, to your point, price appreciation and locking in yields. It's a nice combination that you might be getting in the months ahead.
Mona, stick with us. Mona Mahajan there from Edward Jones. We're continuing to see breaking news come across the ticker on Ford. People familiar now telling Bloomberg News that the UAW is making meaningful progress with Ford. And of course, we're set to get an announcement from the union president at 10 a.m. on Facebook Live. And then he's set a deadline for 2 hours after that. Let's get back over to Kaylee Lines right now. She's in Washington, D.C. and has more for us on this developing story. Kaylee?
Well, Matt, you can see it moving the market already. Ford shares now up about 2.5%. If these gains hold, could be the best day for the stock going back to June on this news of progress being made with this one particular automaker. We will, of course, look for details from Sean Fain's live streamed event that is happening just about 20 minutes from now. But remember, there's still 2 other automakers at play here, GM and Stellantis, and we don't have news at this point of whether or not progress is being made on that front. So when we're thinking about the ways in which this strike could expand or not, which automaker could see more pain inflicted by the union? Ford shares, though, definitely benefiting from this news. Now, we did have a separate report also just moments ago from Reuters that the UAW was going to ask President Biden or invite him to come to the picket line. And this is really interesting, Matt, because, of course, as we've talked often about, President Biden has billed himself as the most pro-union president in history. He's come out on the side of the UAW workers, even though he says no one wants a strike. But also we have to consider that next Wednesday, on the evening of the second GOP primary debate, former President Trump, is going to be counter-programming that debate by being in Detroit and addressing the UAW. So it'll be really interesting to see if we have the former president and current president, who right now are the front runners of each of their individual parties in the 2024 race, showing up at the picket line. But as for Ford in particular, right now up about 2.25%. We'll look for more details on that progress from Sean Fain just a short time from now, Matt.
All right, Kaylee Lines, they are covering the developing strike story for us out of Washington, D.C., and obviously it's very closely related to the political story as well. So she's an excellent person to get updates from. Coming up, fresh economic data rolling in. We're breaking the latest U.S. PMIs after a little bit of a disappointment out of France and Europe. This is Bloomberg.
Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
I know one of the reasons you're here in Marrakesh and in Africa because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on a dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
The committee left the additional rate hike this year in the dot plot. I think that may be a good thing to do as insurance to make sure that core inflation especially continues to come down. I think the risks are building that inflation could hang up at a higher level or even go higher based on the idea of a reacceleration in the U.S. economy.
That's former St. Louis Fed President Jim Bullard speaking yesterday with Mike McKee on the U.S. economy. Breaking PMIs crossing the terminal right now. Let's get over to our international economics and politics correspondent who is actually sitting right next to me there.
Yeah, not overseas, but we do have numbers both in the United States and overseas, and the U.S. is not Europe. We can say that. Global manufacturing on the S&P manufacturing index for the PMI, 48.9. That's up from 47.9. Still a little bit below the 50 break-even point. But services and the composite for the U.S. remain above 50. 50.2 for services, 50.1 for the composite. Those are down a tick, but they do show still continued growth in the U.S., and that is a completely different story, Matt, from what we see over in Europe. You take a look at France, Germany, the Eurozone, and the UK all reporting today those global, those S&P global PMIs. And look at all the 40s. There are no 50s there. And in Germany, rather, you see 39.8 for manufacturing. Germany, the only one of those countries at this point forecast to actually go into recession by economists surveyed by Bloomberg. But the UK very close to it. And of course, the Eurozone itself is struggling with manufacturing. You look at those numbers, and it is definitely not the U.S. We'll see what the Fed thinks of these numbers and what the Fed thinks of what the Fed did, because today we get a lot of Fed speak. The blackout list today, Lisa Cook is speaking, Mary Daly and Susan Collins are speaking. All this coming up after 10 a.m. this morning, and Neil Kashkari later this afternoon. So we will get some idea of whether the markets are reading the Fed right and what they decided the Fed is going to do after the decision on Wednesday.
All right, Mike, thanks very much. Michael McKee there, Bloomberg Television's international politics and economics editor. Mona Mahajan is back with us. And Mona, what's your take on, I guess the PMIs here are pretty much in line with expectations. The French PMIs I saw disappointing, and Europe looks like it may be contracting. How does the economy look to you?
Yeah, it's interesting when you look at the dichotomy between manufacturing and services. Of course, manufacturing had been in a downturn, and now we're starting to see a bit of stabilization, even a tick higher. And services, which had been driving, the U.S. economy, looks like it's heading towards a peak. And so this idea of rolling downturns, or as some call rolling recession, could still be in play here. Parts of the economy that had originally really kind of gotten hit hard by the Fed rate hikes are starting to see signs of stabilization. You can maybe even put housing in that category, and services, which had kind of chugged along, may now start to stall a bit as we're heading towards these peak rates that finally may catch up with that lag impact that we've all been talking about. And so we do think that the U.S. economy could soften, but probably not heading towards any sort of technical recession, but a period of below trend growth. And even in the Fed projections, the 1.5% for 2024 could imply a softer first half followed by a rebound in the back half of the year. And I think that to us seems like a credible backdrop.
In terms of next year, so many people have been saying we're going to see double-digit earnings growth come back again. I guess you have to be in the soft landing camp to believe that. But if we do get sweet economic growth in the U.S., why do you think the Fed would cut rates twice? What's the catalyst?
Yeah, it's a great question. And, look, I think with rates here, even at 5.25% to 5.5%, still highly restrictive. And if you think about inflation perhaps continuing to moderate, even in line with their own projections, that brings the real rate, the nominal rate minus inflation, even higher. Even if the Fed just, keeps steady at this pace on pause, real rates, which do impact the economy and do add a bit of tightening, continue to move higher. Now, if they do believe that a neutral rate is closer to 2.5% to 3%, and if inflation continues to moderate, do they need to stay at such a restrictive level for an elevated period of time? And so I think over time, the way they would probably communicate it is they're going to start normalizing rates gradually back towards a neutral level. And so that could be where you get the signal of 1 to 2 rate cuts next year. We think that is a credible scenario. If the economy softens more than they expect, the original scenario of 3 to 4 cuts may be back on the table as well. But for now, I think a normalization out of this highly restrictive territory is probably the path of most credible for now.
All right, Mona, thanks very much for joining us. Mona Mahajan there from Edward Jones. Let's get some sector price action this morning. For that, we go to Bloomberg's Abigail Doolittle.
Yeah, Matt, very quickly, we are looking at a rebound rally for the S&P 500. So we have more sectors higher than not, led by energy. Interestingly enough, we have some of the rate-sensitive sectors on bottom, such as utilities and real estate and healthcare. Even though rates are lower, those dividends should look better. That's not the case. On the week, though, let's take a look at the week. The S&P 500 right now heading to a decline of 2.5%, the worst week since early March. Here are the two best sectors: defense, so that's risk off, and then the two worst sectors, real estate and consumer discretionary. Rough week for stocks, third week down for the S&P 500 in a row, Matt.
All right, Abigail Doolittle, thanks very much. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
you thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
This is Bloomberg's The Open. I'm Matt Miller in for John Farrow. Time now for the Trading Diary, what you need to be watching through the next week. UAW President Shawn Fain making an announcement on Facebook Live, this coming amid fresh reports of meaningful progress just in the last 30 minutes in the UAW's negotiations with Ford. That announcement on Facebook Live at the top of the hour will bring you all the headlines. Plus, more Fed speak from Mary Daly and Neil Kashkari. That's at 1 p.m. New York time this afternoon. We get U.S. GDP next Thursday, plus more Fed speak from Goolsbee, Barkin, and Chair Powell. And finally, the government shutdown deadline coming at midnight on September 30th. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
State, Senator, First Lady, with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
From the financial centers of the world This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, September 22nd. Here are the top market stories that we're following for you at this hour. Party like it's 2007? You got long-term bond yields hitting a 16-year high overnight, and now take a break while the S&P pretty much goes nowhere after the recent slide. And measuring PMI pain. U.S. holds up. Euro area, UK PMI is pretty bad. We're going to get instant analysis with Chris Williamson of S&P Global Market Intelligence. And auto strikes rev up. UAW could expand its walkout today after a week of no agreement. We're going to get you the latest. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, it does feel that everybody's tired. And I'm not talking my book. I'm just saying everyone feels tired. Volume's really light. It just feels like everyone's taking a break.
I'm not sure everybody's partying right now with these higher yields. It feels like it's maybe the punch bowl being taken away. That's going to be the problem. That's going to be the impact that maybe these higher yields ultimately have on the economy. Susan Collins of the Fed giving some further comments on what is happening here. Further Fed hikes are certainly, quote, not off the table, according to her. The PMI data, I think, paints a really interesting picture today, Alex. Certainly a fairly bleak one for Europe. They have been pointing to a fairly bleak picture for a while, but the numbers just continue to get worse. In the States, less so.
Yeah.
So our question of the day is basically around how much pain do they point to? And it feels like the answer is very different depending on which side of the Atlantic you're on or which side of the Pacific you're on for that matter. So let's get some instant analysis. Chris Williamson, S&P Global Markets Intelligence Chief Business Economist, joins us to discuss this. If I'm Alex Steele over in America, the picture looks much better. If I'm Guy Johnson here in Europe, it doesn't look quite so clever. Chris, give me the instant analysis and how different that analysis is depending on where you are.
Yeah, it's an interesting way of looking at it, Guy. Certainly the European numbers, both Eurozone and UK, turning down in recent months. Some signs of maybe it bottoming out in the Eurozone, but forward-looking indicators like order books, they're still turning down really quite sharply. So more pain to come. So the upshot is you're looking at signals of Q3 GDP declines, both for the UK and the Eurozone, with that weakness persisting into the fourth quarter. US, on the other hand, is fairly stable at a pretty miserable level, mind you. We're pretty much stalled. So we had a good growth spurt up to July, really, which seems to be fading now. So you might get a good GDP reading for Q3 in the US, but I think Q4 is going to look quite different. So there's just a delaying the pain, really.
That was some cool focusing that just happened on your camera. Chris, delayed pain, does that mean that we're going to see U.S. PMIs roll over to the extent that we've seen in Europe and the UK, or will the U.S. always, in some ways, outperform?
I think the US will outperform. We've had, obviously, big drags in Germany from the energy price hike. We're seeing that in manufacturing. It's one of the reasons why the German manufacturing numbers are just so weak. There's been a structural hit, if you like, to the German factory sector, which it's still reeling from. And the US, in contrast, is investing a lot of money in expanding new production facilities with the new acts that Biden's brought in. So I think the prospects for manufacturing in the US are looking a lot brighter than in Europe at the moment. That's a big factor to help. The other side of the whole economy, of course, is the services side, where we're seeing this synchronized weakening of growth from consumers being hit by the increased cost of living and higher interest rates in the US and Europe. That's really beginning to take a toll now. So it's going to be a key thing to watch as we go forward, just how much households are being hit by that element of that headwind.
Chris, the Bank of England apparently saw your data before it made its decision relating to pausing its rate hiking cycle. What within that data do you think would have caused them to pause?
Well, for a start, the weakness of the activity levels, then that's also translating into a sudden, quite worrying downturn in hiring. The job market, as we all know, has been fairly resilient, and that's helped keep this wage growth up. But one of the things central banks are looking for is the labour markets to start weakening and to start reducing that wage bargaining power. And that's exactly what you had in September with those PMI numbers. That's coming through really quite clearly now. But then the other side of it was a sharp reduction in price pressures as well. So although we had higher prices for energy, notably from the oil price hike. That doesn't seem to have cut through. There's other forces at play here, and this is this reduction in pricing power firms have got. So their costs may be rising, but they just can't pass it on.
And this also goes to maybe the employment part as well, because what I thought was interesting was in the U.S., you're still seeing employment growth and that quickening versus in the UK, for example, or Europe where it's not. Walk me through the why there.
Yeah, well, this is about labour market supply, first and foremost. So, yeah, job growth actually picked up in the US. Now, you've got more people starting to struggle with the cost of living and interest rates, and they're coming back into the labour market, which means some of these long-standing vacancies can be filled now. So this is helping support those numbers in the US. The question, of course, is how long will this persist for? Even in the US, we've got backlogs of work falling sharply now. Companies are going to start looking at their workforce numbers soon if that persists.
Chris, what is the message on inflation?
The inflation, it's stickiness, stubbornness, around the 3% mark. It's not faltering yet. Again, let's watch those labour market numbers. That could help bring it down. Against that, you've got the oil price rise. The overall picture is sort of stuck at 3%. This last leg down to 2% is still looking really unattainable.
Chris, always great to catch up. Thank you for the instant analysis. Chris Williamson, S&P Global Market Intelligence Chief Business Economist with the PMI data. Let's turn our attention to another event that is happening right now. We're expecting it to happen right now. We can't see that it's started yet. The UAW President Sean Fain, we understand any minute now will hold a Facebook Live event. He's going to be updating on the negotiations with the automakers and potentially updating us on where the strikes are going to progress to next. People familiar with the matter apparently saying that the UAW is making, quote, meaningful progress with Ford. Where does that leave everybody else? What are we expecting over the next few minutes? Craig Trudell joins us now. This is his wheelhouse. You're behind the driving wheel of all our coverage here on autos. It hasn't started yet. We understand Ford is making progress. What are we expecting to hear?
Yeah, importantly, that language around substantial progress was the sort of bar that the UAW said just a few days ago was what these companies were going to have to clear or else the strike expands. And so I think, we have not been able to confirm this just yet, but the expectation is that Ford may be, kept at just one factory for the time being. With GM and Stellantis, it may be another story. We have not gotten an indication that substantial progress has been made. With each of those companies, it's just one factory that's been down for about a week, as has been the case with Ford. The expectation there would be that we would see some additional plants struck as a result of that lack of progress.
So it looks like the Facebook announcement with Sean Fain is indeed starting. Craig, if we do see progress with Ford, don't the others kind of have to go along? It's going to be hard to make a deal with one and not the others around the same kind of terms, right?
Ideally, we'll see some, I guess ideally if you're a car maker in Detroit right now, we'll see some semblance of normalcy restored here because this is how it has always worked in the past. You've had the union sort of, settle in with one car maker, hammer out a deal, and then try to use that deal to sort of leverage agreements with the other two. And even if it's one at a time, or at the same time, in the past, that's the way this has gone. I think the very unique aspect that we've seen here is the UAW sort of rip up that playbook. The UAW president, Sean Fain, has actually, thrown offers in the trash in a sort of show of his frustration with the offers that have come in from these companies. And that's not the only way that he's sort of thrown out convention in the way that he's approached negotiations with these companies.
It looks like some sort of video is playing. As soon as we get to Sean Fain, we will bring you the news on what he is going to tell us about where we progress from here. What is if the strike is going to progress, where is it expected to progress to?
That's one of the sort of uncomfortable facts for these companies is they don't know what the union's next move is. I think, generally the expectation, if I were a betting man, would be assembly plants because parts plants are unlikely to be a sort of good place to take those out because that will lead to other assembly plants going down and potentially lead to layoffs that the UAW would have to sort out, strike funds going to those plants anyway.
All right, Craig, thanks a lot. Super appreciate it. We're going to bring you back further if we have more updates. Coming up, we're going to get to our question of the day, but I do want to take you now to the UAW Auto Workers President Sean Fain. He's speaking on Facebook. Here's kind of what he's talking about.
Region 1, 400 workers at Lear, the auto parts supplier, just joined Local 155. President William Verdier and Recording Secretary Sylvanus Thomas worked hard to help bring these workers into our union. From auto to higher ed and everywhere in between, our union is organizing, growing, and building our power. It's not just new organizing, it's on the picket line too. Our 1,400 UAW members at Blue Cross Blue Shield of Michigan just marked a week on strike. For years, the insurer has been outsourcing their work. Our UAW family at Blue Cross Blue Shield was once 5,000 strong. Today it's shrunk down to just 1,400. And the workers that are left are stuck in a tiered system where it takes 22 years to get to top pay. Our members have said enough is enough, and they are being strongly supported by Secretary Treasurer Margaret Mock, Region 1A Director LaShawn English, and Region 1D Director Steve Dawes. They are all working together to raise awareness and build public support for this critical fight.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This economy has held up too well to pile into defensive parts of the market. So we want to be really particular in what we're looking at if we do expect a broadening of market participation. And this is really for the quarters ahead as we head towards 2024.
That was Mona Mahajan, Senior Investment Strategist at Edward Jones, speaking earlier on Bloomberg Television. So it leads us to the question of the day. How much pain are the PMIs predicting? They tell different stories, varying degrees of pain in the UK, Europe, as well as the US. And then how is that reflected in the markets? Kathy Entwistle, Morgan Stanley Managing Director, joins us now. Kathy, how much pain are the PMIs predicting and where?
Yeah, every time we see the PMIs go down further, it's just showing us that there's going to be more issues that are coming and that we need to be concerned. So a lot of times these numbers that we're looking at across the board when we're looking at the economy, we're trying to figure out where we're going. And again, these will help us realize that the reality is there are issues in the markets, there are issues in the economy. And even though we've been seeing such a great trajectory of growth stocks in the markets, overall, there's issues to come and we have to think about them. and know that we need to position ourselves properly to, to manage our portfolios against that.
Kathy, the big story out of this week has been central banks that have paused. We've had PMIs that are pointing to slowdown, or at least sort of not stagflation, but stagnation at best. Yet you look at what is happening in the bond market and the yields that we're seeing and the climb that we've seen in yields this week, and it doesn't all add up. How do you put all that on the same piece of paper and make it kind of connect?
Yeah, that's interesting. It's almost like a tale of two cities. We're looking at inflation, and there's some inflation that's coming down and some inflation that's going up. We're looking at, the PMI numbers, and we're looking at the services that are, underlying that. And it really is very typical of where we are in the cycle. We're sort of in the late cycle of this market. And we should see some relief eventually, but we're not going to see it yet. And I think as long as you're aware of that and you look at opportunities to take advantage of, I guess, low points and buy at those times, that's how you manage your way through the market in terms of spending and the reality of that we're all consumers, and how are we going to get past these high costs and high prices, and will people still pay to travel and things like that. I think we're going to see some pain there.
Well, okay, so as an equity investor, let's just say, take the equity market for instance, because what I found so interesting about the PMIs and then the reaction in the equity market was the lack of. Like, sure, we're a little heavy over in Europe, sure, we're holding up okay here in the US, but like no real movement, right? So I'm just wondering, like, is all the bad news already priced into Europe to some extent, but it's the US that has more to go?
That's a great question, Alex. And I would say that when we look at the markets and where the opportunities are, we think Europe does have a little bit more advantage because the valuations are lower and there's probably more opportunities there, where yes, the US probably has more to go. And as we all know, the way the market has been running, it's really been based on just a few key stocks. And there's a lot of underlying stocks that are not performing quite as well. And those also might be the stocks that are the opportunities for clients going forward.
Why would I want to come out of cash, though, right now, Kathy? As you say, we're at a really difficult juncture. We're trying to read the market. It's a struggle to read the market. This week, bonds have gone down, stocks have gone down. What do you do with that? Do you just sit in cash, wait, watch, see what happens, and then make a decision when the chips are kind of easier to read? How do I play this?
That's a great question. It's tempting to stay in cash because you are getting that 5% return, which seems a lot more positive than some of the markets that we're seeing with bonds and stocks, especially in the last week. However, we have to think long term. We have to have more of a disciplined approach. So we don't want clients to be out of the market. We want them to be in the market, but more focusing on the areas where there might be more opportunities, more defensive type companies. And also, when you think about growth stocks, look at growth stocks at a reasonable price. Look and make sure the valuations are reasonable. And you can also look at dividend-paying stocks, but also look at dividend-paying stocks that are growing their dividends, because that's showing that they have some opportunity to increase the value of their company as well. So looking in those areas are a little bit, I guess, smarter right now than others.
So Kathy,
dollar cost average too. Sorry, Alex.
Yeah, no worries. Dollar cost average, you gotta love that one. But that seems to me like buy consumer staples and buy AI tech stocks on the dip. Is that a fair assessment?
Yeah, healthcare, financials, energy, and buying the markets on the dip for sure.
Yeah, but in terms of my risk tolerance, am I being risk averse right now? Am I in defensive mode? Am I in wealth preservation mode right now, Kathy, rather than trying to make money?
Yeah, you should be in defensive mode. First of all, you want to protect the money that you have. You want to protect your investments. So you want to be in areas that are more defensive, and you don't want to be overly aggressive. And interestingly enough, we're finding that, maybe 10 years ago, we would have clients in portfolios that were the old, 60-40, 60% equities, 40% fixed income / cash-like investments. And we're actually bringing down that allocation to equities, not expecting more than, we're not expecting more than high single-digit returns over the next 10 years in the equity markets. It's not going to be like 2011 to 2021. So you have to be thoughtful and you have to be selective about where you're putting your money.
Kathy, great to catch up. Have a great weekend. Really appreciate the time as ever. Thank you very much. Kathy Entwistle, Morgan Stanley Managing Director. The Sean Fain event is still ongoing. He continues to update and brief as to where the UAW is going to be moving next. He talks about the fact that GM and Stellantis still need a serious push. He talks about the fact that there has been progress with Ford. It looks like they're making the most progress with Ford. So this is what's going to happen. The UAW is going to expand its strike action against GM and Stellantis. It is not going to do so against Ford. It feels it needs to push Ford a little harder, but progress is being made there. Clearly, it feels it needs to push GM and Stellantis much harder, and as a result of which, the strikes will be expanded. We'll continue to follow this event for you. This is the Facebook Live event that is taking place right now, and we will continue to keep you abreast of what Sean Fain is saying and the implications for the auto industry and the US economy. Still ahead, we need to talk about what is happening in the tech sector. Microsoft, Activision, that deal could actually happen. The deal edging closer in the United Kingdom. This is UK regulators signaled they will accept Microsoft's latest, quite substantial concessions. Details of that next. The startup is coming. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We probably need to go back and check in on what is happening with the UAW update. Sean Fain updating us now on what is going to happen next. We are going to see a significant expansion of the strike. The strike is going to be expanded to 38 locations in 20 states. This is at GM and Stellantis facilities. Ford, where progress appears to be being made, we're not there yet, but Ford is going to be spared that expansion.
Yep, and you can really see it also in the stock price. Ford is holding up okay. That stock up by about 3%. GM kind of rolling over here at neutral. Stellantis, though, still holding up by 0.6%, but off its highs. But very clear, like we're not done yet, but definitely obviously making the agreement that as they inch forward, that things can go the car makers' way as well. If they give a little, then they get less strikes, I guess. But Stellantis and GM definitely not done yet. I do wonder, though, Guy, if they do, as I mentioned before, if you do make a deal with Ford, is that just going to be the deal for the other car companies? Is there a first mover advantage when it comes to making a deal with the union?
Probably, yes. Ford has traditionally had better relations with the UAW, so that may be kind of the easier part of the narrative. Maybe the others are going to hold things up. They are going to fight a little bit harder. So maybe they don't just take the Ford deal and say, that's what we're going to do as well. Maybe they're actually going to say, you know what, we're going to take a different view. We're going to take a different stance on this. As I say, better relations with Ford traditionally with the UAW. Let's talk a little bit about what is happening as well with the Microsoft and Activision deal, because you're certainly seeing an impact in share prices around that. Probably time to take you to the startup. Ed Ludlow covering this story for us. Ed, let's talk about the deal that looks like it's going to be done in the UK that may get this deal over the line. So the UK regulatory authorities had held this deal up, but there's been a big concession. Does this kind of show that maybe the UK authorities were right to push a little bit harder?
It's so funny to say a big concession, because the point the CMA made, and Sarah Cadell on the show earlier, right, was like, why didn't you guys just make this offer at the beginning? If you'd done it at the start, you wouldn't have incurred the costs of negotiating that you had. But the compromise is to sell cloud gaming rights to Ubisoft, a French independent studio game developer or studio, and that has satisfied the regulator. And I can tell you that both Microsoft and Activision were very frustrated that cloud gaming was even the point of contention, because it's such a nascent and small market. But some strong words from the CMA on Bloomberg Television earlier was interesting.
Yeah, I have to wonder, are there other deals that could now come to the foreground if they do a little bit of negotiating here now?
What's so funny about this deal is Microsoft bought Activision for mobile gaming and the metaverse, right? That is what King Studio at Activision is good for. The getting hung up on the cloud kind of really had nothing to do with Microsoft or Activision's motivations. But again, the political context here is so interesting. This is post-Brexit CMA, right? Go to the Bloomberg story and look at what the CMA chief said to us earlier. And it's basically like, this is a lesson learned for anyone that wants to do a big deal, that wants to avoid an expensive negotiation. Come to us with the compromise that we asked for up front. It's pretty fighting talk, I don't know.
It is, it's interesting, and it looks like finally this deal may get done. Ubisoft, one of the big beneficiaries, certainly over here in terms of the share price reaction, could be one of the big winners out of this deal. Ed, I'm sure you're going to have some great coverage on this a little bit later on. Bloomberg Technology coming up in around 90 minutes' time. He will. Ed and Caroline, Bloomberg Technology a little later on. Sean Fain has just finished. We'll continue to keep you updated on that story next regarding the UAW. This is Bloomberg.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
From New York City,
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
We're about an hour into U.S. trading session. I gotta say, volume is really light. It does really feel like everyone's exhausted from this week, and we're just taking a bit of a breather. Abigail's tracking the moves. Abby?
Yeah, real Friday feel. And this is a classic board that we would have taken a look at back in the day, led by the Dow. But you can see the Dow up the least, up 0.1%. The S&P 500 up a bit more. And then tech, the NASDAQ 100 up about 0.6%. So a little bit of a relief pop after 3 down days in a row on the hawkish pause from the Fed, or higher for longer. The idea that the system could be taken, some more money could be taken out. On the week, it's a different story. This is really, again, it's not even a relief rally, it's a relief pop. It'll be interesting to see if it lasts on the whole day. Here is the S&P 500 this week, down about 2.4%. Last time I looked, this was the worst week going back to early March, down for a 3rd week in a row. So the selling that we started to see back in early July, or excuse me, late July, right after the last Fed meeting, when they also delivered what seemed to be some sort of a more hawkish tone than what markets had expected. I think that they've been pretty transparent in this, but markets keep getting caught off sides. And that is, of course, resulting in yields trading higher. Take a look at the 2-year yield, up 5 basis points, but more importantly, the level up 5.08% earlier, closer to 5.15, than the 5-year at 4.55. That 10-year yield right now at 4.4% or so. Likely, I think it had touched 4.5%. Again, technically, we've been talking about the fact that now that it's breached above resistance, you could see an equal and opposite move back above 5%. Then the 10-year yield is the big loser on the week at a 4.53, but it's kind of amazing that you could have the 30-year trading below the 2-year. I mean, it's just really kind of crazy. In any case, if we take a look at the S&P 500 pricing all of this in, we've been watching this chart for a while. These lines, these fan lines, show that last year's bear market was reversing. Here's the range. For a little while, we popped out. It gave us some hope. This week, take a look at this. This is how bearish this week is. We are now close to the bottom of that range. The RSI on a weekly basis is moving lower. Alex, actually, this suggests that we are going to see this S&P 500 go, I would say, somewhere to 4250, but the bigger thing is, does this range, this ascending range, does it break to the downside? It is a bearish pattern. So again, this fall may prove interesting.
Yeah, and sort of what that catalyst is even going to look like. Abigail, thank you so much. Really appreciate it. So one catalyst could be oil. So oil prices trading around $94 a barrel, capping a very tumultuous week. The highlight was Russia banning some product exports, which is really going to tighten up that market. Christian Malik is JP Morgan Securities Head of Global Energy Strategy. He joined Bloomberg TV earlier today.
The question we've had a lot today is why 100? Well, when you look at spare capacity of OPEC, over the next few years, the only ones that are going to be able to fill that gap in supply is OPEC. And historically, when spare capacity has fallen to sort of between 5 and 10% of total capacity in the world, that's a risk premium, which I haven't used that term for a very long time in oil, maybe last year briefly, that will drive $20 above the 80 to 100.
So that's the strategy take. Why don't we get the investor take? Ben Dell is Kimmeridge Energy co-founder and managing partner. Kimmeridge is an alternative asset manager focused exclusively on the energy sector. And Ben, by energy, I mean everything. You recently closed your latest E&P fund, so you do have oil and gas. You also do a lot of climate-related stuff as well, and you're working on some carbon management exchange things. So we're going to get to all of that. Do we get to $100 oil?
I think we do. I don't know if it's 2024.
Stay there?
I think we're going above 100. I mean, fundamentally, what we're seeing here is a repeat of the 2000s in the sense that the upstream business is consolidating. Operators are not investing in supply. There's an underinvestment on the supply side of the equation. And ultimately, we're going to see the marginal cost of supply rise. And I think that'll continue to drive up commodity prices, both oil and gas prices, over the next 2, 3, 4 years.
How does the Permian react to that, Ben? If you see prices north of 100, the temptation to crack is going to be enormous. Now, the privateers will definitely do that, but what about some of the bigger companies as well?
I think you're going to continue to see discipline. I mean, 5 years ago, we saw the business model of the upstream oil and gas companies change from a high growth, no return model to a low growth, high return, distribute cash flow, improve balance sheets. I think the other thing that we've been seeing happening is a ramp up in M&A. And we saw this in the 2000s. We saw large cap buy small cap. The large cap operators are short inventory. And as a result, they're starting to accumulate and aggregate smaller companies. It started in the private space. We're now seeing it in the public space. Again, we saw that in the 2000s. And as we lower the number of companies operating the space, I think you'll continue to see discipline associated with that.
So yeah, I mean, we've seen actually the private play, I mean, we've seen production kind of static. Do you think that's because the private players have come to religion here and are trying now to clean themselves up to then do some M&A with some larger guys, and are you into that?
I think it's fundamentally a change in the business model driven by an understanding that delivering return on capital employed and returning cash to shareholders is what shareholders care about right now. The second issue is there's a lack of capital in the space. If you look at private equity fundraising, the last 2 years have probably been the worst on record in probably 20 years. So there's really no capital to put to work from a private side. The cost of capital has gone up on a debt side. And when you look at the compression in multiples, the cost of capital on the public side has gone up. So I don't see that changing anytime soon. I mean, fundamentally, we've seen that capital move away from the space. I think if returns stay elevated, multiples ultimately expand, money comes back, and then we grow the supply base again. But that may be 4 or 5 years away.
Which 4 or 5 years we're supposed to be doing a net zero thing and like working towards that. So somebody mentioned to me the other day that what's happening in the alternative energy space in terms of, say, a capital suck is what we saw in shale back in 2015, 2016. We learned that the returns are a lot less. You have to plow in a ton of more money to even eke out those small returns, and we're kind of readjusting for that. Is that true? I mean, and if so, like, how do you, Bendel, invest in that space?
Yeah, I think there's a lot of analogs. I mean, if you look at renewable power, especially solar and wind, it's all been about megawatt growth, and it's not been about returns. And the argument you've heard is we're going to grow, we're going to get bigger, this space is going to accelerate. And I think what we've seen is a number of people make investments where the returns on those are low single digits. Now we have a higher cost of capital, and we're starting to see those companies' multiples compress because investors are realizing there's actually no value creation in that opportunity. I think what you'll see in the renewable space is what you saw in the shales in 2010 to 2020, which is that growth will decelerate, companies will consolidate, and the smaller cap players will get acquired. And we'll see better capital discipline, and ultimately those business models will also change. So I think it will come, but I do think you're seeing the parallels of the shale revolution in renewables right now, which is its growth at any cost.
Ben, one of the issues that we continue to have with the energy transition is we don't have a lot of frameworks in which we can operate. We don't know what the price of carbon is. We don't know what the price of anything is, to be honest, going forward from here. When is that problem going to be solved? Do we just adopt EU carbon trading? How do we fix the problem of commonality of the baseline from which the industry is going to grow?
Yeah, well, what we've said is that really everybody wants the same thing, which is low-cost power on demand with no carbon footprint. And if you look at that, you have your existing asset base, oil and gas, and you have carbon removal. And on the other side, you have renewable power, and then you're going to need to pair that with storage. And in the long run, what we should see is the price of carbon go to a marginal cost of renewables plus storage. Now, I think there's a huge path, decades long, of price discovery in that. We personally would love to see a carbon price. We think carbon markets are critical to success. And the reason I say that is what we've seen in the IRA is that if you create economic incentives, capital will follow. And when you really think about what a fully functioning carbon market will do is it puts a price on the emission, and it will bring capital to lower those emissions.
Right, because if you can't price it, then you can't invest in it. So unless you can show an investor, I'm losing this much money because of this carbon, I have to invest in it, it's not going to happen. So, but everyone wants to create a verified trading carbon platform. Like everyone wants to create the holy grail of like, I'm going to judge this tree versus this carbon management capture over here. You're also doing that. Is there room for all the players? How does this wind up if you're not all on the same platform?
There is. I think, listen, the carbon market will grow over time. We've seen it internationally. I think it will happen domestically. The fundamental problem with the carbon market right now, though, is transparency. If you think about carbon removal, what we care about is additionality. Have we taken carbon dioxide out of the atmosphere? And duration, are we doing it in perpetuity? When you think about that, it's really a mass balance. Whether someone looks at a tree or a new tree, whether someone looks at storing carbon underground, you should be able to measure and verify that you have stored the carbon and it's there in perpetuity. We're big fans of carbon removal credits. I think the market has got somewhat mired in this discussion about avoidance, which are counterfactual arguments about, well, this forest would have been cut down if I didn't do that.
Right.
And we need to see segregation between those two. We need to see greater transparency. And I think at that point, you'll see an acceleration in the market.
Before we let you go, LNG, you have an agreement with Commonwealth LNG. Any update there? Like, how big are you betting into the LNG U.S. export market right now?
We believe that fundamentally one of the best ways to remove emissions is to convert coal to natural gas. That substitution has been one of the biggest drivers in the US, and the US has the ability to export gas into international markets and accelerate that adoption internationally. We have an upstream asset in South Texas. We're integrating it through to LNG, and we believe we can actually put LNG on the water with no net emissions on a Scope 1 and Scope 2 basis.
Wow.
So we're big believers in the growth of US LNG. Well, we'll hopefully be doing that by 2028.
Okay, that'd be huge. Like green natural gas in just a few years is like that, no longer a bridge. Like that's gonna be the real fuel going in. Ben, really cool stuff. Thank you for joining us, Ben Dell of Kimmeridge Energy. And next week, speaking of energy, I will be at the 2023 American Energy Security Summit in Oklahoma, where I'll be talking to the heads of Oxy, Devon, and Continental, plus a conversation with Nikki Haley, the former U.S. ambassador to the U.S. No, Guy, I am not bringing the hat.
Sorry. Okay. If you're gonna answer the question already, we could have some fun with that. But if you're ruling the hat out already, that's a huge shame.
It takes up a lot of space on the plane. Okay, ETR Friday's next. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
So let's get to ETF Friday, because there's been one that has a very big uptick in volume recently, almost fully recouping losses from earlier in the year. And Emily Grafeo joins us now for today's ETF Friday to tell us which one it is. All right, what is it?
So this is the Dynamic Beta Managed Futures ETF. The ticker is DBMF, and it seeks to replicate the hedge fund strategy of managed futures. This is a quant-based strategy, so no discretionary investor involved. They're going long and short various asset classes and commodities. And this strategy really fell off in the beginning of the year as the stock market rallied. Now we're seeing volume pick up, and DBMF had its biggest inflow ever last week, $96 million in one day. The idea here is that as stock and bonds pick up in correlation, maybe investors are going to want an alternative asset class, and you can get that with managed futures. At least that's the promise of DBMF.
Emily, just very briefly, who's buying this?
Well, it's unclear with ETF inflows, exactly where it's coming from. Retail investors obviously can buy ETFs, or you can have professional asset allocators who have a 60-40, but they want a little slice of an alternative, and they can add that managed futures allocation in there.
Emily, great stuff. Thank you very much indeed, Emily Grafeo, joining us for ETF Friday. Coming up, we are going to be speaking to the Greek Prime Minister. Kyriakos Mitsotakis is going to be joining us. That conversation next. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
So, let's talk about Greece. More than a decade after we saw those bailouts and those horrible austerity measures, Greece has been pulled from the brink of bankruptcy, and the country very much economically on the rebound. In fact, to the point at which it's on the cusp of regaining a series of investment-grade ratings. Here to talk about the economic outlook for the country in light of rising interest rates, what's happening with the slowdown that we're seeing, certainly evidenced by today's PMI data at the core of Europe, is the Greek Prime Minister. He is, of course, Kyriakos Mitsotakis. Prime Minister, thank you very much indeed for your time. I hope you're having a great week in New York, and it's fantastic that you can take some time to join us here at Bloomberg.
Well, thank you.
We are starting to see an economic slowdown in Europe. We are starting to see Germany slowing down. We're seeing France slowing down. How do you think that's going to ripple into your economy?
Well, first of all, I'm happy to report that the Greek economy has proven particularly resilient. We will have significant growth rates for 2023. I expect growth in excess of 2%. And my goal has always been to significantly exceed the Eurozone average growth. And I think this is a success, taking into consideration everything that had happened to Greece over the past decade. So I think Greece is back for good. We just won our second mandate. We have a very clear reform agenda. We just got to investment grade, which was an important milestone for the country after 13 very difficult years. And if you look at all the indicators, I think we will do significantly better than the Eurozone average. And I'm cautiously optimistic that we can maintain this growth track for the long term.
So what's your goal then economically for 2024 in light of potential 4% interest rates from the ECB for longer?
Well, first of all, the fact that we got to investment grade, helps us with our borrowing costs, and this is, of course, significant for public finances. But we've also been unapologetic about maintaining fiscal discipline. We understand how important this is for global capital markets. Looking at Greece, we will have a primary surplus of 0.7% this year, and a higher primary surplus in 2024. And we feel that we can meet these fiscal targets without compromising our growth. If you look at tourism numbers, they were remarkable this year. And there seems to be a trend in Europe, in spite of the recession. People continue to travel, and they seem to continue to prefer Greece over maybe other Mediterranean destinations. And of
Guy
course,
definitely does, by the way.
Alex, you should too. And Greece is a lovely country to visit, and not just during the very hot months of July and August. We've been able to expand our tourism season and attract significant investment in sustainable tourism.
Okay, Prime Minister, I'd like to talk to you about that. I managed to avoid it this year, but I know plenty of people that didn't. It got very hot in Greece. It got very hot around the Mediterranean this year. I talk to people in Scandinavia, and they think that they are going to be the big beneficiaries of this. They think that people will no longer want to travel to places like Greece if it's 45 degrees and there are fires burning. What do you think the long-term trajectory is for Greek tourism if we are going to see this climate change sticking?
Well, I disagree with this hypothesis. People still enjoy the hot Mediterranean, and they do want to come to the Mediterranean and to Greece in particular during the summer because they like to spend time at the beach. If anything, I would argue that climate change is an opportunity for us to expand our tourism season. Yes, it may be hot to come to Greece in July and August, but we will always have enough people interested to come to Greece during those 2 months. But we have now more people interested in coming to Greece in March and April, or October and November. More people interested to come to visit our cities year-round. And expanding our tourism season has always been an important priority for us. And I think, Guy, that there will be more people who, given the choice, will choose not to take their holidays in July or August. Not just because it may be too hot, but because it's too crowded. So for us, it's a great opportunity to expand our tourism season and also to open new destinations on the mainland for people to explore. So it's still going to be some time until the Scandinavian beaches or the Danish or Swedish beaches are going to compete with the Greek beaches. I don't see this happening anytime soon.
I'll pass that message on next time I see them. You did face some criticism, though, in the way that you handled the wildfires this year. What lessons do you think you learned?
Look, I mean, the climate crisis is here, and it's here for good. We've always had wildfires in the Mediterranean, but we had particularly intense wildfires this year, and we also had unprecedented floods. So it's very clear that we need to focus more on short-term adaptation. And this is, of course, a case I'm also making to my European colleagues. We spend trillions of euros on long-term mitigation, and rightly so, because we want to be leaders in the climate transition. But we also need to support people when they lose their livelihoods, their houses, as a result of climate disasters today. So we need to be much more effective in dealing with these disasters. We've made good progress. For example, in Greece, we have a 112 emergency number, which we used very successfully to evacuate people and make sure that we saved lots of lives. This is something, for example, that was not present in Maui. And when I look at the Maui disaster, it's so painful because we had gone through similar disasters 5 years ago, but we learned from them. And we are using technology in a much smarter way today to make sure that at least we can save people's lives.
The climate crisis is going to cost more money in terms of either dealing with events or also where you get your energy. Where are you going to get reliable, affordable energy from, and where do you get it?
Well, first of all, we get it from the wind and the sun. We are
affordable.
It is affordable. It is
reliable.
Cheaper. It is cheaper. It is reliable because we have lots of sun and lots of wind. But of course, it will not do the trick on its own. But Greece is one of the top 10 producers of renewable energy from the wind and the sun. We have 12 gigawatts of installed wind and sun energy in Greece, and much more to come. But of course, in the short to medium term, we will also need to rely on natural gas as a transition fuel. And there's a case to be made that Greece is playing a very important role in the European energy system, because we are also an entry point for natural gas to serve not just the Eastern Europe, but even pumping gas up to Ukraine. So Greece's role as a pillar of geopolitical and energy stability in the Eastern Mediterranean has certainly been enhanced after Russia's invasion into Ukraine.
Prime Minister, one of the other effects of climate change could be that we face within Europe even greater pressure from migration. How destructive could that be to the forces that bind Europe, the EU, together right now? How damaging could it be to institutions such as the European Union? Could we see those institutions once again fraying at the edges because of the pressure that is being applied? And what do you think needs to happen now in order to try and avert that crisis? I know you've had talks with President Erdogan recently. Let's talk about how that could progress in terms of dealing with the issue. But how do you see the European Union doing more on this matter?
Well, obviously there are long-term solutions addressing the root causes of migration, but these are going to take time. As far as the short-term solutions, we need to do two things. We need to be ruthless in terms of breaking the smugglers' networks that benefit from desperate people who they put on boats which are clearly not seaworthy. But at the same time, we need to balance that by offering legal pathways to migration to those who can come to Europe and who can also help us with our economic growth. Look at Greece, for example. We're bringing our unemployment down. We already have labor shortages in sectors such as agriculture. So we want to do bilateral deals, but we want these people to come on our own terms and to come safely.
Prime Minister, we do have to leave it there. It was such a pleasure to catch up with you. Thank you so very much.
Thanks for having me.
Prime Minister of Greece joining us here. Thank you. Come back. The European Close coming up next. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business Business Authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Friday, the 22nd of September. US stocks are starting to rally. Doesn't feel convincing. Over here, we're not even getting that rally, really. CAC's flat, DAX is flat, FTSE's up a little bit. Not really much action. But it's been quite the week, hasn't it? Maybe we're just kind of pausing, trying to figure out exactly what's going to happen next. We'll talk about what can happen next. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
European stocks are down a little bit. We're seeing some of the mining stocks doing well, some of the commodity stocks broadly doing well, but the market's just a little soft. And one of the reasons for that, the banking sector is under a little bit of pressure. Key to that story is the fact that Dutch banks are tracking lower today. The Dutch Parliament passing additional measures that will allow the government to tax these banks a little further. So ABN AMRO is down by 4.32%. We've talked about the impacts of the CMA deal that could allow Activision and Microsoft finally to get together. One of the big beneficiaries of that is Ubisoft. That stock, Alex, up by circa 4%.
Yep, the other big beneficiary of that is Activision. That stock is up by about 1.7%, so just to start there on that point. Now, yes, the S&P is up by about 0.5%. Tech stocks are getting a nice lift now, up 1%. But I just have to point out that volume is still terribly, terribly light. We did get the PMI that was the best of the bunch. It's still above 50, but continuing to roll over just a touch. We also had a sell-off over the last couple of days in the equity market where you had the S&P close below its 100-day moving average, so maybe a little bit of a lift off of that. But I got to tell you, it's hard to take direction seriously. I mean, just look at the 10-year. The 10-year yield hit its highest level since 2007, and then now we have buyers coming in, and yields are down by about 5 basis points. Now, the dollar-yen is up. That actually is maybe a function of market action here. You get up by 0.3. You had the BOJ overnight, absolutely nothing. Zero zilch. Therefore, that weaker yen continues, Guy.
Let's talk about the data. Let's talk about what's happening. It does feel like a different picture on either side of the Atlantic. Manufacturing is uniformly weak, but the US economy is a service sector economy, and that is holding up, as you can see. These numbers aren't great. The manufacturing number looks a little off, but France, that's where the weakness is in Europe. Germany's kind of stabilizing at an aggressively low level, a little bit of a pickup in services maybe. The Eurozone numbers still look horrible, services below 50. And the UK data, the real takeaway from the UK data is that the labour market is beginning to soften and soften quite significantly. The other takeaway from these numbers is that inflation, Alex, remains very sticky.
Yep, inflation's sticky. The jobs picture, though, very different depending on where you are. We spoke to Chris Williamson, chief business economist, how about that, at S&P Global Market Intelligence in the last hour on those PMI numbers.
So more pain to come. So the upshot is you're looking at signals of Q3 GDP declines, both for the UK and the Eurozone, with that weakness persisting into the fourth quarter. US, on the other hand, is fairly stable.
Takes us back to our question of the day. How much pain are the PMIs predicting? Gotta love the alliteration. Maybe it's hard to say. Denitsa Zagova joining us now here in London. And international economics and policy correspondent Mike McKee back from DC, back in New York, back with the traffic. Loving that. Denitsa, let me start with you. Let's talk PMIs here in Europe. They are quite ugly. Are they going to get uglier? What are they predicting? Because they've been predicting a recession for a while.
They have indeed been predicting a recession for a while. When we compare the US and Europe, we see a really big divergence. And of course, US PMI stagnated today, but if we look at the divergence, US is still holding above that important 50 threshold, which is something we cannot say about the UK or the Eurozone. And that is kind of a similar, if we look at the overall picture of economic data, a great way to look at it is the economic surprise index between the US and the Eurozone. And there is this huge gap with the economic data in the US surprising to the upside, while we're kind of seeing the other trends in Europe.
Yeah.
So obviously the data today is a little bit disappointing, but compared to what we've seen in Europe, it's relatively better.
How much pain are the PMIs predicting? See, Guy, it's really not that hard. How much pain are the PMIs predicting? There you go. I've said it multiple times.
Okay. You can keep practicing. I messed it up once.
And
what was the top? Was correspondent?
Yeah, I did call him a correspondent. I don't know where that came from. Words are hard.
It's Friday. Look, I think my point here is it's Friday. It's been a long week. We should give each other a little bit of a break.
Always. How much pain are the PMIs predicting, Mike?
Rubber baby buggy bumpers.
Rubber baby buggy bumpers. Come on, guys, get with this.
Well, in the U.S., not a lot at this point. And I think the manufacturing obviously is the weak part. We knew that. I go back to the ISM from last month and your interview with Tim Fiore, who said he thought this was the bottoming out. And we do see a little bit of improvement in manufacturing for the U.S., so that could be the case. The U.S. just seems to be hanging in there, not growing gangbusters in these reports, but growing much faster in actuality, at least the data we keep getting.
Yep.
But Guy, one of the, and I can't remember, I'd give them credit, one of the banks today, their analysis was the good, the bad, and the ugly. The U.S. was the good, and Europe was the bad, and the U.K.
Yep.
They have problems. But the interesting thing is, this month,
you didn't want to say it.
So far this month, the surveys that Bloomberg does of economists in all these regions show really only Germany forecast to undergo recession in the third or fourth quarter, and even the UK not there yet. So how much pain? Hard to say.
The problem I have with this data is that it is pointing to a slowdown in Europe. Yes, it's probably going to get ugly, I think probably for everybody, but that inflation is going to remain sticky. So the pain is going to be substantial because normally you would expect a policy response, but maybe we don't get that policy response. And that is the problem here. That's where the pain really lies.
Well, it's going to be interesting to see how the central banks play that as we see
we were used to historically, because the downside surprises in PMIs in the summer have contained the sell-off in Bund yields. Now, what will be interesting really also in terms of the comparison in US versus Europe is how the supply picture shapes up, and also how that extra tightening that central bank may consider, what shape will that take? In the US, we still expect one additional hike. In Europe, we think that the extra tightening we will get is more likely to come through bringing forward the end of QE or investments in PIP. So that creates also a bit of supply pressures in European bond markets, which weigh really in the 5 to 10-year part of the curve, while in the US, the sell-off may continue to be mostly driven by the front end of the curve, where the Fed can still push yields.
Have an impact, yeah. Sophia, great to see you. Thank you very much indeed for coming to see us. Sophia Salim, Head of European Rate Strategy, joining us from Bank of America. The European equity markets are done. We finished fairly flat, even the FTSE 100 finishing fairly flat today as well. Little tick down during the auction over the last couple of minutes. FTSE 100 just in the green, but only just. The DAX just in the red, but only just. The CAC 40 suffering a little bit more, but not by much. Basically a fairly soggy end to what has been a fairly negative week for European equities. What are we going to talk about next? You want to see currency turbulence? Turn your attention to what is happening in Nigeria. Alex, there, the country has been forced to appoint an acting central bank governor. After this week, we've seen the country delaying one of the key the rate decisions that it was going to be making. We are going to be talking to a key player in that economy next. Looking forward to that conversation. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field, because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
There were like 11 central bank decisions this week all across the world. One where there wasn't was in Nigeria. Had to postpone its rate decision meeting after the nation's president overhauled its leadership as the Nigerian currency plunges to a record low. It's been really tough. Well, joining us now for more on kind of what's going on within the country is Jennifer Zabasaja, which is so great to see you.
Thanks for having me, Alex.
Next to me. Okay, so can you walk me through what are the hurdles right now for Nigeria?
Yeah, I mean, it's a lot, right? It's only been a few months since President Tinubu assumed office, and there was a lot of optimism in the market initially because there are these two parallel markets with the Naira, with the exchange rate, and what he was trying to do was really bring the two together because there's a lot of divergence that we've seen over the past few years. And so initially there was optimism because we saw these two parallel markets converge. Now, as you mentioned, the Naira is plunging to new lows. It's touching close to 1,000 Naira per dollar. And there's a lot of concern that this is not going to change anytime soon until we see the central bank really getting back into place because the previous central bank governor was removed from office. And so there's a lot to look out for potentially when we see this new central bank governor coming in.
Jen, what does he need to do? I'm assuming we need lots of dollars. Can we provide those? How does that work? I'm presuming that's what's required here. And I'm assuming there's probably going to be a fairly substantial rate hike as well.
Absolutely. And as Alex mentioned, I mean, there was supposed to be a significant rate decision this week that's been postponed indefinitely until we do see this acting central bank governor come in. And on the issue of dollars, a lot of concern in the market, a lot of people have been talking about that the central bank has been holding off giving any dollars out at this point in time just because of the frenzy of concern that people are rushing there. And so right now in Nigeria, people are not just seeking dollars just for imports. They're looking for it just to stash into the country just because they're concerned that the Naira is going to continue plunging. And so really the market is looking for any indication that this situation is going to change. Here in New York, where I am, we saw President Bola Tinubu down at the stock exchange saying that Nigeria is still investable and that the money should still come. But it's still looking a little bit dicey and a little bit of concern for investors at this point in time.
Okay, so great segue because let's go to that. And Jen, stay with us because talking about investing, for more on Nigeria's financial future, Tony Emelelu is UBA Group Chairman and founder of the Tony Emelelu Foundation. He also chairs the largest conglomerate. You're going to be investing upwards of $2 billion in the power sector. Like, you are putting money, time, resources, and philanthropic efforts into Nigeria. Make your case for why money should be coming in when Jen outlines all the difficulty.
I think I have a credential of business turnaround, and I know how it is to turn around a business, which Nigeria is like a business turnaround situation at this point in time. The economy was badly run, and we have a new president who believes in the private sector and who is doing his best to attract investors to the country. That is why my group and I, we keep investing, and we want to continue to invest in Nigeria. I have seen a president who is pro-business. 2 days back, we were at NASDAQ where he rang the closing bell. And to me, it's signaling, symbolic. It shows that, because we have a lot of resources in the country, human, natural resources, the missing link has been poor leadership. And I believe, as we all know, there's so much private global capital seeking the right investment destination. All it takes is for a leadership to show that this country is set for business and people come there. People want to move into an economy where they can invest freely as well as move their monies out when it comes for time for dividend and remittances and repatriation of a dividend. Right. So I will continue to invest because of the signal that we see in the market, because of certain fundamentals that are right. If we can fix some of these, oil theft, fix oil theft, make sure the pipeline that carry the transportation of oil is right, make sure that the macroeconomic indices are right, make sure, as we do now, how today, coincidentally, the new central bank governor just resumed. Right. And we hope that he and his team, we know some of them, and we think they're very capable.
Right.
We believe that he and his team will be able to bring confidence and trust back to the Nigerian economy so that investors like us and investors outside the country
Tony,
will grow their confidence.
What is your expectation, though? You mentioned the central bank governor has assumed the role, but at the same time, we're talking on a day where the Naira is, as I mentioned, touching almost 1,000 per dollar. I mean, is the volatility going to continue? Is that your expectation?
The way I see it is when you're doing a turnaround, it gets worse and then things get better. You know, the two rates have been merged, or the multiple rates have converged, and people just want to see that the new leadership will be able to sustain what they've started. Once they do so, confidence will rise. And as you rightly said before, Jennifer, the reason people are accumulating dollars, not because they need it now, is because of lack of confidence. When they see that the new government is taking the right policies, as they have started, they've harmonized the exchange rate, and they've also removed petroleum subsidy, which used to be a major drain on our natural resources. Fix the insecurity issues, make sure the oil theft is addressed, make sure the petroleum pipelines are strong.
Yep.
I think it's a matter of time. The country will take off. And so, yes, the rate would ultimately improve because the kind of speculative demands we see today will fizzle out.
But as you say, Tony, you have to have confidence. And you have to believe that the government is going to do the right thing. This week has not felt like that. And that's the problem, that confidence is being undermined every day. We see the kind of headlines flashing around the world about what the currency is doing. Isn't the job of restoring confidence getting harder every day that this crisis continues?
I think two things have happened. First, there's been a change in leadership at the central bank, and the new central bank governor resumed just today because the Senate had to clear the new appointment. We have confidence in the new central bank governor based on his credentials and his team, and we believe that they will correct things. Number two is people are panicking because they don't know where the rate will go. And what you see in the headlines you see today is a reflection of what has happened for the past couple of days. But from now on, that we have a new leadership at the helm of affairs of the central bank, plus the president's signaling and strong commitment to actually making decisions that will help the economy rebound. We believe that it's a matter of time. But most importantly for me is fixing the fundamentals, making sure that oil theft is addressed, making sure that there's consistency of policies, making sure that the good discipline and audacity that the new leadership has put in place continues, because it's big audacity to converge the rates as well as making sure that the fuel subsidy is removed. These are things that used to guzzle a lot of currency in the country. So with that gone, and with people, new leadership, and people beginning to see that the direction, the discipline, I think it's a matter of time for this to correct it. But as I said, I have been involved in turnaround business, and I know how it can be when you're starting the journey. That's what I think is happening in Nigeria at this point in time. A little bit of patience, and I think things will smoothen out.
Well, Tony, speaking of turnaround, there's also the issue of Nigeria's power sector, but you've been very significant and substantial in continuing to invest in the power sector. You've been here this week. Have you secured any other foreign investors potentially to help the turnaround in the power sector in Nigeria?
No, what we do, we buy the general electric equipment, GE equipment, the turbines, etc. And we have quite a couple, right now. What we're trying to do is to make sure that gas that we need to fire the plants are are fixed and in abundance. But in terms of acquiring new assets, we have quite a bit. We've invested close to $2 billion in this area. Today, we have capacity of about 2,000 megawatts of electricity on a daily basis. We supply almost 15% of Nigeria's total energy consumption, and also supporting the Republic of Benin, which is a neighboring country. But what's important to us is making sure that access to electricity is improved, because that is critical for even the exchange rate we're discussing now. You cannot industrialize Nigeria anywhere else in Africa without fixing access to electricity. You cannot develop a continent without fixing that. So to us, it's not just about making investments for profitability. It's about contributing our own quota that helps to transform Nigeria and Africa, because to us, our operating theater is all of Africa, not necessarily Nigeria. Access to electricity is important. Good governance is important. Strong leadership is important. And all of these work together to make sure that we take and that Africa takes off. And of course, we cannot forget our young ones. The future of Africa belongs to our young ones, and we must make sure we prioritize them in everything we do so that jobs can be created and they can be more economically and meaningfully engaged. And that is what brings sustainable prosperity.
We wish you well with all of those substantial tasks. Fantastic to have you join us here at Bloomberg. We greatly appreciate it. Tony Elumelu Ubiye, Group Chairman and Founder of the Tony Elumelu Foundation, and our own, of course, Jennifer Sabajaja. Thank you very much indeed.
Thank you.
This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Actually doing pretty well. I mean, volume is still light, but you have NASDAQ 100 up by about 0.8% after a pretty brutal week. Abigail is tracking the moves. Abby?
Yeah, the gains are accelerating here on this Friday, Alex, with the S&P 500 up about 0.5%, the NASDAQ 100 up 0.9%. You can see that the NYSE FANG index, those mega cap tech stocks, doing even better, and then China Tech up 3.2% after getting brutally beaten on this week. And that is the story in the week, to Alex's point, that stocks are down this week on a still hawkish Fed, or a Fed that's willing to raise at least one more time. This is the NASDAQ 100 this week, down about 2.5%. The question is whether or not this little area of congestion here next week can move into a bounce. It may in the brief period of time, but these indexes, they're really starting to break down technically. We probably have some more weakness to the downside. As for weakness to the downside, take a look at our recent IPO stocks. ARM Holding, Instacart, and Klaviyo all down on the day, so not well supported despite the positive tape. Kind of an interesting side note here, and we'll have to see how they continue to go. ARM and Instacart, I believe, are definitely below their IPO prices. Klaviyo, I think, is still above. As for the week, though, let's take a look at where the real pain is, and here it is. Tesla down 7%, Amazon down 6.7%, Microsoft, Nvidia, all of this, Alex, of course, having to do with the Fed, yields rising, the dollar rising, putting pressure in particular on big tech.
Yeah, it's been a tough week. All right, Abigail, thank you so very much. And funnily enough, we did see services in the PMI a little bit subdued. And here's one tangential story that might help give some color to it, Guy. Darden Restaurants, which owns things like Olive Garden, Ruth's Chris Steakhouse, Olive Garden, like endless bread baskets, okay? Just think of it that way, like overload on carbs. They say that they're actually seeing more softness with household income above $125,000. So according to Darden's CEO, consumers are still resilient, but they're being more selective in choosing things like lower-priced alcohol compared to last year. I'm loving all these indicators that we do on this now.
Do you have to check what your annual earnings are when you check in to get a table? I'm just wondering about how they're so specific about the
That's true. That's actually a really good point. How do they know that?
How do they know that? What basically they're saying is that people have substituted travel for wine. They are spending more on travel, and as a result of which, in their daily lives, they're spending less when they go out at the weekends or during the week, depending on your desires. So they're buying cheaper bottles of wine, but they're flying more.
There's probably an Alex Steele effect in all of this as well. Speaking of Alex Steele, I will be in Oklahoma City. Maybe I'll bring the cowboy hat for Guy. 2023 American Security Energy Summit. So join me. Mega guests coming on Monday. Have a great weekend. This is Bloomberg.
The thing that strikes me about these technologies in particular is that the brain is that last fortress, and our inner self is the thing that defines us. And yet we're at this turning point where that inner space could become part of some business's private enclave or some government's Orwellian fantasy.
So I worry about this deeply. And I worry that that final private space, the space that I think is so critical both for self-awareness and for resilience, for the ability to know truth from fiction, the emotional self-reflection and cultivation, is at risk of brain transparency.
You mean the idea that we can just be seen through entirely?
Essentially, right? I think the way we define intimacy in a lot of relationships is by choosing what emotions, what thoughts, what secrets we want to share with another person. And if all of that can be revealed by decoding your brain activity, if other people can have access to it, whether it's your partner who says, no, I want you to prove that you're in love with me, or a lie detection test by the government, or the way you authenticate yourself at borders is through brain transparency, I think this final space of mental reprieve is at risk.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde of Bloomberg's world headquarters in New York.
And I'm Ed Ludlow, not in San Francisco, side by side for the last time this week. And this is Bloomberg Technology.
Coming up, look, Microsoft poised to clear its final hurdle for its $69 billion takeover of Activision Blizzard. We'll dig in.
And the UAW expands its strike against GM and Stellantis as talks progress with Ford. We'll give you those latest details.
Plus, iPhone 15 hits the shelves around the world today. We'll get the read on the state of demand for Apple's new products. But first, let's check in on these markets. And if you weren't standing in line, over by Central Park in New York City. Maybe you're eyeing up what's happening in terms of the moon music turning to the green side. Just ahead of the weekend, we get a little bout of buying. We had upwards of 1 percentage point move on the NASDAQ earlier. We're now just up 0.6%. We saw the S&P 500 after 3 days of really quite torrid selling, managing to bounce off of what had started to become some technically oversold markers. Now we're seeing a bit of buying on the debt market at the moment. We're seeing 5 basis points, 6 basis points to the downside on the 10-year after we'd hit, well, close to a 10-year high in terms of the 10-year yield. We are overall, though, seeing what is a little bit of tentative purchasing in Bitcoin as well. Look, only 0.1%. I put it on there because it's small amounts. But really, what's driving this mood? Is it because some of the data actually looked worse than usual in the US and actually some slowing in terms of business spending overall and some of the data points showing that maybe the Fed doesn't have to hike so much? Or is it what's happening with US-China? Is there a thawing in relations? Are we starting to see these meetings that the US Treasury Department has just told us about between some senior level government officials in China and the US? Will that help the relationship? Certainly K-Web, some of those internet-related names traded here in the US, in China currently up 3.6%. But Ed, what are you doing on the micro?
Yeah, a lot of news, some of it here in town. Tim Cook here for the launch of the iPhone 15 that's gone on sale. Apple up 1.4%. Whether it's in direct reaction to that or not, we will discuss later in the program with Bloomberg's Mark Gurman. The other big piece of breaking news this morning has been the UAW is expanding its strike against GM and Stellantis, but not against Ford. You see Ford shares up 2.5%. GM flat, Stellantis actually higher, despite that continuing stalemate, essentially, between the unions and those automakers that are transitioning to EV. There is concern long-term about jobs. The other big story of the day is coming out of the United Kingdom. The UK Competition and Markets Authority has essentially greenlit now Microsoft's $69 billion purchase of Activision. They've looked at the compromise, which is to sell cloud gaming streaming rights to Ubisoft, the Paris or French-based video developer. Earlier on Bloomberg Television, we had the UK CMA CEO on to react to that decision. Have a listen.
The content creation remains with Activision, but the ability for Ubisoft now to take independent decisions about how that content is then distributed through third parties. So we know sort of previously Microsoft could control and limit the distribution channels, for example. That doesn't happen now. That's all within the unilateral control of Ubisoft.
CMA CEO there. Now let's dig into, well, the ongoing narrative of this story. Mark Bergen is standing by in London. And, I mean, we still got months to go until it's formally greenlit. But you think we can read the tea leaves that this is going to be good to go?
I think my impression is that Microsoft hopes by October 18th, so that's less than a month. But you know, these things, as always, are up in the air, and the regulatory environment, and certainly in the UK and Europe, can be a little bit more unpredictable when it comes to tech.
You know, Mark, at the beginning of the summer, I don't think anyone thought this deal was going to go through, and they overcame the regulatory hurdles here in the United States. Now the UK CMA was the final hurdle. What was the CMA's argument or commentary on why they felt Ubisoft was a good enough compromise?
I think this is a really interesting concession, and from my understanding, it's like they're basically looking for a third party that's not Microsoft here that can be making these decisions around cloud gaming. If you buy the Microsoft thesis, and certainly like other companies like Google have tried and probably will continue to try in this world of cloud gaming, giving Microsoft it feels like giving Microsoft control of that. If you have Ubisoft involved, then you have this third-party company, a French company, that can sort of deny the ability for Microsoft to manipulate the market.
Microsoft, Brad Smith in particular, comes out saying that they're still going to be working towards this October the 18th deadline, as you point out, Mark. But what a different environment. I mean, this has been a year and a half since they first wanted to get this $95 a share deal done. What's changed? I mean, is still the business basis remaining the same? Is it still all about mobile gaming?
You know, my impression, there's a armchair political analysis here, which is that the CMA was sort of the only organization in the US and even the EU, which is typically sort of much more willing to block these sort of deals, gave the green light. What's happening here in 2 months in London is the Prime Minister is holding this big summit around AI, this focus on AI safety, but also trying to build out the UK as a home to innovation and industry. I think it was certainly seen, the messaging from Microsoft is that if the CMA blocks this deal, that is very counterproductive to the ultimate aims. And so that probably was maybe one of the factors in this redirection here. And I'm sure we've done some excellent, my colleagues have done some excellent reporting on what went on behind the
Welcome back to Bloomberg Technology. I'm Adadlo here in New York City.
One last day. Meanwhile, I'm Caroline. Hi, let's get a quick check on these markets on this Friday play day. We're seeing currently up a percentage point, NASDAQ 100, managing to get a little bit of risk appetite creeping in towards the weekend. Now, there are some catalysts, whether it be some slightly weaker economic data that means the Federal Reserve could potentially hold for the rest of the year. Look, many are betting on at least one more hike. But for now, we get over the Federal Reserve hump day and move towards actually a bit of buying in the 10-year yield. We, of course, have been at highs for years on out, but we're currently at 4.44, let's call it, on the 10-year. We're currently down by some 6 basis points. So a little bit of appetite having seen those yields push wider. I'm interested in the China story, though. Crane shares, that's a particular index that I'm looking at, up almost 4%. These are internet names in China that are traded over here in the United States, and they get a bid because actually maybe tensions are easing a little bit between US and China. There's going to be working groups, discussions, particularly at the Treasury level between the United States and China. Could that be easing some of the overall heated conversation we've been having of late? Move on to the individual movers. PDD doing well on the back of that. Meta Platforms, interesting buy note coming from Citi as we look ahead to Meta Connect next week. And I'm looking at Warner Brothers Discovery. Not a huge amount of news lines around Warner's today. We're down by some 3%, worst performer on the NASDAQ 100. Maybe we look towards whether those striking actions, particularly between writers, could be alleviated a little bit more on this day of discussions then.
Another favorite risk asset of choice of ours here on the program, of course, is Bitcoin. I just checked. It's still at almost 27,000 US dollars per token. One of Europe's largest cryptocurrency asset managers, CoinShares, is actually looking to expand here in America with the launch of a hedge fund division. Fortunately, with us on set to talk through it all, Jean-Marie Mognetti, CoinShares CEO. One would imagine that if you're launching a hedge fund here in the US, there is demand on the other side for such an offering.
Yeah, thank you for having me. We started our journey in Europe. We are, as you mentioned, Europe's largest asset management company in crypto. And, the US remains 90% of the AUM allocation in the world. So you have to get an offering in the US. We started our journey in Europe, and it's time for now to bridge into the US. And we didn't want to go into the US with our traditional ETF program or ETP program like we get in Europe and trying to find something different.
Yeah.
We've been trading. Our DNA is asset management and hedge fund business. We were doing commodity business before that in a hedge fund style. So we say it's time to go back to our roots and offer the US market a hedge fund offering, especially when everybody is leaving the US. So what a better time to get in the US when everybody is exiting.
Okay, so you're taking a sort of controversial move because people are exiting because they're worried about regulation in particular. Perhaps people building their businesses elsewhere. We're looking at Gary Gensler really talking tough against the industry. What are institutional clients, investors saying about this?
So I'm not sure if it's controversial or contrarian.
Contrarian, yes, that's better.
When we started our journey in 2013 in crypto, I guarantee you we were very contrarian and people were telling us, what are you doing? So it's kind of part of our, again, DNA to be doing this kind of move. We're not building the hedge fund business. The hedge funds are not based in the US. They are distributed and available for US investors, and that's very, very different. And our game is like, how do we bring this product and extend our product offering into the US? Our legacy product has never been distributed in the US, never been available to US investors. This is the very first time now that we can bring this product to market to a US audience, and there is an appetite for that in the US. There is a lack of product availability in the US. You obviously get the GBTC availability, but beyond that, there's a few little number of players. So bringing a bit of diversity and different view and different thinking is a great advantage.
Is it generally going to be exposure to Bitcoin and some of the clearly not expected to be deemed securities?
Yeah, so first of all, it's liquid. So everything we do is like 100% liquid. We don't do like 10 years VC fund in that approach. So it's like liquid investment, monthly redemption, monthly subscription. So very, very kind of easy to invest. And at the end of the day, you have to be able to follow as well market capitalization and liquidity. So we're going to really focus on Bitcoin, ETH. Mainly, which are like kind of the big thematic we are seeing interest from.
The thing is, like, the fundamental question, whatever corner of the investing universe you're in, is what is the value of holding Bitcoin in a portfolio? From an asset allocation standpoint, or if you're a retail investor, what's your argument?
It's a very interesting point, because if you look at our start of our journey, we come into it as a deep value investor in CoinShare with our CoinShare eyes. So we started buying Bitcoin in 2013, seeing how it will transform and how a shock on the demand side will have an immediate effect on the price, because the offer is constrained by code, constrained by law. It's 21 million, nothing else. And for us, it was a very appealing process. I think that the narrative got lost a little bit in the meantime because of the speculation happening around crypto. And we can see now that the stats on-chain and also off-chain are showing that people are starting to hold to their Bitcoin and not letting them go. There is a CoinShare research which came out this week where we can see that the amount of Bitcoin held on-chain for 1 year, not moving, 2 years, 3 years, 4 years, up to 5 years, are now at an all-time high. So people are starting to realize and go back to the real principle of Bitcoin, for instance. It was a reserve, kind of a reserve of value, a way of storing value for them for long term, and not kind of just like a trading asset. So it's a very interesting part for portfolio allocation strategy. And in our CoinShare model, we want people to be able to come to us, say, okay, we want to allocate beta with you. And if you want to go beyond beta, you go to our hedge fund division and have either an overlay or a complete alpha strategy.
What was it like setting up the business here? I spoke to Chris Larson 3 weeks ago, the Ripple co-founder, who, you know, he is one of the biggest advocates for the underlying blockchain technology, has his own token. But he told me that basically the Fed, raw government, and the Fed and the Biden administration have killed the prospects through regulation in this country.
So, you know, CoinShare have a presence in the US since 2017. We have a broker-dealer in the US since 2018. We have grown up this broker-dealer so they can distribute our product, which are effectively offshore products, so they are available for onshore investors. So the capacity to do it is very available in the US. It has to be done properly, done with the right people and in the right manner. And if you just go on this journey and accept to go on the journey and not say, we're just going to do it the way we want, then there is a kind of a clear roadmap you can follow.
Can you tell us, on your journey, you're out here marketing, I'm sure.
I'm not marketing.
You're out here having discussions about the offering that you're going to be attracting investors towards.
Of course.
And therefore, who are you speaking to?
I think the people who are interested in this kind of offering, you know, nothing we're doing here is for retail. It's all accredited investors, qualified buyer, and more sophisticated investors. And you can see like an interest going from, you know, RIA at the bottom of the stack up to very sophisticated asset management company who are looking for sleeve of diversification, because it's not very easy when you are a multi-billion-dollar hedge fund to just create a pocket of liquidity just for that. So it's like, how do I find the right partner to be able to grow and allocate?
Jean-Marie, great to have some time with you on your journeys across America. I have a feeling you'll be back a few more times. Jean-Marie Wagnetti is CoinShare's CEO. Meanwhile, we did have a little bit of breaking news, and we just want to get you ahead of what's happening next week. We understand that, well, the FTC is poised to sue Amazon for antitrust violations as soon as next week. There had been a report by Politico this could come as soon as Tuesday. So keep a close eye on, of course, the ongoing regulatory environment with which some of these big tech companies find themselves within.
Yeah, and I think Bloomberg's now reporting that the FTC is going to do this next week. And remember, this is going after the online retail part of the business, the most sort of consumer-facing bit. And our colleague Leah Nyland, I think she reported in the first week of September. So we thought this would come, but yeah.
Specifics.
Right, coming up here on Bloomberg Technology, we're going to talk about the future of climate tech and how AI can impact that sector, its potential, but also possible drawbacks. Ananda Impact Ventures' Zoe Pedden joins us next. This is Bloomberg Technology.
I know one of the reasons you're here in Marrakesh and in Africa because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on, dinosaur era fossil deposits of oil, coal, and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
You need to have a dialogue with countries like China. They're not going to go away. And there may be things that we can work together with China on. But, we have to be very realistic and we have to have those discussions with our eyes open. What we're trying to see is if we can get a global consensus on how to make sure that artificial intelligence remains a massive force for good in the world, which I truly believe it can be.
That was UK Chancellor of the Exchequer Jeremy Hunt there. And as world leaders gathered at the UN General Assembly in New York City this week, everyone seemed to agree on one thing. Climate change is among the biggest problems facing the planet. Maybe that's where AI could be a force for good. On today's VC Spotlight, we're taking a look at climate tech investing, the impact of AI on that sector, and much more with Ananda Impact Ventures, a European VC firm with $213 million under management. They're investing in startups with scalable missions for the planet's future. Let's bring in Ananda partner Zoe Pedden for more. And Zoe, these meetings, these big, high-profile, week-long, let's talk about the world kind of events, as somebody who invests in the early stage, do you see a trickle-down of benefit from something like that?
I think it's good to put the topic on the world stage. The media, like yourself, are picking it up and talking about it, and it really helps the startups who are already working in it to get some momentum and get people talking about certain sectors that perhaps haven't received such media exposure. There's been a lot of focus on carbon and carbon accounting, but what about biodiversity? What about nature? This is being put on the radar now. So I think it's important that we do have these meetings at this global stage.
What's interesting is we just heard from Jeremy Hunt. Meanwhile, his leader, the Prime Minister of the UK, is getting a lot of heat for basically putting climate goals to one side. And I'm interested in your perspective of the politicization of the space in which you work. I mean, certainly that's here in the United States as well. Has there been as much interest in backing funds that want to invest in climate startups?
I mean, I was looking at PitchBook the other day, and it reported that in Q1 2023, climate tech startups raised $5.7 billion. So 279 VC deals, which is a 36% decline in deal value and 31% decline in deal count from the previous quarter. But that's a lag indicator for me, because when I'm out there and I see when we're raising, our fund, and I meet people who want to invest in Ananda, I don't see this hesitation. I just see more and more money coming from many different areas coming into climate. So I think the dip in climate investing of that last quarter is just a general reflection of the dip in VC funding overall and not an indicator of where things are going.
So let's talk about how you stand out from the crowd. At one point, it felt like a very busy crowd. But what's interesting about Ananda is you sort of put your money where your mouth is and you don't take fees unless
Well, the companies which you're backing are saying what they're going to do, and you're holding yourself to some sort of transparency account here. Is that something that's being copied by the rest of the industry?
It's increasingly being copied, and we wanted that. It's called our impact carry model. We created it back in 2014 alongside the European Investment Fund, so it's a co-creation where the carry is linked to the impact. So we have impact KPIs, and we need to meet at least 60% of those targets from those predictions from those startups to be able to see any carry at all. So it means you really values align, and the founders really like it, and of course our investors do. I think it's really important that we have something like this around accountability and governance in impact investing to stop impact washing, which, you've got greenwashing, you've also got impact washing.
Zoe, what is the AI climate play for a venture capitalist like you?
Oh, there's lots of different things. I think the biggest area is in machine learning. That's what we've seen for the last few years. So going from looking at computer vision that's tracking had thermal cameras with nano satellites, being able to detect and look at prevention of wildfire, massive area, and then down to being able to predict in wastewater. Wastewater surveillance is a big new area in climate tech, and pathogens. So being able to start to track different pathogens like the COVID virus, which is viral, but actual bacterial ones, and being able to predict which areas might not respond to antibiotics. So antibiotic resistance is massive. So that's when you start to see the environment cross over into population health, and then regenerative ag. What else? Lots of things going on in ocean tech. Very difficult area at the moment. And biodiversity, nature, as I was referring to before. A wonderful, wonderful new area, much more tangible to talk about than carbon. And I think there's a lot we can do around being able to track nature using environmental DNA on the ground, and being able to predict and what species have been removed, either through infrastructure or mining or something in the water, anything that's being dug up, and replacing that and making it better than it was before, because those little microbes, so it's not the big species that you think about, big animals, it's actually the microbes in the water. They leave trails of pieces of DNA, and we can detect all of those, and they're the ones that when you talk about our food and our soil systems, they're absolutely essential for the balance that we have in nature, and those are the ones that are suffering.
And Under Impact Ventures partner Zoe Pedden, thanks for spending some time with us, really talking us through some of the opportunities there. Meanwhile, we're going to focus on climate impact a little bit more, with some hundreds of millions being spelt in that particular direction. Eldridge, Brightstar, and the Clario Group have signed an agreement to acquire a majority stake in Osenco. Now, it's a global provider of engineering consulting services to the minerals, the metals industries, and indeed to energy transition, such as designing efficient mines, metal extraction facilities, or delivering sustainable mine waste or water management. Basically, this is a billionaire, of course, Todd Boehly, getting involved. He is known for Major League Baseball investments, and among others, and of course, Marcelo Clary partnering up. Meanwhile, coming up, we're going to be continuing the conversation on sustainability. Global Citizen's going to be in the house. There's a music festival here in New York.
It's like Live Aid in the social media era.
Yeah.
Is that fair?
True. And how are they using social media? This is Bloomberg Technology.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States, and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
So it's the Global Citizen Festival. It's become the world's longest-running global campaign calling for an end to extreme poverty ever since its first installment here in New York City in 2012. Now, for this iteration, 3 million actions have been taken by global citizens via its app to ask global leaders to defend the planet, to defeat poverty, to fight for equity. Now, as we gear up for 2023 Global Citizen Festival taking place tomorrow, let's bring in Michael Sheldrick. He's Chief Policy Impact and Government Relations Officer over at Global Citizen. And we're going to put the weather to one side because it might be a little drizzly, but ultimately you're fighting because of weather elements, because of the climate, because of poverty. And what's so interesting about Global Citizen, you were born in an iteration where people used to perhaps tweet, or they'd write letters, or they'd send emails. How have you used social media to now bring your force to bear?
Well, thank you for having me on. And the first thing I will just say, if anyone's coming tomorrow, the Global Citizen Festival continues, rain, shine, hail, doesn't matter, everyone will be there. And you're absolutely right, around the world, extreme weather events are impacting the most vulnerable communities. But the way to think about the Global Citizen platform is, yes, people know us for our festivals, but inherently we're a digital platform. And we campaign 365 days a year. People engage with our content, and we're always finding ways, novel ways to meet people where they're at. So we're on TikTok, we're on Instagram, we're finding ways to engage people who may not even have access to Wi-Fi in developing countries as well. And what we're seeing is record levels of engagement. Even as social media becomes more fragmented, we're actually seeing our citizens looking for a way to express their agency, to take action, such as calling on the UK government to follow through on its commitments around climate financing.
So where does Rishi Sunak, who at the moment perhaps is getting a lot of criticism for not really focusing on the climate agenda, how do you tackle him? Where are your citizens going to? How do you present your case to Rishi that he should care?
So we have global citizens in every single constituency across the United Kingdom, for instance. And what we see, and this is mirrored around the world, is 2/3 of people around the world are saying that they favor clean power, particularly solar energy, over fossil fuels, right? So we're actually seeing, if you look at where people are at, it's an entirely centrist message. And we believe that the UK government, especially with the Prime Minister's remarks over the last few days, is on the wrong side of history. And global citizens have been calling them out. They've been contacting their local member of parliament. And we're also calling on the Labour opposition, Sir Keir Starmer, if he's elected Prime Minister, to stand up and not backtrack, because you need Britain. Britain has been a leader on climate change. And through our digital platform, it's a way for citizens not just to whine and complain about these issues.
We're good at that online.
I know. But we can take action. We can actually do something. And the data shows when you do something, that also gives us hope as well.
You know, Michael, in the last segment, I was saying this is like Live Aid, but in the social media era. We talk so much on the show, Carrie, don't we, about the health of social media platforms right now, knowing that what stands out is authentic, legitimate, How do you feel about that? Do you feel that you are able to get a direct message out through the content that you're sharing?
So Live Aid, Bono, Bob Geldof, we always say we stand on the shoulders of giants, but our evolution, we see action as our currency. So rather than selling tickets, we could make a few $1 million, or we can give people a way to take action. And people can take action on our platform, and in taking action, they accrue points. And as we'll see tomorrow at the Global Citizen Festival, they can exchange those points for rewards like tickets as well. But we see people, they like to be rewarded for their action taken, but they also like to engage throughout the year as well. So
obviously you employ, well, you don't employ, but you stand on the shoulders of celebrities to get your message across. How do you navigate the politicization of these social media outlets? How do you decide, we're going to remain on Twitter, now X, even though there seems to be a blow up around now who owns it, or indeed the direction of travel of TikTok?
So I think, a really interesting example is Jungkook, right, of BTS fame. They're citizens, and you can see the engagement going on. To be honest, they don't really care which platform. I think what you see, whether it's on Instagram or you see it on Twitter, you see record numbers of engagement in the issues. And when Jungkook shares something about the issues on all of his platforms, you see people not just engaging with their content, but also coming back to the platform to take action. And I think for them, it's not about being political. It's not about being left or right. Often the sentiment is around the issues. And I think what they see is they trust many of these influencers. They trust these artists. And so I think what they're seeing is the artists being trustful custodians of the message.
Michael Sheldrick bringing your message today. We thank you, Chief Policy Impact and Government Relations Officer at Global Citizen. Keep an eye on that rainfall. But it happens rain or shine, apparently. Now that does it for this edition of Bloomberg Technology and Ed. I can't get my words out because you're about to leave.
I know. I'm going to go back to San Francisco, but it's been good to be in New York. Recap the show. We love that you guys are listening to the podcast. Apple, Spotify, iHeart, wherever you get your podcast. Long week in New York City. What a week to be in New York City.
The listings, the pops, the fact that we're going to be analyzing how that continues to evolve next week. From New York.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just
just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, Powell's higher for longer message at Wednesday's meeting sends yields soaring to the highest levels in over a decade and prompts fresh default fears as borrowing costs rise. We begin with the big issue: how high and for how long?
The Fed made it pretty clear that
the rates will be higher for longer.
Higher for longer.
Higher for a little longer.
Higher for longer.
This was a very hawkish pause.
potentially one more rate hike coming.
The market is pretty much pricing in the Fed scenario.
They basically think a soft landing is more likely.
They're baking in the soft landing, right? But they're saying GDP is still going to be sluggish.
In terms of the forecast, there are some real questions that need to be answered.
We all have forecasts, and most likely they're all wrong.
Probably raise in November.
We don't have the Fed taking any steps of action until March of 2024.
I think the Fed will cut rates even if the inflation rate doesn't get to their 2% target.
Through 2024, I think there's real scope for rate cuts to seriously overwhelm market expectations and for yields to push much lower.
The Fed wants to be cautious about when they start to cut.
Take the Fed's message with a fair bit of skepticism.
There's still a lot of uncertainty.
Joining us now, I'm thrilled to say we have Jay Barry, co-head of U.S. rate strategy at J.P. Morgan, and Morgan Stanley Global Director of Fixed Income Research, Vishy Tirupattur. And Jay, I'll start with you because it feels like the conversation has really shifted over whether or not they're going to go again to how long this Federal Reserve could stay on hold. After what we heard from Jerome Powell this week, how long do you think that we're going to stay at that eventual terminal rate?
Sure, Katie, and thanks for having me this afternoon. So it's been our view at J.P. Morgan that we think that the Fed is likely done tightening here, and that's been our view for some time. And certainly the risk is to one more hike, but we think once they're on hold, they're likely on hold for the next year or so. And we don't actually envision the Fed lowering rates until the third quarter of 2024. And certainly we do see growth decelerating from here after strongly above trend growth to start the year through the middle of the year. But against the backdrop of an economy that's likely to move below trend into next year, but inflation that should remain elevated, we think the Fed's on hold for an extended period. Although it's unlikely the market's going to get this clear, I think for at least a few months, because with the dots still indicating one more hike is likely, we do think it's going to take the data panning out over the next few months to really get certain about this.
Well, Jay, how much stock do you put into the idea that, okay, we could see the Fed cut, not because we're heading into a downturn or because a recession arrives, but just because they want to get back to more neutral territory?
I think it's our view here, Katie, that as inflation eases over the course of the next year, real policy rates will be getting more restrictive. So at some point when the Fed is comfortable that inflation is getting back closer to its target, it will leave room to ease, if anything, to kind of prevent rates from becoming more restrictive, then to getting closer back to neutral. We actually think that the pathway back to neutral is going to be relatively slow, because even though we see growth slowing, it's hard for us to pick out some sort of nonlinearity here amongst consumers or corporates or even state and local governments to make you think that a bigger downturn is coming, at least with what we know right now.
And Vishy, on that long, slow path back to neutral, where do you fall on the duration argument? Are you stepping out the curve here, or would you wait?
We are constructive on duration here. I think I agree with Jay that our view, research view, is also that the Fed is done here, and I fully acknowledge that the median dot plots has indicated another hike, but we think Fed is done here. I think the point of some disagreement with Jay for me would be that I think we are more optimistic on the deflationary process, perhaps compared to the market, and thus far how the PCE has unfolded is is very much in line with our expectation, and if this process continues to be the case, we think that there will be in conjunction with a slowing of the in the employment scenario as well. We think there will be a reasonable chance that end of Q1 we will see the Fed cutting, and once again, Fed cutting not to stimulate the economy, but beginning the process of gradually moving to a more normalized monetary policy path.
What gives you confidence in that path of deflation? Because, for example, you look over the past few weeks, you've seen energy prices rise very significantly. You're starting to see that filter through break-even rates, for example. When you look out over the next few months, over the next year, what makes you confident that we'll continue to see inflation come down?
A number of things. First, of course, the Fed thinks more in core PCE terms, and some of the more volatile energy prices will affect more of the headline inflation. But I think the more important thing is that we expect that the growth spurt that we saw in the third quarter comes from some of the one-off events, and we see considerable amount of economic headwinds to the market, facing the economy. We'll see clearly the UAW strike is going on, perhaps expanding a bit. There is a high likelihood of a government shutdown. The student loan payments come back into play. All of those things, in our mind, would mean that a meaningful slowing is ahead. And if you look at the median expectation from the dot plot from the Fed, to get to the 3.7% core PCE by the end of the year, between now and end of the year, we would need to see month over month inflation core PCE numbers average about 33 basis points. Our expectation is it's closer to 20 basis points. In fact, our number for the next data point is 14 basis points. So you need to see the progress that's been happening in core PCE has to be undone and revert into a very different trajectory, which something, given the economic environment, given all the economic clouds that are out there, we think that's we think pretty confident about our expectation about the deflationary process.
Well, Jay, Vishy brought up the government shutdown, potentially. And it's interesting, going through your research, you put out a note in the past few weeks saying that if you think about the setup now heading into this potential shutdown, unlike previous episodes, Fed policy is actually pretty tight. If we do see the government shut down, how might that play out?
Yeah, I think it's interesting, Katie, that in each of the last three big government shutdowns we've seen, in 95, 96, in 2013, and again in 2018-19, Treasury yields have trended lower. And you're right, it's because in each of those instances, the Fed was either easing or pivoting more dovish. Whereas right now, we're in an environment where the Fed is leaning towards potentially another hike and not necessarily wanting to sort of sell any optionality. So we think that the impact on Treasury yield is likely to be much more neutral this time around unless there's a real sharp shift in risk sentiment. And the thing that actually concerns us is there's an acute awareness and concern on fiscal right now, on spending and on Treasury supply. And to the extent that has manifested itself with an increase in term premium over the course of the last couple of months, and we even heard Chair Powell talk about that on Wednesday, that's something that may actually even pressure Treasury yields modestly higher if we have a shutdown, which seems like it's becoming increasingly likely.
And Vishy, weigh in on that, because as Jay walked out, again, we're looking at a pretty tight stance of monetary policy. You look at 10-year yields right now at 4.42%. If you think about the possibility of a shutdown, how much agita is that giving you?
I think it depends on, there is plenty of agita. But I think what really matters is what is how big is the shutdown? Is it a partial shutdown? How many departments do get shut down? And how long the shutdown lasts? If it is a matter of a couple of weeks, perhaps it's not going to be that material to the markets or to the overall economy. But the longer it lasts, obviously it's going to be worse. We also have an interesting, as a research analyst, there may be a situation, depending on which departments get shut down, we may run into the data releases that come out that may not be coming out. And we've seen that happen in the past. And in a world where the world is very data dependent on policy outcomes, not having data could actually add to that data haze, if you will.
So a lot to potentially get worried about. Speaking of agita, let's talk about the basis trade. Of course, we're talking about that small difference that we see in pricing between cash bonds and Treasury futures. Jay, we saw an interesting warning from the Bank of International Settlements this week saying that basically if you look at the leveraged buildup of short positions, it's big enough that it could cause financial vulnerability should we see some sort of margin spiral take place here. When you think about how big the basis trade has become and these risks there, are you as worried as the BIS is?
You know, Katie, over the medium term, I think the increase in these sorts of positions could bring with it a reason to be concerned about financial instability. But I think you sort of need a sort of lever or something to kind of pull in order for that to be a massive source of concern. But to me, the growth in the basis trade is pretty natural. And we've talked a lot about how with the Treasury market moving gradually away from price-insensitive investors like the Fed and U.S. commercial banks and the foreign community, that more price-sensitive investors need to sort of pick up the slack here. And with Treasury supply growing, it's levered investors that sort of need to pick up the slack. So with volumes increasing, a higher likelihood that the Fed is close to, if not done with its tightening cycle, leaving more room for relative value trading, it's not necessarily surprising to me that the basis trade's picked up. It seems like it's still smaller than it was in 2020, and the Treasury market's bigger. So I think it's something to watch, but not right now to be 100% concerned about.
Well, it's a good note to end it on. Really appreciate both of your time. That is Jay Barry. He is co-head of U.S. rate strategy over at JP Morgan, and Morgan Stanley Global Director of Fixed Income Research, Vishy Terapator. Thank you both. Have a great weekend. Now up next, the auction block, where there was a flurry of sales ahead of the Fed decision this week. That's next. This is Real Yield on Bloomberg.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Secretary Secretary of State, Senator, First Lady, with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where we had a quiet end to the week with 3 straight zero sales days for U.S. high-grade bonds. We did, though, have a flurry of action ahead of the Fed. There was $16 billion in sales for the week, highlighted by companies such as Hyundai and UBS. We also got strong demand for WorldPay's debt sale. The combined offerings drew about $20 billion of orders in a deal to fund the partial leverage buyout of the company. It's the largest LBO financing package since Twitter. And over in Europe, Bayer saw strong demand for its offering of new hybrid bonds. It follows the trend of recent hybrid offerings from companies like Volkswagen, which also saw a strong order book. Meanwhile, we caught up with Apollo's Torsten Slok about default risk.
Particularly in high yield, where default rates are now up to 4.3 in the data for August that just came out, that could continue for the next 6-9 months. And that's then going to open up a risk that if we begin to see the cost of capital bite harder and harder on companies every single day that cannot either get a new loan or refinance an existing loan, we begin to run the risk, of course, that we'll begin to see more companies defaulting.
Let's bring in now UBS Head of Credit Strategy, Matt Nish, and Winnie Cesar, Global Head of Strategy at Credit Sites. And Matt, I'll start with you, because when it comes to default risk, it feels like this boogeyman that we've been talking about forever that we haven't really seen materialize. But when you think about how high real rates are and how high Jerome Powell would like them to stay high and for how long, could we actually start to see a pickup here?
It's been really interesting. I think, tactically, we've gotten a little bit less bearish, and really it's because you've seen stabilization in some of those key metrics, which we think are the leading edge of default. So, 3 I would highlight. One is bankruptcy filings have seemed to stabilize, albeit at high levels. Middle market or private credit defaults for the second quarter actually moderated about 0.3%. And then leveraged loans obviously has been a big area of focus, certainly for us and for your viewers. And you've seen ratings migration stabilize in August and then September to date. So I think really it's a question of time horizon. In the short run, we're feeling a little bit more surprised, candidly, at the resilience of some of the default and stress metrics. I think longer term, though, as you allude to, the biggest risk, certainly after the Fed, is the potential for no landing, higher for longer. And certainly so you get more concerned when you go into 2024 about the potential scenarios for default rates in the U.S.
Well, Matt, it's refreshing to hear that you're feeling, a little less bearish. Winnie, when you look at the fundamentals of the corporate credit market, are you on the same page, or are you feeling a little bit more worried?
So I would say that we're actually feeling a little bit more worried, and I would caveat that with kind of the backstory that we were feeling quite good about 2023 in the corporate credit market. We started the year very constructively and have been just slowly ratcheting down our risk tolerance more toward a carry position. We do think that looking ahead, the headwinds in 2024 could start to grow quite considerably, especially if the Fed is on hold at this elevated level for an extended period of time, into the back half of the year. That's not our base case expectation. We actually think that the Fed will be able to start cutting a little bit sooner than the market is anticipating. But I think that that's because we do expect some deceleration in some of the sectors that have done really well, consumer discretionary, for the past 12 months, as the broader consumer starts to slow down a bit.
And it's interesting to hear you say that. I want to talk a little bit globally here, because when we think about, again, very high rates and how high they might stay, the point has been made many, many times that a lot of companies got ahead of this, that they've refinanced. And Matt, I want to bring this to you because we had an interesting conversation at Bloomberg's Global Credit Forum in London with Akshay Shah, of Kaima Capital, who made the point that if you have floating rate bank debt, that transition transition mechanism is pretty immediate. If you've got fixed rate debt, you're going to have to refinance your bonds. The European market has done a pretty poor job of refinancing out their maturities. And I want to get to floating rate debt, but Matt, when you think about the differences between US corporates and European corporates, do you agree with that sentiment?
I think it depends on how far you look out. So we think in general that liquidity, cash on balance sheets, and fundamentals are going to be resilient in Europe through the end of the year. I think as you look into that large 2025 type maturity wall, a lot of investors are certainly focused and more concerned as you look into next year. And we've shown about 120 billion odd in debt coming due for European high yield companies over the next several years. So I think the short answer is, again, it depends on time frame. In the short run, we're not overly concerned. Longer term, and with the ECB optically staying at close to 4%, it definitely is going to present some problems, but a lot of that is contingent on the economic environment.
And when we think about the other component of what Akshay was saying there, Winnie, it's interesting to hear the call on floating rate debt, because I take a look at ETFs all the time, and the products that track senior loans and the products that track CLOs in particular have seen many, many months of inflows. Is floating rate debt the way to go here versus fixed rate?
I would say looking ahead, we actually have a preference for fixed rate over floating rate. Floating has clearly been where you have wanted to position for most of 2023 and all of 2022 as well. But we do think that that is going to start to shift as we do see some of the refinancing needs and this elevated interest rate environment starting to really impede floating rate issuers. When we just look at the leveraged loan market, fundamentally, it's a bit lower quality than the high yield bond market is. And we think that going forward, the preference should be actually for fixed over floating.
Matt, is that your read as well, that really the juice is all out of that floating rate trade?
Yeah, a lot depends obviously on your economic outlook and your view on rates, but the short answer to your question is yes. We ultimately think there's a slowdown coming and a recession toward the end of the year. We think that spreads are tight. You have high grade spreads at about 120 basis points, high yield at 380 basis points. We think the right level for those is more like 135, 140 near term, and 450. But yields are harder to argue. The attractiveness of IG getting close now to the high 5% level or 6%. High yield now this week through yesterday, closer to 8.75%, in some cases 9%. The overall all-in yield picture is still, we think, more attractive. And we're seeing that in the flow data, and you're seeing buyers come in, most notably insurance companies in the US in the long duration or longer part of the IG curve.
And just to wrap that into your earlier point, that you've been surprised at the resilience of some of these corporates, are you willing to risk or go out for credit risk here?
We ultimately think that if you're looking for your viewer that has a total return or a typical bond fund, that the attractiveness of interest rates here offsets the risk of spread widening. So the short answer is, for somebody that in most cases owns a total return bond fund, we would look to go out the curve. We think the curve will flatten as the spread curve, as the interest rate curve steepens. And we're generally thinking that lower rates and lower US yields will largely offset, or I should say more than offset, any sort of spread widening here.
And Winnie, in 30 seconds, I'll give you the last word. Where are you feeling on the risk appetite spectrum?
I would say that we're feeling much more neutral. We have some parts of the market that we're favoring. We like a barbell strategy with front end and then 7 to 10 year investment grade bonds. We think the high yield BB market still looks very attractive from a risk reward perspective. And we still like high yield energy as well.
All right, guys, great place to end it there. Really appreciate both of your time. That is UBS Head of Credit Strategy, Matt Nish, and Winnie Cesar, Global Head of Strategy over at Credit Sites. Thank you. Still ahead, the final spread. The week ahead features a wide range of economic data. We'll get into it next. This is Real Yield on Bloomberg.
important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, we will have a slew of U.S. economic data ranging from durable goods to PCE to home sales to personal spending. Of course, we're also going to hear from central bank leaders such as Jay Powell and Christine Lagarde. But let's talk about those estimates for PCE. Of course, it's the Fed's preferred measure of inflation, and you're expected to see core drop as headline continues to heat up. That mirrors what we saw in CPI. Expected to see the same thing with PCE. And that divergence that we see between headline and core, maybe it'll grow if we continue to see energy prices continue to climb there. And what that means for the Federal Reserve, we'll see. But from New York, that does it for us. Same time, same place next week. This is Bloomberg Real Yield, and this is Bloomberg.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I'm John Roseman. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on the markets at this hour. We are seeing some gains on the major equity indexes, but not enough to offset the losses that we've had in terms of the superlatives. Even with these gains, we're looking at the worst week for stocks since March. You do see the 10-year yield coming down a bit, 7 basis points, but still at 442.36. The Bloomberg U.S. Dollar Index continues to climb right now, 1257 for the BBDXY, and NYMEX crude actually holding under $90 a barrel. It moved down below 90 yesterday, had popped back up today, but it's given up those gains, so trading right now, John, at 89.83.
All right, Matt, want to look at some individual corporate stories today. Just wanted to check in on Goldman Sachs. It's been down today. A small-sized settlement with tied to some inaccurate trade data that had been sent to the SEC over the period of a decade. We're also watching U.S. Steel. This Bloomberg scoop about this interesting development with the Canadian steelmaker Stelco possibly making a bid for U.S. Steel. Of course, they need a lot of muscle financially to do that, so there could be a partner that comes along with that. Anyway, U.S. Steel shares are up on that news today. And then, of course, Matt, we continue to watch what's happening with the automakers at this hour. And we are seeing the big three, as they're often described, moving in different directions. On the one hand, you've got Ford higher, you've got GM and Stellantis, which have been trending lower, which would feed into the story we've been talking about throughout the day, Matt, the fact that the strike has expanded, the walkout has expanded, but Ford arguably being spared just based on some of the encouraging contract talks that they've had with the UAW.
That's right. They're still striking the Bronco plant there in Michigan, where they also make the Ranger, but they're not expanding the strike, according to UA President at Ford, according to UAW President Sean Fain. He spoke earlier about the expansion at the other plants. Listen in.
We can and will go all out if our national leadership decides the companies aren't willing to move. Stellantis and GM in particular are going to need some serious pushing. All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike. We will be striking 38 locations across 20 states, across all 9 regions of the UAW.
Okay, well, let's bring in David Welch, Bloomberg's Detroit bureau chief, for some more perspective on how things have been playing out. David, what has been the reaction to the fact that you have more strategy from the head of the UAW here when it comes to this additional strike action, and as Matt and I were just talking about, the fact that Ford, for now, spared, at least in terms of more walkouts?
Yeah, look, Ford gave in on cost of living allowances. And what it sounds like, they didn't give us the exact formula, but it sounds like they have reinstated what was taken away in 2009. And what that does is it basically, in addition to the raise that Ford agreed to, which we're assuming is about 20%, they also get whatever inflation is, they get that built into the raise. Almost like, so inflation's 1.5% next year, the workers would get that on top of their raise. What GM has wanted to do, and this is the fundamental disagreement and probably why they've got 30 parts plants going on strike, GM believes the way to handle inflation for workers is just give them income protection, give them a big raise, and then on top of that, if inflation is high, they would protect the workers with maybe lump sum payments or some kind of formula that gives them money if inflation is, in excess. And the workers don't want that; they want both. And I think that's what one of the big fights is over right now. The other is how they handle temporary workers. That's been a fight all along. And it just sounds like GM and Stellantis aren't there where the union wants them. And Ford, I wouldn't say they have a deal in hand, but they're probably in striking distance.
David, there's an interesting balancing act here for the administration, right? On the one hand, President Biden claims to be incredibly pro-union. On the other hand, he's trying to push through this green transition for which the federal government has already given out billions of dollars in subsidies. And I think Ford is interesting because they seemed very committed. They seem very committed to battery electric vehicles, and yet they seem to be swinging back towards hybrids a little bit. How's that balancing act work out, and what does the UAW want to see?
So I think Ford has seen that they think that the growth in EVs is slowing a bit, that there are some early adopters, luxury buyers who definitely wanted them and like the vehicles, but they think, they're seeing a lot of growth in hybrid sales, so they're going in that direction. That kind of is what the union wants to see. Sean Fain has said that they support the transition to green vehicles, but they want to make sure the workers who work in engine and transmission plants are protected. And if, look, we get into this interim hybrid era that lasts longer and puts off the day when EVs are the majority of vehicles, that means engines and transmission jobs will be more secure for a while. But eventually one day, they'll be going away, and the union wants to make sure that anyone who works in a battery plant gets the same kind of pay that an engine and transmission worker would have gotten paid. That's really the rub there. So that's why the union has been so adamant about job security gains in this contract. They want a product in every plant that exists right now. That product means that for the life of the agreement, those workers will be employed.
All right, excellent to get an overview from you. David Welch is the Detroit bureau chief and covering, no doubt, this strike 24/7 from Motown. Here to discuss further is Cornell University Director of Labor Education researcher Kate Bronfenbrenner. And Kate, you explained something to me last time, which I thought was very interesting. David kind of touched on it there. We talk about the wages issue a lot. We talk about the pension demands as well as the shorter work week. But they also want to get rid of this tiered system. Are they getting anywhere on that? Because that's one of the pieces that we don't really hear about very often.
The companies have moved on that issue, but not as far enough for the unions. That for the union, it's a huge issue for the rank and file members. This idea of not working next to someone doing the same job or a similar job for much less pay. And this is, they don't want workers in components to be making different pay than workers in the other parts of the plant. They don't want to have workers that were hired later, not having the same pension and health care benefits. And they believe this very strongly because it hurts morale, it hurts productivity, and it hurts union solidarity to have workers being paid different amounts of money working side by side.
And Kate, I'll ask you what we were asking David, just the fact that as we saw this expansion play out today, the fact that you have what began as a somewhat different approach by the UAW to not have a target automaker, but to be talking with all of them. I guess, should we be surprised to see the expansion of the strike itself in many ways be pitting different automakers against each other?
The union is running a very smart strategy, and probably the key element is that the companies don't know what is going to happen next. So they can't prepare and say, okay, we're going to get striker replacements in this place or in that place. They don't know what the union's going to target. The union is rewarding Ford for moving, and they're saying to Stellantis and GM, if you don't move, we're going to keep pushing you harder. And we've expanded to 38 different sites today. And not only that, the places they've expanded to are parts production facilities, which get the consumers much more engaged, because if consumers can't get parts, they're going to be blaming the company and pushing the company to settle. But they also, GM and Stellantis don't know what's happening next, and Ford knows that if they don't keep moving, the union's going to hit them as well.
Kate, how do you balance concerns about labor, and the organizational impact that they have in terms of raising wages and improving the quality of life for all their workers, and the climate? Because right now it seems the two are at odds, right? In terms of the green transition and, these workers being able to earn a living wage and have some kind of job security.
we have to, we have to deal with the climate crisis. There's no question that has to be done. And I don't think the auto workers are saying they don't want the country to deal with it, but they don't want it to be at their expense. They want to make sure that, and not just at their expense, but the workers who are in the new green economy, they don't want them to have bad jobs with no benefits and lower pay. And if the EV sector ends up being a poor paid job with fewer benefits, it's going to undercut all the workers that are not in that sector and undermine the union. So they want to make sure the transition happens in a way where workers are fairly compensated, workers are protected from health and safety issues, which are one of the big things with the electronic vehicles. It's a new industry, new health and safety questions because the batteries are so volatile. They want to make sure the jobs are safe, are compensated well, and it's done fairly.
All right. Great to get some more context from you. Really appreciate your time again. Cornell University Director of Labor Education Research, Kate Bronfenbrenner. Now, coming up, negotiations resume for the other strike that we're following. We'll have the latest for you on the Hollywood strike, which may be nearing an end. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We have an aberration in our country right now, but nonetheless, we still have to strive for unity. Sometimes you achieve it, sometimes you don't, but we have a responsibility to act in a bipartisan, unifying, transparent, accountable way.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Let's get to our stock of the hour. Media names Warner Brothers, Discovery, and Paramount Global have been slumping as shareholders try to assess the strike talks in Hollywood, while the Studios and Writers Guild have been in their most significant round of discussions since writers walked off the job nearly 5 months ago, trying to make the right bet on when a deal might ultimately be in place. Matt, that has been a tough one so far for investors.
Yeah, absolutely. I mean, I think even difficult for actors, guild, leadership and studio leadership as well. It's not been an easy thing to forecast when this will come to an end. We still don't know. Bloomberg Intelligence media analyst Geetha Ranganathan joins us now. Geetha, what's the lay of the land in terms of both the writers' strike and the actors' strike?
Yeah, so this is really a unique time in the industry, Matt and John. I mean, you have this dual strikes happening in Hollywood right now. Obviously, it's good news that they're back at the table, but the longer and longer these strikes drag on, it's obviously bad for everybody. I mean, whether it's the writers, whether it's the actors, and definitely the media companies. So, we've seen some companies like a Warner Brothers Discovery actually take down their earnings expectations for this year. They reduced it by about 500 million because they said, not having fresh content is basically going to affect advertising. And as these strikes kind of drag on into, possibly into 2024, that could become a real problem for their bottom lines.
At the same time, Geetha, you and the Bloomberg Intelligence team put together some data on what the free cash flow picture looks like in light of the strike and how long this has been playing out. What did you net out there?
Yeah, so funnily enough, because there is no production happening right now, John, obviously there are no huge cash content costs that these media companies have to pay out. So they've all actually kind of taken up their cash, or rather their cash flow projections for this year. So we know Netflix, they had initially projected about $3.5 billion. They took it up by almost 40% to $5 billion. So did Warner Brothers Discovery. Disney actually reduced its cash content budget from about $30 billion to $27 billion. So in the short term, yes, it kind of artificially boosts cash flow. But again, over the longer term, again, cash flow is going to be pretty lumpy next year. And this is really not a good situation from an earnings perspective and long-term earnings growth.
What is the bottom line for the streamers? The head of the Actors Union told Paul Sweeney in an interview I was listening to on Bloomberg Radio that she thinks the streamers make $30 billion a year in pure profit. Is that business model such a strong one?
Unfortunately, it is not. Yes, they do generate some revenue, but it is not translating into the bottom line at all. In fact, at this point of time, the only company that is profitable is Netflix, and they will generate about $6.5 billion in profits this year. All the other streamers, including the mighty Disney, the Paramounts, the Warner Brothers Discoveries of the world, they are all losing tons and tons of money. They are going to lose a combined $9 billion, this year. So no, streaming still has to kind of really establish itself in terms of generating long-term profits, and so that's kind of one of the reasons why they are so reluctant to kind of consent to all that the writers are asking.
All right, Geetha, thanks for breaking down the Hollywood math. Obviously, we've got to see where this goes from here. Geetha Ranganathan from the Bloomberg Intelligence team. Coming up, the company building a solar-powered cobalt plant that could create 1 million electric vehicle batteries per year. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From New York City, in London, in Sydney, from Washington, in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. The UAW strike is being politicized in Washington as a concern over the Biden administration's aggressive clean energy spending. Here's what Mike Pence told Bloomberg last week.
What I'm hearing around the country is that auto workers are very concerned about Joe Biden's Green New Deal, heavy-handed effort to use taxpayer dollars to drive these automotive companies into electric vehicle production. I mean, you got 145,000 workers out there many of them built a lifetime making gasoline-powered cars.
Well, our next guest's company is about to build America's first solar-powered cobalt sulfate processing plant, as roughly 80% of critical minerals needed for EV batteries are sourced from China. Let's bring in Evolution Energy CEO Navaid Alam. And it's nice to have you with us, Navaid. You know, the fact that not only you're building a solar-powered fueled facility, but one that is part of one of the key components to making electric vehicle batteries, I would imagine it's the kind of story in this environment, the green transition, that's gotten a lot of attention. What would you say about sort of the government support you've received from this this big push you're making?
Thank you. I think, the government support really helps us, but we were going to do this project anyway, even without the government support. We've been planning on doing this for over 4 years. And that was well before the Inflation Reduction Act and the bipartisan infrastructure law came into effect. You've got $90 a barrel crude oil right now, and that is the main driver for EV uptake, right? I mean, if people can't afford to fill up their gas tanks, they're going to switch to electric vehicles.
Yeah, I mean, to me, the interesting story isn't how the green transition will be used as a piñata by the Republican presidential candidates, but the interesting story is we need to move some of this production to America because, all of the cobalt or the lion's share of it comes from the Congo and then goes to China where it's processed. And anybody building batteries, whether it's the Germans or the Chinese or the Americans, they all have to buy that processed cobalt from the Chinese. So this is going to be, as far as I understand it, the first cobalt processing factory in North America. Are we going to start seeing real volume come and when?
Yes, absolutely. You're right on, Matt. It is, as you said, there's no cobalt mined in China, and yet they have 30 processing facilities, while we here in the United States and Canada have 0. So it's important that we, bring this material directly from Africa to the United States, and then we process it here and sell it into the new factories that have been announced in Canada and the United States by General Motors, by LG, by Umicore, by Ford, by Samsung. I mean, there's hundreds of billions of dollars being spent on the EV transition to bring in these new factories, hire U.S. workers, give them good wages, give them new training on the technology of the future.
And I mean, I know that the Yuma County in Arizona estimated this is going to generate $330 million for the local economy. That's not, that's not what you're paying your workers. That's what it's going to create around there. I imagine that's the kind of thing that even the Republicans want, right, to generate more money for Americans. Are you going to be able to get preferred status when, Ford and General Motors or Tesla are looking to buy cobalt? Are they going to buy it from you instead of buying it from the Chinese?
Well, we hope so. That is a good benefit from the Inflation Reduction Act, that we should be able to be a preferred supplier because we are qualified under the act and we aren't using any materials from China. So that should work in our favor for sure. We're helping the local community in Yuma. We're solar powered, so we're selling back some of our excess solar power at cost to the local farmers who have been losing hydropower from the lower levels on the Colorado River. So it's a win-win all around.
And Matt was talking about Tesla. Am I correct in that you, in terms of the location where this plant will be based, is close enough to California that you think that I guess that first generation of electric vehicles, or I guess the demand for new batteries, that being physically there is a beneficial or a net benefit to your business?
Yes, I mean, in the long run, we intend to recycle electric vehicle batteries. So being here right on the border of California will help us get, the first generation of EVs that have run through their life cycle. We'll be able to get those batteries to recycle that cobalt. We're also planning on building a cobalt metal strategic reserve for the U.S. government. The administration has identified cobalt as a critical material that is used in hypersonic missiles and stealth bombers. And with the world today, we really need to have this type of material onshore.
All right. I think it's a really interesting story, and we'll have you back on when you build this plant. Navaid, thanks so much for coming on the program. Evolution Energy CEO Navaid Alam talking to us about his new cobalt processing plant in Yuma, Arizona. We are looking at very slight gains here, John, and even if we finish a little bit deeper in the green today, we still are looking at the worst week for equities since March. So at least you see, I guess, the yields coming back down from 450. They're at 442.36, and crude under $90 a barrel. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Markets struggling to regain their composure after the Fed dashes those cut rate dreams. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you down to the closing bell here in the U.S. We're looking at green, but just barely. If you take a look at the S&P 500, up less than 0.1%. We'll see how the next 2 hours go. Big tech faring a little bit better. You can see the NASDAQ 100 up by about 0.4%, helped by what we're seeing in the bond space. You're looking at 10-year Treasury yields. They got as high as 450 overnight, but their yields are actually falling right now, down about 7 basis points or so. And I wanted to highlight dollar yen. Of course, we had the Bank of Japan overnight remain dovish, didn't do much, and as a result, you're seeing the dollar strengthen against the yen, that pair up by about 0.5%.
Yeah, interesting to see stocks coming off the highs of the day. Big tech has actually gotten a bit of a reprieve here, coming off what was the worst 3-day sell-off in almost 2 months for that sector. They're at the respite that we're seeing for small cap stocks, not actually seeing it all. Somewhat negligible here with the Russell 2000, relatively unchanged on the day as it heads for what's going to be a third weekly decline and a third month of underperformance relative to the S&P and NASDAQ. The Russell well below its August lows and not far off from that year-to-date nadir set back in May. Matt Maley over at Miller Tabak, he noted this in an interview, saying that when you factor in the moving average convergence divergence indicator, the MACD, that's now in negative territory, which means that bout of weakness that we're seeing for small caps, it might actually continue. A counterpoint, though, is the folks over at Bloomberg Intelligence say Russell 2000 and their fair value model suggests the index could rebound if, and I do mean if, the Fed can stick that soft landing. Of course, the latest Bank of America note out on fund flows actually shows most bets right now for that soft landing aren't so soft. In fact, most people planning for a potential hard landing. In the week through Wednesday, investors pulled almost $17 billion from global equity funds, the most since December. Michael Hartnett saying the higher for longer on interest rates means, quote, pops and busts in the financial markets. Hartnett says you're already seeing those tails starting to appear, including a steepening yield curve, a rise in the unemployment rate, and higher defaults and delinquencies. He says pay close attention to the reaction in this year's stock market leaders once bond yields start to drop significantly. If those lower yields spark a rally in home builders and chip makers, then it's bull 5,000 again. But if they can't generate those gains, it's back down to what he says is, quote, bear 4,000. For now, Treasury market volatility as measured by the ICE Bank of America Move Index remains subdued, at least relative to the peaks we saw in March. But the uncertainty, Katie, about the Fed's trajectory, about the potential for a gray swan event, if you will, with that big government shutdown everyone's talking about, means that volatility could pick up.
And what's interesting about this period leading up to a potential government shutdown is that yields are very, very high right now. You look across maturities, we're well above 4%. The 10-year in particular getting above 4.5%. You take a look at that purple line, of course, that is your 2-year yield above 5%. We have not seen that in quite some time. So that's the setup heading into what could be a government shutdown. And if we take a look at past periods, Romaine, you had mentioned the fact that right now you have seen bond volatility come down. You can see we spiked and then we're coming a little bit down. But if you take a look at past shutdowns, these red lines here, we tend to see a little bit of a jump. Again, when you think about where we are when it comes to Fed policy being very restrictive and this big sell-off that we've seen, particularly in the long end of the curve, it could lend itself to some fireworks, if you will.
All right, let's get some insights out of Michael Pond, head of global inflation market strategy at Barclays, joining us right now to help us kick off to the close here. And let's push ahead, Michael, I think, to the next couple of weeks here. We kind of forget about that government shutdown, and I've heard from a lot of folks here saying that if we do actually reach that precipice in a material way and go beyond it, we could see a material pickup in volatility in the bond market.
I think that's right. Next week might be a bit of a quieter week. We have some more minor data focused on housing, although at the end of the week we do have that core PC number, which is quite important for the Fed. But then we lead into October 1st. And October 1st, we could have a government that shut down, and that will likely lead to some heightened uncertainty. Usually what happens is government shutdowns. We get furloughed government employees. They all come back when the government opens, and they get their back pay in their hands. So, it often costs the government money because we're losing that workforce, but then we pay them anyway. But so if we do reopen relatively soon, the economic impact and hence the impact on the markets will likely be fairly limited.
Right.
But again, there's concern that this could go longer than others.
Well, let's talk about what happens if it goes longer, because in addition to just the economic and financial implications, there's also this issue here that the government agencies effectively stop putting out much of the data that this data-dependent Fed is dependent on, and for that matter, the market is dependent on as well.
Right. A big difference between the shutdown that happened in December 2018 and January 2019, which lasted 35 days. So that was a pretty long shutdown in historical standards. But the Department of Labor, and hence the BLS, sits within that, was already fully funded through the end of September 19. So the Department of Labor and data that we were getting over that shutdown was not affected. This time, there could be a greater concern. With some of the market numbers, particularly CPI, which is important to the TIPS market, while the Treasury does have a backup plan of what happens, again, it just creates uncertainty and hence volatility. But even going into the Fed meeting in early November, if we don't have enough data in hand, the Fed may hold themselves back on making a major decision.
And Michael, before we get to a potential government shutdown, we have to get through the PCE numbers that we're getting next week. And similar to what we saw with CPI, you're expected to see core continue to cool. You're expected to see the headline figure pick up a little bit. Let's say that energy prices keep rising. Let's say that divergence between headline and core continues to grow. What does that mean for the Fed?
Historically, the Fed has dismissed food and energy prices as simply due to volatility and not something they should react to though. During the pandemic, Chair Powell was indeed focused on food and energy prices, so headline CPI and PCE, because he was particularly worried about losing faith with consumers through inflation expectations. He wanted to make sure that inflation expectations remain anchored, and oftentimes consumer inflation expectations are driven in large part by food and energy prices. And so if energy starts to ramp up, that affects consumer expectations, and the Fed may feel that they're starting to lose grip again. But for now, we think that they'll just look through the energy price moves that we've already seen that will be reflected in next Friday's data.
And it's a point that I think about a lot, that you said, that of course, when you think about food and energy, the Fed likes to poo-poo that, but it obviously matters to consumers and their inflation expectations. If you take a look at market-based measures of inflation expectations, I'm taking a look at 2-year break-evens right now, we really haven't seen that much of a bump up. Are you surprised by that? Would you have thought that this big upswing that we've seen over the past few weeks, particularly in oil, would have translated more directly into the bond market?
Now, whether we look at the 2-year, the 5-year, the 10-year, the 30-year, the market, especially in forward space, is basically priced for Fed perfection when it comes to its 2% PC target. And as a baseline, we think that's relatively reasonable. Again, for the Fed to get it right over time, sure, that's a good baseline. But we think the risks are significantly to the upside, and we do think that, just as you noted, that we do think that break-even should respond more strongly to these structural risks in the economy, as well as the near-term oil move. We did get a decent bounce in very front-end break-evens from the oil move, but it really hasn't filtered through into forwards further out the curve.
Michael, always great to catch up with you. Michael Pond there, head of global inflation market strategy over at Barclays, to help us kick us off to the close here on this Friday afternoon, with a close eye right now on what's going on with that United Auto Workers strike. They're now saying that they will expand their strikes against GM and Stellantis. We're going to get you an update on that and tell you why Ford is not part of that expansion, Katie.
Plus, we'll get insight on consumer demand for skincare products from Heather Wallace, the CEO of Curology.
And one of the strongest pockets of the market today is in the emerging market equities. We're going to get the outlook for EM with Christine Philpotts, who launched 2 new funds this year over at Ariel Investments. That conversation coming up in a bit. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
All right, as the dust settles on more than a dozen central bank rate decisions around the world this week, emerging market stocks are trying to regain some of that lost ground today, but they still look set to end the week in the red. Longer term, though, there's an opportunity there for returns. Driving that and driving the strategy right now over at Ariel Investments is Christine Philpotts. She's a portfolio manager there for their Emerging Markets Value Fund. In fact, you all launched 2 funds this year in the emerging market space. And I'm curious about sort of what ends up being kind of the dominant driver of returns going forward, particularly if you believe, I think what we've heard a lot of central banks this week, both in the developed world and the emerging markets world, that the rate hiking cycle is either at or near the peak.
Yeah, absolutely. And thanks for having me. So I think what's interesting is to think about the divergence that we're seeing between the emerging market world and the U.S. And a lot of focus this week has clearly been on the Fed having a more hawkish tone and that rates are potentially staying higher for longer in the U.S. But what's important, I think, to focus on is not just the absolute level of rates, but the relative real yields that investors are able to get in emerging markets relative to developed world. So unlike in the U.S., where we see inflation has been more persistent and stickier than had been anticipated, in many emerging markets, such as Brazil, we're seeing inflation coming down meaningfully. So in Brazil, for example, inflation rates had peaked at 12%. They're now at 4.5%. And so this is providing additional scope for many emerging markets to actually cut rates. And we've seen, whether it's in Poland or Brazil or other emerging markets, central banks starting to cut rates, which should help accelerate local economic growth without compromising the real yield differential, which is still at relatively high levels versus the U.S.
So if that scenario plays out, and let's just take Brazil as an example, if that scenario plays out there, then what becomes attractive from an investment perspective? Is it like cyclical stocks? Is it financials? I mean, what becomes the dominant driver?
Yeah, so we think there's several opportunities that are really exciting in Brazil. So for example, within the financial sector, we own Banco BTG, which is the largest investment bank in Brazil. And it benefits directly from lower rates through higher capital markets activity. But it's not just a macro play, it's also a play on the fact that they're gaining share in wealth and asset management, which should lead to higher multiples, given that it's a less cyclical and less volatile business. So we think that opportunities in Brazil benefit from lower rates driving higher growth and higher valuation levels, but also idiosyncratic drivers for the individual companies we're betting on.
So Brazil is a bright spot here. Talk to us about China, though. It feels like every conversation in emerging markets right now especially comes back to China, and maybe how optimistic we were at the beginning of the year. How are you thinking about China right now?
Yeah, so the Chinese growth has clearly disappointed the markets. I think what's interesting, or what's important to note, is that we still see meaningful opportunities at stock-specific levels, even if the macro were to remain status quo. So for example, we're seeing opportunities in consumer, in autos, in companies that are able to gain market share through new product development, through increasing utilization of existing capacity, through in some cases exports, and being able to have product mix shift towards higher margin products relative to their legacy products. And we think that some of these stocks are trading at single-digit valuations at all-time low levels. And so even if the macro were not to meaningfully be stimulated, we still think there's many opportunities and ways that those stocks can outperform.
So you specified Chinese equities there. Does that logic carry over to the debt of some of these Chinese companies?
I think it depends. So I think it really becomes a matter of digging through the individual balance sheets and risk profiles of the companies. So clearly, if you look, for example, at the real estate sector, meaningful dislocations in that market, but I think it's important to not throw the baby with the bathwater. So even though you have many privately owned real estate companies that are clearly struggling and whose debt payments are under question, you have many larger state-owned enterprises that have relatively strong balance sheets that are also seeing weaker earnings from the broader lower demand in the real estate sector, but they're actually well positioned given their land bank to gain market share from some of these weaker players. So I think it's really important to look at it on a security by security level as opposed to painting all of the securities with a broad brush.
I mean, as I'm sure you know, there are still a lot of folks out there who want exposure to EM, not necessarily to China, at least not with the magnitude that maybe it was in the past. That's led them to look to India and to a certain extent South Korea as well. Are you finding any opportunities there?
Yeah, absolutely. So I think South Korea is a great example where we see many opportunities and actually with two different levers. So one opportunity we see is, for example, in Korean banks. So banks like KB Financial, which are trading at 0.4 times price to book, but should be trading at 1 times price to book, given that they're generating ROEs that are essentially equivalent to their cost of equity. And more recently, we've seen some progression in higher return of capital to shareholders, announcements of more buybacks, which is positive, but also the opportunities for sequential increase in loan growth, given some stabilization in the real estate market and improvement in the real estate market, which should further benefit the earnings outlook. On the other side, if we think about the export-driven markets within Korea, we still see many opportunities in the memory value chain, particularly with pure-play memory producers like SK Hynix. They're benefiting not only from a cyclical rebound in DRAM prices, but the structural underpinning of growth in artificial intelligence.
Is there an AI story in there somewhere, or no?
There is, absolutely. But I think that's not the only story. So with AI, it requires more bandwidth. The memory content requirements are 4 to 8 times greater than non-AI applications. So SK Hynix chips are required for those high-end servers and for all the processing that's required. But what's also interesting is that we find ways to benefit from this trend, not only from the memory producers, but also other service providers. So Kingguan, which is a company in Taiwan, provides testing services for semiconductor producers. That's another stock at 13 times forward PE. We think it's quite attractive in different ways to play that theme.
There's an AI story everywhere. Come on.
If you look hard enough, yeah.
You knew the answer there. Christine, it's really great to see you. Our thanks to Christine Philpott. She is portfolio manager for Ariel Investments Emerging Markets Value Fund. Now, coming up on the close, we'll give you fresh headlines from GM and Stellantis as they respond to the UAW, who expanded strikes today. That's next. This is Bloomberg.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Well, the United Auto Workers said today that it has clinched key concessions from Ford and will not escalate walkouts at those plants. However, it will, though, expand the strike to 38 additional facilities run by rivals GM and Stellantis. UAW President Shawn Fain spoke earlier about the wider strikes.
We can and will go all out if our national leadership decides the companies aren't willing to move. Stellantis and GM in particular are going to need some serious pushing. All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike. We will be striking 38 locations across 20 states, across all 9 regions of the UAW.
Well, just in the last few minutes, both companies responded, with GM saying the strike escalation is, quote, unnecessary, Romaine. And we heard from GM also saying that the UAW leadership is manipulating the bargaining process. So it seems to be very, very tense still.
Yeah, very tense here. But I mean, we've seen this before, right? You kind of have this back and forth. And I think the idea, particularly when you see the latest headlines of at least coming with some degree of a counter offer, at least there is a back and forth. Because we've seen these labor negotiations where folks don't even talk, and then just months go on with nothing.
I feel like we just saw that with the writers and the actors strikes. For so long, it seems like they were just not getting to the table, not actually being in the room. We're starting to see some movement there. And to your point, I mean, these two sides, they're talking. The words aren't necessarily warm, but they're talking.
And it's interesting. We've spoken with a lot of analysts about what the potential economic impact, or I should say fundamental impact, would be on the companies. They talk about, obviously, the relatively healthy balance sheets that the automakers have, the inventory that they have on dealer lots, which should at least for the next few months be enough to meet whatever supply, whatever demands are out there for new cars. But then the question becomes, too, that if the production is halted in a material way, similar to what happened at the onset of the COVID crisis, then what is the longer-term issue when you head into the spring season when a lot of people are looking for new cars? Are they going to have anything to test drive?
It's a great question, and it's going to be interesting to see if we...
You're a car owner, right?
I'm not.
You're not?
I know at least I'd like to buy one.
You're a horse owner, though.
I own a horse.
That's good. Are the horses on strike?
Rates on horses aren't as necessarily punishing.
Is that a good financial investment, owning a horse?
I don't know. JP Morgan Private Bank actually had an entire note out on that today, but we'll have to talk about that at a later time because David Welch Welch. He's the Bloomberg Detroit bureau chief. He joins us now. And David, what happened in the Ford conversations that didn't necessarily happen when it came to GM and Stellantis?
They gave in on cost of living increase. That's been one of the core issues for the union, cost of living allowance, or COLA. It's something the unions gave up in 2009 as General Motors and what was then Chrysler, now part of Stellantis, went into bankruptcy. It was one of a number of concessions the union made to improve the cost base and get the companies financially stronger. And what it does is it basically gives workers a raise that matches the rate of inflation. So if inflation's 3%, in addition to whatever percentage the union and the companies agreed to for a base pay raise, you get that on top of it. What GM has wanted to do, and it's a fundamental disagreement between the company and the union, is they want to give the union protection if there's abnormally high inflation. I don't know exactly what the formula is, but it's not just sort of an addition to the raise that matches the rate of inflation, which is what the union wants. So that doesn't sound like a huge issue. It's just something GM doesn't want to make inflation sort of a structural part of their pay.
Yeah.
So it's always rising and getting compounded every year.
But this is kind of the crux, I think, of what the UAW, at least publicly, what we've heard from Sean Fain, are really getting at. I mean, even their whole slogan, record profits, record contracts, you can interpret that how you will. But they seem to be making the case that when you look at the trajectory of what these auto companies have made since the last contract, if they didn't have their share, if they didn't have those adjustments, give it to me now.
That's right. And the other thing they brought up is some of the CEOs have seen their pay rise 30, 40%. So they're saying, look, if we're going to get 20, COLA is not that big a deal when the top executives are getting so much of a bigger raise throughout the course of the contract as well. So, look, I think GM is, they're probably going to have to give in on this one. This isn't the traditional pattern bargaining we've seen, but Ford seems to have set the pace here, and it looks like they don't have a deal yet, but it looks like, there's light at the end of the tunnel for Ford.
Yeah.
And it seems less so with GM and Stellantis, and it looks like both of them are going to have to do something similar on this inflation adjustment issue.
Yeah, they're going to have to come to some agreement. It'll be interesting to see who thinks they have the most leverage and, well, how it actually shakes out. David Welch out there in Detroit, and we've seen, of course, this labor issue play out in other industries. Been talking a lot about Hollywood, but there was a big strike going on over in Australia surrounding some liquefied natural gas facilities, and we did learn this morning that those sides, primarily led by Chevron on the corporate side and the labor unions, have come to an agreement there.
Which is a relief, because you think about still the very delicate global supply chain right now and how important LNG is just to the global energy picture. So some good news there, but it really neatly shows again that this is happening across industries, across the economy.
And ask yourself this, why does that get settled? Why did UPS avoid a strike? There was a certain degree of leverage that those labor unions had that the companies had to sort of meet, right? We saw that with Chevron meeting their demands for the cost of living increases. Similar story for UPS. For whatever reason, at least right now, the automakers don't think their workers have that same leverage.
And we'll see how that develops over the next, couple weeks, couple days.
We'll see. Stick with us. A lot more coverage coming up here on The Close. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I found myself in a spot where I was constantly getting new challenges. A lot of, I think, the best mentorship I had at Bridgewater is because people often saw in me the potential to do things I didn't even see in myself yet.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is the countdown to the close. While broader markets right now are still holding on to modest gains and losses, depending on what index you look at. As far as the commodity space, a little bit more green on the screen. Abigail Doolittle standing by right now with our commodities close.
Indeed, Romaine. So for the Bloomberg Commodity Index overall, we have a very small gain, but here are some of the bigger winners, for lack of a better way to put it. Crude oil, about 0.4%. You can see natural gas outperforming up 1%. Gold, a small bit. And then wheat actually turning it around. Earlier, it had been lower, I believe. No, actually, it's been higher. There's been a second ship leaving a Ukrainian port from the Black Sea, so even more supplies making on the world. Grain traders, wheat traders looking past, probably in part because wheat is down almost 30% on the year. Now, copper, it's really interesting, not really doing much on the day. But if we go into the Bloomberg terminal and take a look at what's going on, this is a really interesting risk of asset divergence. So this is a year-to-date chart. And you can see earlier this year, especially when there was the idea of China reopening, and China, of course, the world's largest user of natural resources, copper and the S&P 500 really trading right there next to each other. Copper declining as the China story deteriorated. The S&P 500 going higher. Well, we have we have copper going back below 0% again on the year, negative move on the year. The big question here, Romaine, we have an uptrend breaking on the S&P 500. How much is the S&P 500 going to connect, and where will these two risk assets reconverge at some point in the future?
Yeah, good point there, Abigail. Abigail Doolittle there with our commodities close. We want to pivot from that to the world of financial regulation, a big debate taking place right now in Washington. We are learning that U.S. officials, led by Janet Yellen, want to make it easier to label firms as systemically important. But the big financial titans are preparing to fight back. That's because that too big to fail label would bring greater oversight and new compliance headaches, including capital requirements that a lot of them just don't want to have to deal with. Katanga Johnson is joining us right now, our banking regulation reporter down there in Washington. And first, let's start off with the implications for this. When we hear the words too big to fail, we think of the J.P. Morgans and the Citigroups of the world here. And I think we can all easily make the connection of their importance to our economy and the need to keep them solvent should the worst come. Why are they the regulators looking to expand that definition?
Biden's top regulators are really hoping to have more authorities to designate a firm as opposed to just the activities of the market as systemically important. Sources make it clear that this push to undo a guidance that under the Trump administration sort of made it difficult, applied a sort of costlier test for the top regulators in the financial system to designate such firms as SIFIs. They're trying to undo that, make it easier, shorten the amount of time, so that in the event of an event that took place early this spring, where you had a number of banks failing and also, challenges that ripple effects that might have stemmed from that, regulators want to be able to step in sooner and spot those risks with this blueprint.
And let's say that this designation is extended. Who are we talking about? What kind of firms, non-bank firms, could this be extended to?
The likes of hedge funds, money market funds, as well as non-bank mortgage lenders are likely to be wrapped up in this. Regulators have said that these firms play a significant role in the the financial system, but the level of data that regulated firms like banks and others have to submit to the regulator and disclose to the public is not as readily available in all cases. That makes it harder for them to really spot as firms continue to grow, as non-bank firms continue to grow in size. They're really concerned about their ability to spot whether there's a risk that could potentially have knock-on effects to other parts of the financial system, including banks, which in many ways provide liquidity to many non-bank firms.
Give us a sense of kind of where we are in this process. I mean, anytime you get a new rule, particularly one that's going to be this size and magnitude, you're going to have a huge lobbying push, if not to kill the rule, at least certainly to neuter it in such a way. How far along are we in this process?
It's very early stages. Of course, the Biden administration's regulators proposed to make this change in April. They had a meeting today and a closed-door session to discuss the comments that stemmed from that April proposal. The hope is, sources tell us, to adopt this measure by the end of the year, to have these powers by the end of the year, so that as soon as next year, regulators can consider which firms might likely make a short list to be considered. And it's important to note that even though sort of this race to the finish to have these powers by the end of the year is likely, it may take about a year before regulators can actually notify firms that they're on a short list. And therefore, in some ways, firms are trying to get ahead of it and make changes to the consideration ahead of time.
Well, Katenga, I'm sure we're going to check in with you soon on this. Our thanks to Bloomberg's banking regulation reporter, Katenga Johnson. And Romain, to your point, you take a look at some of the reporting. BlackRock, Fidelity, and Vanguard are all among the players who've sent in comment letters about this.
Yeah, and this will be interesting. I mean, we talk about, 8 systemically important banks. And we kind of forget that they tried to expand this label before. Remember, I think it was Prudential, MetLife, and a couple others, insurers who actually got caught up in this. But then they were actually later allowed to shed that label. Primarily because of the big lobbying push. But you kind of wonder, too, the clock is ticking. Remember, Trump administration sort of pushed back on these rules themselves. Biden now wants to put them back in, but he's only got, another couple years in office and, assuming he doesn't get reelected.
Yeah, better hurry up. And in a way, it's like a backhanded compliment. You're really big. You're really important. Here's a bunch of regulation. I'm sure we're going to be all over this story as it develops. But still ahead on the close today, PayPal downgraded at MoffettNathanson. We'll talk to the analyst about the headwinds she sees ahead for the payments company. That's next. This is Bloomberg.
State, Senator, First Lady, with being a grandmother?
Well, actually, there are similarities. Negotiating with 3-year-olds is about as hard as anything I did as Secretary of State.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
All right, time now for our top calls. A look at some of the big movers on the back of analyst recommendations. And we start off with a look at Volkswagen, an upgrade today to buy from holdover at Stifel, with the analyst saying that while the stock remains a, quote, risky call due to some of the long-term challenges and short-term order softness, he says the stock has already corrected for some of those possibilities, and he sees an opportunity for the company to cut costs and preserve margins. ADR is here up 3% on the day. Next up, Deere, getting cut to hold over at Canaccord, which also slashed its price target all the way down to $400 from $530 a share, saying industry data showing slowing unit growth for new agricultural equipment and rising dealer inventories on used equipment. Those shares down 2% on the day. And finally, let's take a look at Charter, upgraded today to overweight from equal weight at Wells Fargo, and the price target going up to $550. The analyst saying that the worst of the cable TV downturn is behind the company. And he says Charter is actually, quote, the clearest expression of the new normal, with new opportunities for growth in mobile and rural customers. Those shares, though, unfazed on the day, unchanged on the day, I should say, down about 0.2%, and those are some of our top calls. We want to stay in the sell side space and take a look at PayPal. The shares have been under pressure all week. A little bit earlier this week, we did learn of a downgrade to market perform over at MoffettNathanson. Pleased to say that Lisa Ellis, analyst over at MoffettNathanson, joining us right now to talk about that call. And Lisa, I am curious, interesting quote in your note was about this idea of some of the competition that PayPal has seen as of late, and I'm curious as to where that competition is coming from.
Yeah, they're seeing competition from a few different angles. The most significant one is from Apple Pay in the core branded checkout button at PayPal. That sort of pay with PayPal checkout button that you see on merchant websites contributes over half of the gross profits of the company. So disproportionate contributor to their profits, and it's under increasing pressure from Apple Pay, which got a lot of momentum coming out of the pandemic, and we estimate now has about half of the same share of checkout that PayPal does, but is gaining very rapidly.
I am curious, when we talk about, I guess, some of the first mover advantage that PayPal had in this space, and of course, even with Venmo and that sort of a level of transaction here, is there any sense that they have the opportunity to maybe reclaim some of that market share, or is the strategy and leadership just not there to do that?
Well, they do have a new CEO coming in. He starts next week. That will be, kind of an injection of new talent. He will have a lot of work ahead of him. He has to, it's not only him, but he has to bring a whole team with him because there's been a lot of turnover in the senior ranks at PayPal. He comes from Intuit, so has a lot of experience and success with small businesses, which if you go back to PayPal's original value proposition, 25 years ago at the advent of the internet, was very focused on small businesses and facilitating payments for smaller merchants on the internet. We expect that he will sort of refocus the company in that direction and really focus on winning in that space, which is where PayPal competes more with a player like a Stripe or the European player Adyen. PayPal has very strong products in that space as well. And that's an area we expect them to kind of try to, pivot a bit and gain some additional momentum.
Lisa, I want to talk a little bit more about the C-suite, because this line from your note really struck me, that if you take a look right now, PayPal currently has vacancies or temporary assignments in the COO, CFO, Treasurer, and Chief Strategy Officer roles. How unusual is it that a company has that many important open roles at once?
Yeah, that's pretty unusual. Yeah, for sure. The outgoing CEO, Dan Schulman, has been with PayPal for 9 years, since prior to the spin out of eBay. He joined when it was spinning out of eBay. He has had a very strong, loyal team around him for a long time. Unsurprisingly, as he's transitioning out of the company, many of those folks who have also been there for 8 or 9 or more years would naturally be retiring or just moving on. But the CEO transition at PayPal has taken a little bit longer than maybe I think investors were hoping it would. It's probably, taken, could have happened as much as a year ago. So there has been a bit of a kind of air pocket where we've had some departures. And since we did not yet know who the new CEO was, and he has to bring in his own team, right? There's sort of these seats that have been sitting sort of vacant or temporarily filled now for quite a while, which is probably contributing a little bit to the to the sort of sluggish performance of the company this year.
And once we get the bench assembled, once the team is up and running, what should be the first item that they should focus on? Is it the market share? Is it the margin? What's first on the list?
Absolutely, first on the list has to be addressing that competitive threat from Apple Pay, because that business for PayPal, the branded checkout business, contributes, it's more than half of the profit of the company. And right now, it's not a disaster. It's still growing. It's growing in the mid-single digits. But we need to see that business reaccelerate. And the things, for example, they can revitalize the value proposition of that digital wallet. They have a lot of good capabilities. They have like a really strong buy now, pay later product, for example, that competes with a player like an Affirm. And they have some good, kind of credit and debit products, some other interesting feature functionality, but they really need a strong kind of product and marketing push around it to kind of steer consumers back toward using PayPal to check out and be their preference for checking out on websites or in apps, and moving a bit away, and kind of turning the tide back away from Apple Pay.
All right, Lisa, great to catch up with you. Lisa Ellis over there at MoffettNathanson, a closer look at PayPal. Meanwhile, we want to bring you some breaking news. This involving WW, the company formerly known as Weight Watchers, up about 3.5%. And in fact, just within the last 20 minutes or so, it's actually spiked about 10% off of the lows of the day here. This is based on a report coming out of Goldman Sachs, which is citing a posting on the Blue Cross Blue Shield website in Michigan that seems to imply that they will be covering the cost for some of these weight loss drugs, these GLP-1 weight loss drugs such as Wegovy, which is made by Novo Nordisk. Remember, Katie, there was a lot of discussion here about the cost of these drugs and whether the insurance companies would actually pick up some of the costs. Basically, what we're learning right now is that Blue Cross Blue Shield of Michigan has designated the drug as being highly effective when used alongside healthy diets and exercise. And then the Goldman analysts are extrapolating from that this could mean that we could see some sort of coverage, insurance coverage for these drugs.
It's a good thing that Goldman had their alerts set up on the different websites. As you can see, the after-hours share reaction.
I don't have one of those alerts for Blue Cross Blue Shield.
Now I'm thinking I should.
I feel like I'm behind the curve.
Probably set one up. Interesting to see what would be a pretty quiet Friday, a big pop in the shares.
Yeah, and we should point out no real action, at least as of yet, in shares of Eli Lilly or the ADRs of Novo Nordisk, which are just relatively unchanged here in the session. Coming up, we're going to talk about skincare. Skincare spending holding up in the face of inflation. We're going to discuss the resilient demand for creams and serums. The CEO of Curology, Heather Wallace, on deck. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from It's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Skincare, it's everywhere, whether you're scrolling on TikTok or following your favorite celebrity influencer, Romaine. Consumers still spending big on creams and serums, and our next guest is the CEO of a big player in the space, Curology. It's an online skincare platform that offers customers online assessment and virtual consultations with its providers. I'm thrilled to say that Heather Wallace joins us now. And Heather, it's interesting. I mean, I don't know whether it's because I spend a lot of time on TikTok, but I feel like skincare is really picking up, and its popularity and just the presence that it has in daily conversations is growing.
Absolutely. Skincare has been growing for many years, and it keeps growing. It's a very resilient category. I always say people face the world with their face, right? And so as you think about prioritization of spending, skincare is always at the top of the list.
Is that typical, though, when you're heading into, I don't know, a period where there's a lot of talk about a potential economic downturn? Of course, inflation remains very, very high right now. When you think about how consumers prioritize their spending, where does skincare tend to fall?
Skincare really sits at the top of the list. If you think about what happened last year with tons of inflation, skincare was actually one of the only categories that grew units and not just dollars.
So talk to us a little bit, I guess, about how Curology works, because this isn't just going out and just buying a cream on your own. You actually do get to consult with a dermatologist or some other sort of medical professional. Is that true?
That's exactly right. So Curology is very different in that we were founded to make effective skincare accessible. And the way we do that is we combine a dermatology-focused telehealth practice with custom compounding ability. So we create personalized multi-RX ingredient formulas that truly raise the bar in terms of efficacy.
Because this is what I'm curious about. I mean, she mentions TikTok, and we know a lot of people are getting advice on TikTok and these other social sites, but not necessarily from reputable people, or at least people with actual real knowledge of it. How do you make sure that what's being advised to folks is best for them, best for their skin, and isn't maybe going to cause some adverse reaction?
Yeah, so we recommend that everybody comes directly to us, and you can speak for free to one of our dermatology providers. So they assess your skincare goals, they look at pictures, and they give you really good advice. And they can prescribe the products that we can create and personalize for you, but they'll also help you build your full skincare regimen.
And Heather, this is a real question. What role have influencers, if you will, TikTok, played in basically growing the industry? Because again, I spent a lot of time on TikTok. Every other video on my For You page feels like it's about skincare in some way.
Yeah, so TikTok definitely plays a role. If you think about how our company was founded, we were actually one of the first companies picked up authentically by our own patients. And so we were trending on Reddit in early days. And a lot of our own subscribers come from other subscribers who are getting on platforms and talking themselves. So we leverage it where possible, but we really leverage our dermatology providers to provide the recommendations and the personalization and make sure that we can kind of straighten out any myths that might be happening from a skincare perspective.
And if you think about that from a user acquisition cost standpoint? Has the fact that it's become so big on TikTok, does that make it more or less expensive to get users?
I think this space is crowded, right? And so the more crowded the space gets, the more expensive it gets. Luckily for us, we're 9 years now. We're a scaled company, and so we have the dollars to be able to go and reach consumers in many different ways, and not solely focusing on social media.
Yeah. Do you need like a big celebrity, spokesperson or big celebrity endorser? Is that? I mean, when we talk so much about skincare, or really anything in the kind of the beauty and cosmetic space, it always seems like there's some, big actor, actress, or other athlete or something attached to it.
Yeah, I think that works great for some brands for the right purpose, but we're really focused on our dermatology care. We're really focused on efficacy. And so for us, it's about our own providers and creating those relationships and really being focused on the science and the proof.
9 years, you scaled this up. You're still a private company.
9 years, we're still a private company.
Any plans to go public?
We're always looking at the market, but it's always about us delivering sustainable results. And if the timing is right, the timing will be right.
Heather, great to catch up with you. Heather Wallace there. She's the CEO over at Curology. And of course, Katie, as I'm sure you know, based on your TikTok feed, celebrity-backed beauty brands are everywhere. From Rihanna's Fenty, which I'm wearing now, by the way.
No kidding.
Selena Gomez's Rare Beauty, which you might be wearing. And Kim Kardashian's Skins, who I don't want to know who's wearing that right now. Carlisle co-founder David Rubenstein, the hard part of his job here was to sit down with Kim Kardashian, who I should point out is now a bit of a VC mogul herself. That peer-to-peer conversation was taped just a little while ago. Take a listen to her approach to running a business.
I'm so hands-on. I'm so involved. I mean, to this day for Skims, I'm still our fit model, which we have like a group of fit models, and I'll know the collection that I didn't fit for. I'm very specific on how things fit, and I pick the fabrics, I come up with all of the marketing. So with Skims and my beauty brand Skin, I do every last thing.
And Kim Kardashian there, who needs no introduction there in her Storm outfit. I guess that was for Halloween. But when we talk about sort of the need, I guess, to have these sort of big celebrities sort of attached to these brands, because like I said, you pay attention to this because it's Kim Kardashian, right?
Yeah, definitely. Yeah. I mean, you've been following her. In my case, you've been following her since you were a young teenager. The brand loyalty, I mean, that some of these celebrities have is just amazing. And to Heather's point, I mean, it is a crowded space at this point.
Yeah.
Kim Kardashian has a skincare line, but so does everyone else.
But that's the thing, and we were talking with Heather over Curology. I mean, there really is so many players in this space, and it's like, how do you stand out, right?
Yeah.
Like I said, I mean, you'll pay attention to a Rihanna or Kim K, but if you don't have that type of person attached to it, how do people find you?
I really think that the first mover advantage also matters here because Kim has been out there. Rihanna has been out there.
Yeah.
You know their lines. And, for some of these celebrities that are just introducing skincare lines, and there's a lot of them, it's harder.
I'm just told in my ear, apparently our director, Jared, he's a big Skims person.
No kidding,
yeah.
Jared.
Yeah, that's staying slim there. You could catch more of David Rubenstein's interview with Kim K on his peer-to-peer conversations, of course, on Bloomberg Television, all of our Bloomberg properties here. As we start to round off into the final hour of trading here on this Friday afternoon, a wild week to be sure. And I just want to go back real quickly, if we can, Katie. The shares of WW have been all over the place. At one point up about 7-8% here on the day on the back of an alert put out by Blue Cross Blue Shield of Michigan, we should point out. Extrapolate that for what you will. One bright spot in an otherwise tepid day here of price action. We're going to break down all that price action for you when we come back after the break. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics center at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
Almost 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Katie Greifeld.
A view from the top here on this Friday afternoon. A bit of a reprieve for broader markets, but not nearly enough to erase those massive losses that we saw from earlier this week.
And it's been a really awful month in general. We're looking at back-to-back losses on the NASDAQ 100, the same case for the S&P 500. And of course, today, not seeing much of a lift at all, the S&P 500 flipping into the red.
Yeah, most of the sectors in the red. You have some bright spots here as some of the big cap tech names are higher, but not enough to really cause any real damage. You see the NYC FANG index, which actually was up about 1% earlier in the day, now relatively unchanged. Bank stocks and a lot of the rate-sensitive sectors have really been under pressure all week long. No change here on the day. And you take a look at that 10-year yield, actually getting a little bit of a spike here, down about 6 basis points here on the day, but still camped out at about 4.5 after, of course, trading above 4.5 earlier in the session. Flip up the board here because I was taking a look at the broader market and what the next catalyst could be for it, Katie. And remember share buybacks?
I do.
Well, apparently the companies don't, because a lot of them have given up on it. You can see this chart here, and you can see where share buybacks sort of peaked and how much they've come down. That may not look like a significant amount given just how far down we were, but when you consider that uptrend that we had seen, particularly in 2020, 2021, and how the bloom has really come off the rose, remember, that was a huge support for this market, and at least for right now, that support isn't there. Of course, a lot of companies now have to kind of go into that quiet period, if you will, ahead of the earnings season. So we'll see once we start to get those earnings in about, 3 weeks' time, whether those buybacks resume.
We'll see. Maybe one of the reasons why the wheels are falling off a little bit of this equity market. But let's take a look at some of the individual movers. Of course, we do have some green. Really, I actually picked 3 gainers. I didn't realize that. Ford up 2.3%. That's after the UAW said it actually got some concessions from Ford. It's going to spare Ford from some of the pain it's inflicting on General Motors and Stellantis. Shares up 2.3%. Let's talk about the iPhone, though.
Okay.
Let's talk about Apple.
Yeah, I heard the iPhone went on sale today. iPhone 15.
It did. iPhone 15
Which
Pro.
is actually like the 17th or 18th version.
Yeah, something like that. It went on sale in 40 countries in its first wave.
And did you stand in line this morning for one?
I did not, but apparently a lot of people did across the world, including in New York. And if you take a look in New York,
do those people not have internet connections?
I don't know. A lot of them do order online, and the online orders sold out of some metric, I believe. But still, people like to go out and camp in front of the iPhone store. I'm not one of them, but shares are up almost 1%. Yeah. And let's quickly move on here and talk about Activision. Of course, shares rising since it looks like Microsoft's Activision deal is set to clear its final UK hurdle. The Competition and Markets Authority said on Friday that Microsoft's latest proposal proposal opens the door to the deal being clear. That's giving a little bit of a lift to Activision shares.
Yeah, it'll be interesting to see if this deal finally closes. I thought one of the more interesting things coming out of that big antitrust on some of those documents filed was that they had actually considered buying Nintendo a few years ago. And obviously they passed on that, chose Activision. Meanwhile, Katie Greifel and I are here as we move less than 1 hour away from the closing bell. Our cross-platform coverage, counting you down, it starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Masser, Jess Menton in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms here on a Friday afternoon where we were looking for a little bit of a pop here, Carol, to kind of undo some of the damage from earlier this week. That's not happening. And one of the big laggards that we're seeing today is actually the Russell 2000 and the small cap.
Yeah, I'm glad you went there because there's a great story by our Esha Day taking stock of what's going on in the trade and looking specifically at what's been going on in terms of the Russell 2000. And she has said, in terms of talking to some individuals, including Matt Miller. She could have talked to Matt Miller.
Talking to Matt Miller.
Matt Maley of Miller Tabac. Matt Miller, did you? No. So I'm just going to read from her story. The Russell confirming a move toward a bearish trend after breaking below an important support level, triggering several technical indicators in quick succession. I mean, read through the story, but it's interesting. You watch some of these different market indicators, Jess, right? And what it might portend, because it seems to be when you see extreme moves in small caps, often a precursor for even more challenges in the equity trade.
And typically small caps are the ones that bottom before their larger counterparts, but they've been under pressure, particularly over the last 2.5 years. But they did recover towards the end of last year, but still over the past few months struggling there. So what that really means when you're looking more toward bigger cap stocks. But I have to point out, Bloomberg Intelligence, they do have a fair value model that does suggest that, say there is a soft landing type scenario for them, they could actually end up orchestrating a pretty big move there. But again, it remains to be seen as far as what this means moving forward.
Yeah, well, they have to, of course, get to that soft landing, Katie Greifeld. Another big story out there on the terminal today that I know you've been obsessed about.
Oh, my gosh. I'm glad that you made the segue for me because I was not sure how to do it. We're talking about the Liver King. Actually, Romaine handpicked this story to talk about a great piece out that basically there's this influencer named Brian Johnson. That is his real name. He's known for eating raw organs, but the problem is a lot of his followers decided to also eat basically raw meat to try to get the physique that this man has. But it came out that actually he's just been taking $11,000 of steroids every single month.
$11,000 worth of steroids? How is he still alive?
I don't know.
I thought, in all seriousness, I mean, this story has obviously kept a lot of attention. I've been aware of this guy for a while, and there's been a lot of talk about whether
have you been eating raw meat?
What he was selling. of short duration, the idea of just, doing, say, I don't know, a 6-month bill or something even rollover risk when you get to it?
Not necessarily looking at the 6-month or even 3-month T-bill. A lot of appetite still just sitting in cash. That's something you're earning 5 to 5.25%, if not more, on just cash. So they're not even looking to go out 3 or 6 months because you can earn more in that cash, and you're very liquid, so you can be very quick to make decisions when we do see a correction in the market. What we've seen thus far, 5.5% down on the S&P 500. That's not a correction. That's just a minor blip here. We think, unfortunately, that we could be in for at least a 10% correction in the S&P 500.
And to keep the conversation going on cash, if we actually did reach that correction, a 10% correction in the equity market, would that just sort of stoke further demand for cash? Because in addition to pretty high yields right now, it also has that haven aspect.
Mm-hmm. It does have that haven, and you often have that investors have that fear of missing out. So you see investors going into the equity market. We've seen it this whole year. They're driving valuations up, and you see that fear that they're missing out on the rally on the upside. Well, it goes the same way on the downside. You get people that get spooked. They sell at the wrong time. Our philosophy has often been, from a contrarian perspective, we don't mind buying when the market's on its way down. We have a longer-term time horizon, and we think that that's when you're going to find the better opportunities.
All right, Megan, great to catch up with you. Megan Horniman there over at Verdance Capital Advisors, helping us count you down to those closing bells. About 3 minutes until we get to those bells, Katie. And I think we need to kind of step back here because we talk about the moves in the market, right? And sort of what predicated that sell-off that we saw on Wednesday and into Thursday here. The idea, not so much just of soft, hard landing, but the idea of those rate cuts that had been priced into the market and into valuations, that being taken off the table seemed to really rattle folks.
I agree. I think that was a reality check, and the price action backs that up. Because if you think about sort of the rallying cry for some of the stock bulls, is that the pain that we've been seeing from higher interest rates, okay, you look into the future, though, it's coming down. And I think it was, again, a reality check for a lot of investors potentially that maybe not as quickly as we had hoped.
Yeah, and for some of those folks who came in to buy the dip this morning, that is those gains being erased here. All of the major indices were higher just a little while ago. Now all the major indices in the red as we move closer to these closing bells. Our full market coverage starts right here on Bloomberg as we take you to the bell and beyond.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell. And here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Jess Menton. Welcome to our audiences across all of our Bloomberg platforms. Carol Masser, last time we spoke, it looked like we were maybe getting a bit of a rally here. But then, of course, after you last appeared, the market has gone south.
I'm so sorry, market. I had no impact on this. But I think it kind of makes sense after the week that was in the Fed meeting, and I think going into a weekend, I think people are a little bit tired, and we're kind of waiting for maybe Fed speak, economic data points, kind of what comes next. That just kind of feels about right to me.
And especially this week, the S&P 500 snapping its streak of 102 sessions without a drop of at least 1.5%. So that was its longest stretch since 2018, Katie.
Yeah, and the S&P 500, third straight week of losses. You would think I'd have a more impressive size and scope, but that happened last month too. It just feels like the wheels are maybe starting to come off a little bit here. Maybe those higher interest rates finally making themselves known to some of those equity bulls.
Yeah, and we talk about some of those key moving averages that have been broken for those technical analysts out there that are really sort of looking to that trend line. Is that trend line now, Jess, to the downside?
Yeah, definitely. And especially when you're looking at that downtrend line, if you're looking at the S&P 500 in particular, on a quarterly basis, it's on pace for its first quarterly loss actually in a year. So next week will be the final week in the third quarter. Yeah, we should point out, of course, for the S&P 500, a down week to be sure. In fact, setting up here for what looks like it's going to be the worst week that we've seen in quite some time, erasing all of the gains for the month of September, erasing all of the gains that it had in the month of August, and erasing all of the gains that it had in the month of July. So this is a market that effectively has gone nowhere since that phenomenal run through the first 6 months. And now here on this Friday afternoon, here on September 22nd, the S&P 500 posting its worst weekly decline
since March 10th. A 0.2% decline on the day, about a 3% decline on the week. The Dow Jones Industrial Average down 0.3% here on the day, while the NASDAQ Composite is going to finish fractionally lower by about a 0.1%. And the Russell 2000, that was your relative laggard here on the day, down 0.3%, setting up for what looks like it's going to be the 5th straight week of declines.
Yeah, a little perspective in terms of where we are in 2023. You still have got a NASDAQ 100 that's up 34%, an S&P that's up about 12%. It is really the small cap universe, so that continues to lag, Katie. It's just up, what, about, I don't know, 0.8% here on the year.
And if you take a look under the hood of some of these indexes, and you take a look in particular at the industry groups, there's a lot of red, there's not a lot of green for this Friday. You can see up at the top, you do have some of the chip makers, the semis, getting a little bit of love, up by 1% or so. Then some of those tech hardware names also managing to stay green. You go down the list, though, to some of the biggest losers. Banks on the day down by 1.4%, and autos off by 3.5%. Of course, Tesla is down by not insignificant amount today, and that is weighing on the industry group overall.
All right, so let's get to some of the individual gainers. Ford Motor Company, right? We've been all focusing on the UAW, the strike out there in Detroit. GM and Stellantis now facing some walkouts at maybe as much as 38 more facilities as talks with their workers union failed to make some headway. Ford apparently, like, they all have different relationships with the UAW, the automakers. Ford spared the escalation after making some progress in negotiations. So Ford, it was the number 4 gainer in the S&P 500, up about 1.9%. Got to talk about Apple at its highs today, up 1.8%, still finishing the day with a gain of about 0.5%. The iPhone 15, you've also got watches going on sale today. And there was also another story late yesterday about the company giving smaller raises to its retail employees this year. So there's a lot of play, a lot at focus, but nonetheless, Apple eking out a little bit of a gain today. Don't judge me. I don't even know if you're going to bring it up, but Wayfair was up almost 5% in today's session. Bernstein coming out, raising their call on the name to market perform from underperform. Raised their price target from 65 or 265, excuse me, from 60. You had Wayfair down 2%, but as I said, it was up as much as 5%, closing the day just under $60 a share. Wah, wah, wah.
I'll take the decliners. Looking over at Scholastic, so this is the children's publishing company, ticker symbol SCHL. That's down 13%. It was its worst day since March 24th of this year. If you look at that, those shares were dropping after it did report larger than expected adjusted loss per share for the latest quarter. It also flagged some seasonality issues with the sales of its education solutions unit. Another one, of course, ARM, which was the biggest IPO of the year that went public last week. Chip Designer, it was recently listed, but of course, Susquehanna actually initiated a neutral rating on the company in this note from earlier today. If you look at that stock, though, it actually fell 1.6%. And then also Deere, wanted to point that out, the world's top agricultural equipment maker there. Looking at that stock today, down about 1.8%, its worst day since September 21st, so obviously yesterday. And then looking at that, Canaccord Genuity actually downgraded shares from hold to buy.
Let's talk about what went on in the Treasury space here. If you take a look at the Bloomberg Aggregate Treasury Index here, down on the week on a price basis here, continuing a trend that we've seen now for at least the past 3 weeks. Yields on a daily basis are lower, but on a weekly basis, they remain elevated. 5.1 and change right now is where we end on the 2-year. That's higher than where we were just 7 days ago. Similar story for the 10-year yield, which at one point did crack above 4.5%, now settling in today at right around 4.42. And on the longer end of the curve, you take your 30-year yield, we're at 4.5, and the 20-year at 4.7 here. And it raises a lot of questions here about the correlations that we're starting to see in the market, the positive correlation now between stocks and what's going on in treasuries, and what that means for market positioning, particularly now that that Fed meeting is out of the way, right? We got to wait till, end of October before we get the next one. And we don't have a whole lot. We get some economic data over the next few days. It'll give us maybe a read on inflation here, but this is a market kind of left to its own devices with a couple of potential gray swans out there, including a government shutdown that could come at the end of next week.
Yeah, that's the thing. I mean, it feels like we're entering into a little bit of a void. I mean, PCE, now that I've said that, probably blow it out of the water. We'll see what happens. It's interesting, though, to think about that positive correlation that has emerged, because even though you haven't seen it in the price action, I talk to a lot of people who say it's time to really step into bonds. It's time to lock in those really high rates and get comfortable with duration here. Maybe if we finally do see some relief on the yield front, they'll translate into good news for equities.
You know, it's interesting. Sylvia Jablonski over at Defiance ETFs was on with us, and she said she has seen a little bit of panic selling certainly this week, but she says she's also seeing a lot of, what did she say, buying on the